Welcome back to the channel Future CMAs. I hope you're doing great. I hope your preparations are going on a fast track basis and your confidence is at the peaks right now, making sure that you're well ready for this exam in December 2025. So, are you guys understanding this fact that 25 days from here will change your career completely? Your career is on the line just based on the next 25 days. A little extra efforts, a little extra push from here for 25 days will convert you from a student to a professional. You'll be called as a member of the Institute of Cost Accountants of India from here. So I hope you understand the importance and the intensity of this 25 days. I hope you're very, very confident there. With that being said, I'm very, very excited to announce the CMA Final Paper number 13, Corporate and Economic Laws Fast Track Session. This is not your regular marathon you see. This is concept oriented. We'll be delivering concept at the same point of time, trying to comprise it into such less period of time so that your time is efficiently utilized, your time is optimally utilized. I have reduced it within a time frame of 6 hours 20 minutes, covering a huge amount of syllabus with conceptual clarity as well. So what are the chapters we'll cover in this particular video, sir? We'll be covering all your other laws. Why other laws? I understand the fact that company law is also important. I'm not denying with the fact company law is not important. Company law is important, but at the same point of time, company law is something where 99% of you, the students, have comfort in it. They are understandable, they are replicatable, and they are able to be memorized easily. But the problem starts arising, especially in the economic laws. If you don't understand the importance of these economic laws, we have made a little strategy video of CMA final paper number 13. You can watch this video on the YouTube and come back to this fast track session after that. So because of the fact that these particular set of chapters have a huge amount of weightage and direct questions are being asked, they're easy to score marks, but they're difficult to understand because they're a different world, because they're different authorities, because they're different terminology, something which is completely new for you, difficult for you guys to understand. So this particular fast track session will make sure that your concept clarity is clear. At the same point of time, your memorization is also created. So my suggestion is, say pick in one particular chapter, raising of finance from capital markets. Listen to the class. Once your class is done, you go through the material, whatever material you have in your hand, go through it on your own. Once you have done your entire material, then go through a couple of questions from the chapter to understand the chapter. Spend a couple of hours of time on each of the topic. You will be very, very comfortable for exam. Spend 2 days of time, mama, 6 hours of class. Your preparation may be for 10 to 15 hours depending upon your position. Spend a couple of days with me with this corporate other economic laws we have. Coupled with your corporate law, you will guaranteely get an exemption out of it, no doubt at all, which will create a moral boost for the rest of 7 subjects. At the same point of time, help in aggregate for group number 3. So why so important, sir? Give me a brief about it. This particular 5 set of chapters will come for close to 30 to 40 marks in the subjective part of your paper, and at the same point of time, somewhere around 4 to 6 questions in MCQs, that is 8 to 12 marks in MCQs. In total, tentatively, it will come for 40 to 50 marks in your paper. 40 to 50 just from 5 chapters in just 6 hours. You have a good amount of opportunity to go through them, properly revise and properly attend the exam for this. And also helping you out with this, I'll also bring in the timestamps for each chapter, each unit in the description of this particular video. Timestamps will be allocated. You can watch the specific particular topic which you're not comfortable with. Then you'll also be given charts. Whatever charts I have drawn during this fast track session, entire charts are summed up into a single document, and this document will be shared in the description of this video as well. If you have any other requirements regarding presentation, let it be time management, let it be the paper pattern, whatever you have doubts, leave a comment in this particular video. I'll come back with it. And don't at all get me wrong, I'm not promoting it as a substitute for your regular classes. Regular classes are must and do. Once your regular classes are done, these are done only for your revision purposes, not a substitute for regular. Let me get that clarified. The regular class for these 5 set of chapters will be ranging, my regular classes will be ranging from 40 to 50 hours. We'll do a conceptual in-depth analysis into these chapters for 40-50 hours. But now I have made an effort to comprise them into 6 hours 20 minutes without losing the conceptual clarity on it. So if you are a student who is starting paper 13 just now, this video is not for you. This is not a video which is going to help you in any way given. This video is helpful for only those people who have a basic knowledge of the subject. This has been 40 to 50 hours have been now comprised into 20 minutes, 6 hours 20 minutes. I hope you understand the intention of this particular video. Let's get into the fast track session. I hope you'll get the most out of this session, right? Sure. Let's start with the chapter SEBI ICDR. I know the chapter's name is different from your ICMA study material. It is basically an extract. It is an extract from the topic called as SEBI ICDR, which expands itself to the topic issue of capital and disclosure requirement. But as per our syllabus, it will be called as raising of finance from capital markets, initial public offer. We know this whenever a company wants to go for a public offer. We have learned this in our Companies Act format. If a company wants to go for a public offer, they'll issue prospectus, they'll invite the public at large, and they'll allot securities. It was as simple as this process that I'll issue my prospectus. But SEBI states that, wait a second, if you want to actually raise money from public at large and you want to use the money of public at large, I want to make sure that the public's money is kept in the safe hands. I'm not going to allow any random person to accept money and run business activities. If at all that company goes into losses, it is not only the company, the promoter that's incurring loss. It's also the public who are incurring losses. Public's money is at stake. Then SEBI states that we have put certain conditions under a regulation called as ICDR. What's the full form of ICDR, guys? Issue of capital and disclosure requirement. Fulfill all these conditions of ICDR. Once you fulfill, now I am ready and happy with the fact that you are worthy enough. You are worthy enough to raise money from public at large. Then you can go raise money from public. You can go get your securities listed. You can start calling yourself as a listed entity. Hence, this process of ICDR is required to be fulfilled. At what point of time? Even before the company goes for a public offer. Once the money has been raised from public at large, I don't sit silently. SEBI states that once money has been raised, I have to make sure that you are maintaining your stature, you are maintaining your level as a listed company, you are maintaining your rules and regulations correctly, for which they have drafted something called as LODR, Listing Obligation Disclosure Requirement. I hope these two words are clear for us before we start this chapter. ICDR is something which we have to fulfill before the company goes for a public offer, and LODR is something which we have to fulfill once the listing has already happened, after listing has happened, after the company has raised money from public at large. Now, what are we going to learn in this chapter, sir? Let's list out everything that is going to be learned. It will make it easy for you to go through this chapter once the revision is done. We'll start with a topic. We'll call a company who is raising money from the public called as issuer. This issuer to raise money from public will have to be considered as eligible issuer. Will check their eligibility. The first point we'll learn is whether the issuer is eligible or not. They're issuing securities to public, they should be eligible to do so. Eligible issuer. Once you're categorized as an eligible issuer, you can raise money from public, you can go for IPO, initial public offer, only when you have fulfilled other conditions given in the law. There are some other conditions. Now here what happens is, we'll be learning 10 conditions here. Once you have satisfied all the 10 conditions, you're called as eligible issuer. That doesn't give you right to directly go raise money. Now you have to fulfill other conditions, then you are allowed to go for an IPO, initial public offer. So what's the conclusion, sir? If I satisfy both of these two things, then can I raise money? Yes. If you have, imagine, if you have satisfied these conditions of eligibility, but you have not satisfied the conditions, other conditions of IPO, can you raise IPO? No. If you have not satisfied, second situation, if you have not satisfied the eligibility conditions at all, I'm not even going to talk about other conditions. You're not going to be able to raise money at all. You have to fulfill these both conditions, only then you can go for IPO. While you're going for IPO, there are a lot of formalities you have to do. You have to prepare your prospectus, you have to advertise your prospectus, you have to make sure that you are entering into contract with the depository, you have to enter into contract with a stock exchange, recognized stock exchange. We have money to be received, we have to analyze the money, collect the money, we have to allot shares. There is a lot of procedure to be done. For this procedure to be done, don't expect the board of directors themselves to do it. Board of directors already have a huge headache on their shoulders to run the business, manage the business. This process of raising money will take at least 3 to 4 months of time, and you're not expecting the board of directors to tackle this process of 3 to 4 months, keeping the business aside. So logic states that you, the board of directors, continue to manage the business. We will appoint certain set of different people who will come and manage everything for the process of raising money. We call them as merchant banker. This merchant banker will help the issuer to raise money from public at large. Merchant banker, along with his intermediaries, will raise money on behalf of the company. So we'll learn who is merchant banker, what are the other intermediaries we have, and we have briefing about what do they do and how do they help the company to raise money at large. So merchant banker and intermediaries will be learnt. Now while we are raising money from public at large, we have learned this in our inter level. You can sell the shares at a price higher than the face value. Then how to fix this price? We'll understand the pricing of securities. We will sit down to fix the price of securities. While we are fixing the price of securities, now understand this. If at all we fix a similar price, a same price, identical price for every single investor in the market, what will happen? All these so-called big entities, insurance companies, take in LIC, take in any banks or financial institutions, they have huge set of money. They'll dominate every small investor to make sure that the small investors and employees of the company are getting a little benefit, a little edge over the other investors. We have something called as not similar pricing, we have something called as differential pricing. We'll differentiate the price when compared to other big players in the market, giving them a benefit to purchase the shares in a better manner. Differential pricing will be categorized. Then the next category we'll have is something regarding the promoter. Now, end of the day, business is being run not because of just the finance given by public, but also based on the idea of the promoter. The idea of the promoter comes from his brain and it is known to the promoter himself. If he does not invest, if he is not interested, if he is not putting efforts into the business, it is not the company, it is not the promoter losing, it's the public losing. I can't take that risk. Hence, promoter must be having minimum contributions to the company. And this minimum contribution will be locked in for a certain period of time, making sure that he is not going to be exiting the company as soon as public has given money. We'll learn about minimum contribution of promoter and we'll also learn about the lock-in period in the process of promoter. Then the last topic, last and I would say one of the important topics for your attempts of December, book building process. What's going to happen, sir? If the company is going for IPO, the company is not able to exactly fix the price on its own to understand the demand and the pulse of the market, to understand the demand and supply of the public at large. We'll do something called as book building process. It's nothing but a process where we have a book. This book, multiple applications are received, multiple papers are prepared, and we prepare a book. End of the day, this book will be used for the purpose of raising money and understanding demand. To understand demand, we are building a book, the book building process. We'll do the book building process, last topic of this chapter, book building process. Now, I hope you have a clear clarity on what is there in this chapter. This 5 to 6 minutes of introduction will make you understand the chapter and have a flow of the chapter very clearly. I'll be leaving timestamps at the end, at the description of this particular video to have a clear-cut picture on this point. So let's start with the first point we'll learn, the eligibility of issuer. Who is an issuer and who can? Which issuer, which person can raise money? We have a total of 10 conditions to satisfy. The first condition states that I want 5 set of people. Who are the 5 set of people? The issuer, the promoters, promoter group. What do you mean by promoter group? The close relatives of promoter are called as promoter group, or the directors or selling shareholders. When the shareholder is selling his securities to the public through the company, they are called as selling shareholders. They are not, they are debarred. If at all they are debarred from accessing the capital markets, the issuer cannot make a public issue. Issuer can make a public issue only when they are not debarred. But we are framing it in a negative sentence stating that a issuer cannot make a public issue if the promoter or if the issuer, promoter group, director or selling shareholder is debarred. Debarred from doing what? Accessing the capital market, or these 3 set of people, issuer, promoter and directors, are willful defaulter. They have done default in the past in a intentional basis in the past. They might do it again with the public's money in the future. I'll not take the risk. Or the existing partly paid up shares of the company have been converted into fully paid up have been forfeited. Just the simple logic. If you have money in your pocket, use that first. If you have used your money in your pocket completely, then come ask money from the public. Partly paid up shares shall not be existing. Then you must have entered into an agreement with a depository so that the securities will be in the future converted into dematerialized format. And the existing promoter's shareholding, the promoter's holding shall also be held in a dematerialized form, giving an assurance to the rest of the investors that dematerialization is safe actually. But this is an outdated concept, which happened in 2013. But still, one of the conditions here. Third point was the agreement entered with depository for dematerialization, and the promoter's existing shareholding shall be held in a dematerialized format prior to the public offer. And then we have to go enter into contract agreement with stock exchanges, one or more stock exchanges, for the purpose of listing securities. But get this clear, I'm not going to go deep into it, but listing process actually happens once the securities have been issued. Today, when we are talking about conditions, preconditions for issue of prospectus, we'll be talking about the point that we'll get a permission. This permission in SEBI language is called as in principle approval. The company, the issuer, has to obtain in principle approval from one or more of stock exchanges, and if you are getting it from more than one stock exchange, we'll have to designate, we have to call one of them as designated stock exchange. This designated stock exchange must be having national-wide trading terminals, making it easy for investors to purchase and sell in the stock exchange at any time they want. Get your securities listed. Listing process will happen in the future, but today get it in principle approval. You'll get the final approval later. Then the process, once the offer has been given, it must be open for at least 3 days, but not more than 10 days. We have to receive a minimum subscription of 90%. If this 90% is not received, we have to refund the entire money within a period of 15 days. And we have one more special point, this has been a little editing mistake here. We have one more point here stating that if the company is raising a total of, assuming they are raising a total of 100 crores, out of this 100 crores of capital they are raising, only say 40 crores is raised from public. Rest of the 60 crores is being raised from other sources. We don't raise entire money from public. 60 crores is being now assuming raised from public at large, 40 crores from public and rest of 60 crores from other sources. You have to make 75% of arrangements of this 60 crores before you come for public offer, making sure that you are actually having money, not only from public 90% minimum subscription, but also 75% of the total offer, excluding the offer made to public. That is, in our case, 60 crores. Out of the 60 crores, I should have made firm arrangements for how much? 75% of the process. Then once the money is received, it will be used only for the purpose for which the money is raised. The purpose for which money is raised, what do you mean by this? I have to mention clearly in the prospectus for which money is raised. Can I use it for anything other than the purpose? No, except up to 25%. Shall not exceed. General corporate purposes shall not, because I cannot mention every single aspect in prospectus. Hence, up to 25% can be used for general purposes. Other than that, that 75% I should clearly mention for what should I be using it for. These are the first 10 conditions. Go through them quickly. Later, we have other conditions for public offer. Before I go through other conditions, I want you guys to understand the pricing of securities. Pricing of securities is done by the issuer. There are two ways in which we can fix price. One is called as fixed price method. Fixed price method, where the price will be fixed by the issuer. Or second concept called as book building process, where we'll try to understand the demand of the public. From the demand, we'll fix a price. We are not fixing a price, we are giving a option to the public to create demand and fix the price. Second option, if you're having a clear-cut picture of my company, I'll go for a topic called as fixed price method. Fixed price method, price will be fixed by the issuer with the help of its lead merchant banker. So what is this lead merchant banker? Let's understand the intermediaries now. Quick, they are not given full details to it, very basic introduction. The issuer shall appoint. Are you getting the word clear? Shall appoint. Must appoint one or more merchant bankers for the purpose of raising money from public at large. If you're appointing only one, that's fine. If you're having a huge issue, you can appoint more than one also. If you're appointing more than one of them shall be designated, one of them shall be called as a lead merchant banker who will be in regular communication with the issuer himself. So what happens if you are appointing more than one of them should be called as lead merchant banker who will be making sure that he will be communicating with the issuer and helping the issuer to raise money from public. Now, if you are having more than one merchant banker, you have to make sure that they are not overlapping their responsibilities. The responsibilities and obligations of each of the merchant banker have to be clearly segregated so that there won't be any overlapping or mishappening of regulations during the public offer process. And their segregated work must be clearly mentioned in the offer document, nothing but prospectus. Then, along with the merchant banker, we have other SEBI registered intermediaries. We have a first person we have is called as the syndicate member. What do you mean by syndicate member? We were just discussing about it. The book building process. what happens? We will receive applications and will build a book out of these applications. Multiple books will be prepared. Now, what happens? These books will be maintained, processed, analyzed, demand is fixed, and closing price is finalized by a person called a syndicate member. He'll help the book building process to be done. But while we are receiving applications, we'll receive application money also. This application money will be received and collected, kept, analyzed, verified, and given to the company or refunded to the investor back again. This process will be done by a person called as banker to the issue. Third category, a person who is going to maintain all these application forms received will be called as registrar to issue. He'll maintain a register of all the issue of this public offer. Three words I've used already, Amma. One is syndicate member, banker to the issue will collect it, registrar to the issue will basically make sure that all the application forms are received correctly. And the last and the most important, obviously, compliance officer. A person who is going to make sure that all the regulations have been fulfilled. Appointing compliance officer is mandatory. There is an MCQ on this. Make sure that you are comfortable with this. A compliance officer is mandatory before the company goes for a public offer. All these set of people must be appointed. Now, coming back to the pricing of securities. Pricing of securities, as we discussed, there are two options. Either it is called as fixed price method or book building process. Fixed price method, it is fixed by the issuer with the help of, in consultation with the lead merchant banker. Or otherwise, we can go for book building process. Let it be debentures, let it be equity shares, doesn't matter, it will be this process. But make sure that your price you are fixing shall not be lower than the face value. It can be either equal to face value or it can be more than premium amount. You can charge more than face value. In book building process, we don't specify a particular price. Rather, we do something called as, we'll mention the price range. Price range is something which is a combination of, assuming they'll mention 10 and 20. What is 10 and 20? 10 will be called as floor price, 20 will be called as cap price. How much ever you are invested, send the application forms. I hope that is visible, Amma. 10 is called as floor price, 20 is called as cap price. Whatever interest you are showing in the company with at a particular price, make an application. Make a higher application, you will have a higher charge. Make a lower application, you will have a lower chance of getting allotted. But book building process, if you want a video on book building process specifically, we'll do an example. We'll have maybe 15-20 minutes of discussion on how the book building process actually happens in the practical world. I'll create a hypothetical example. If you want it, leave a comment on this video. We'll go through that. Shall I come back to our conditions? We are already 17 minutes into the video. Quick. So what are the other conditions we have? There are, just get this clear. This is given under 6.1. Regulation number 6, sub-regulation 1 mentions a total of, little editing mistake here, guys. Four conditions. How many? 4 conditions will be mentioned. These are basically note points. There are a total of 4 conditions mentioned under regulation number 6, sub-regulation 1. I'll give a briefing of it before we go into the points. If you satisfy 6.1, we are happy with the fact that you are a stable company. You are having good amount of profits, you are having good amount of assets over a period of last preceding 3 years. Now I am happy that you are able to raise money and you'll be able to manage that money properly. But if you have fulfilled the previous 10 conditions of eligibility, but you are not able to fulfill these 4 conditions given under regulation number 6, sub-regulation 1, you can still go for the public offer, but you have to go through an alternative route under regulation 6, sub-regulation 2. Where now the SEBI states that because you did not fulfill 6.1, I don't completely believe you. I don't completely believe that you are a stable company to manage money. Hence, don't raise your collars and come to the public at large and demand a price. Do it by a concept called as book building process, where even though you're doing book building process, even though price is fixed through the demand of the public itself, there's a chance that there is a risk involved in the process. If there is risk involved in the process, I don't want the small investors to be affected. I don't want the small investors to be affected by an unstable company in the market. If it is a huge investor, a huge net worth investor, they'll be having enough money to sustain the losses if they're incurred. But when it talks about a small investor, they don't have enough amount of money, enough amount of risk bearing capacity. Hence, I want your investment of 75% of your investment. At least 75% of your investment should be purchased by someone called as QIB, Qualified Institutional Buyers. A quick briefing, we have 3 kinds of investors in the market: RII, NII, QIB. RII, retail individual investor, a person who is raising money from, who is investing at a retail value, small amounts. You and I come under RIIs. Then second category, NII, non-institutional investors. They are not institutions but still investing at a higher value. Mukesh Ambani, he will not invest 1 rupee, 10 rupee, 1 lakh, 10 lakhs. He will invest crores of money. He will be called as NII. Last category, QIB, qualified institutional buyers. All insurance companies, banks, financial institutions, mutual funds will come under this category. QIB, they're not individuals, and they're not investing small amounts. They're investing huge amounts. They're called as qualified institutional buyers. They have higher capacity to bear losses. Are we getting this point clear, Amar? Let me sum it up. 6.1, stable company, you can raise money. 6.2, if 6.1 is not satisfied, you can still raise money, but not by fixing price, but going for a book building process where not less than 75% of the issue must be given to the QIBs, making sure that majority risk is in the hands of QIB. Let the QIB suffer, they'll be able to sustain it. But we are not going to make suffer RII, retail individual investor shall not suffer. Keep this in mind. I'll use it in the book building process. So what are the conditions to be satisfied, sir? The first condition states that we must have a net tangible asset of at least 3 crores, not in 1 year, 2 years, in each of the preceding 3 years. How much? At least 3 crores in each of the preceding 3 years, out of which not more than 50% shall be monetary assets. What do you mean by monetary, sir? Which can be easily and exactly converted into cash. If they're in monetary, what do you mean by monetary? Give me examples. Cash, investments, bank balance, inventory, debtors. They're not actual business activities. They're kept in the company. They're not used for business. Hence, not more than 50% shall be in monetary assets. Meaning that 50%, at least 50% shall be non-monetary for business. If you're having more than 50% for monetary assets, we have to make a arrangement, you have to make a declaration stating that it will be used for business or a project in the future. Only then you are allowed to do so. Second case, second category, you must be having a net worth of at least 1 crore in each of the preceding 3 years. Two conditions regarding assets done, net tangible assets and the net worth topic, where they must have net tangible assets of at least 3 crores, net worth of at least 1 crore in each of the preceding 3 years. Then we must have, this is important, we must have a pre-tax operating profits, average pre-tax operating profits of at least 15 crores. But sir, how to calculate this average? We'll take the last 5 years. Out of the last 5 years, we'll pick the 3 most profitable years. Get it clear? We'll go search for last 5 financial years. Out of the last 5 financial years, which are my 3 most profitable financial years, out of which I'll pick and I'll make an average, which should be at least 15 crores. If you have changed your name previously, you should have generated at least 50% of your revenue from your new name. Only then I'll allow, otherwise you'll be bluffing the investors by giving a new name, by giving a wrong intention, but not having revenue from the new business. If you have changed your name, you must have at least 50% of revenue in the last 1 year from this new activity which you have added. If you have fulfilled all these 4 conditions, you are able to raise money from Regulation 6, Sub-Regulation 1. If not, you can still raise money from Regulation 6, Sub-Regulation 2, but remember, you have to go through the concept of book building process, and at least 75% of it must be given to the qualified institutional buyers. We have some more other conditions, I'm going to quickly go through them. A company issuer can go for IPO of convertible debt instruments without making a public issue of equity shares. What is it? We can go for convertible securities without going for equity shares, but if it is convertible in the initial stage, it will be considered as a debt instrument. And if it is debt instrument, what are you expecting out of it? Interest on a regular basis. Make sure that only point is the company, the issuer, has not defaulted in payment of interest and principal in the last 6 months. But if at all you are going for issue of any convertible securities, making sure that the existing convertible securities of the company have been already converted. There are no outstanding convertible securities in the company. Why, sir? If there are outstanding convertible securities, the proportionate of the company, the percentage of the company, the capital structure of the company will completely change after the conversion happens. If this is happening after IPO, I'll be bluffed with the point that I'll have lesser percentage of company. So make sure that your outstanding convertible securities are not existing before you go for a public offer. While you're going for public offer, you must have a minimum prospective allottees of not less than 1,000. at least 1,000 prospective allottees must be there. Otherwise, public offer doesn't make sense. You advertise, you have made a lot of noise in the market going for public offer, but you have raised only from 10 people. Doesn't make sense. Prospective allottees should be not less than 1,000. This is important, if the issue price is more than, not more than equal to, issue price is more than 100 crores, we have to appoint a bank or financial institutions which will monitor and report on a quarterly basis about the utilization of that fund up to 95% of the total fund raised. Assuming we have raised a total of 200 CR. How much? 200 CR. Out of this 200 CR, up to 190 crores that have been utilized, the bank or financial institutions will, couple of points, they will monitor and report on a quarterly basis until how much percentage? 95%. Last category, if at all you are going for, this is not mandatory, this is optional, because end of the day we are raising money for equity shares, not for debentures. So credit rating is usually not required. So they have given the word, the issuer may provide a credit rating from any of the credit rating agencies so that they'll have a minimum guarantee that company is having proper background, proper credit worthiness in the past. If all the conditions are satisfied. I know it is difficult to remember, but this can be asked as a question. Be careful with this point. Make sure that you go through all the points. If you are not comfortable, go through this video again, right? Differential pricing, quick. What is differential pricing? There are three set of people who are given differential pricing: retail individual investor, the shareholders, that means existing shareholders of the company, and employees. Three set of people: RIIs, employees, and existing shareholders are given differential pricing. They can be sold securities lower than the offer price, issue price, but the offer which is given to such people shall not be lower than 10%, shall not be lower than 10% of the net offer price made to the other category of people. If to the public I am selling at 100, I can sell to my employees at a least price of 90. Anything above 90 is fine, but below 90 is not fine, not less than 10%. If you are an anchor investor, what do you mean by anchor investor? A person who is investing even before the company has gone for public offer, giving an assurance or stability to the company before we go for a public offer. You know this word, anchor. We are making stability in the process. But this anchor investor is not given any differential pricing. He will be sold with the same pricing as other applicants, other categories in the process. But if at all you are going for book building process, the employees can only be given a differential pricing. But remember, as we have discussed, book building process doesn't give you a specific price. They give you a price range. Assuming it is 10 from 20, 10 to 20, 10 is called as what, floor price, 20 is called as what? Cap price. You can sell your securities at a price lower than the floor price, but it shall not be less than 10%. What do you mean by that? I can sell at 9 at max. We are giving discount on what? Not on the closing price. We are giving discount on the floor price. Given the fact that floor price is 10, we can give a discount of maximum 10%. We can sell at 9 rupees, right? Second, next, this is important, a small chart for you to remember. If the issue price of the securities is more than or equal to 500, to make sure that my securities are accessible in the market for every shareholder, I might reduce my face value. Face value of the securities can be either 10 or less than 10, but it shall not be lower than 1. It can be less than 10, but shall not be lower than 1. If at all your face value is less than 500, issue price is less than 500, then the face value of the securities must be exactly 10. We are having no other options. It cannot be less than 10. Are we getting this clear, ma? If the issue price is more than or equal to 500, I can fix my face value either at 10 or less than 10, but it shall not be less than 1. And there is MCQ on this. If the issue price is less than 500, we have to have a minimum face value of rupees 10. Coming to the promoters category, we have three categories of public offers which come through. We have IPO, we have FPO, and we have something called as composite issue. What is IPO? Initial public offer. When we are going for initial public offer, the promoter shall hold contributions worth 20% of the post-issued capital. Let me give a basic example for this. We have a existing paid up share capital of the company amounting to, say, assuming 100 crores. What's the existing paid up share capital? 100. And we are going for a proposed paid up share capital, proposed public issue of, say, assuming another 100 crores. This is what am a public offer. Proposed public offer of 100. So what is my total post issued share capital? 200 crores. Out of this 200 crores, the promoter should be holding at least 20%. At least 20% of the post-issued share capital. That means 40 crores shall be held by the promoter. This is for IPO. When it is going for FPO, that means the company has already gone for public offer in the past. They've already gone for IPO in the past. Now they're going for a further public offer. In case of further public offer, he should be holding either, two options are given among, either 20% of the proposed public offer, the new public offer which is coming, that means this 100 new public offer, or 20% of the post-issued capital. He can fulfill any one of the conditions, either 20% of the proposed issue size or 20% of the post-issued capital. Either of the points can be satisfied. Then the last, composite issue. What is composite issue, sir? It is comprising both public offer as well as rights issue. Get this clear. We are totally raising 100 crores. Otherwise, I'll take another example. We are raising a total of 500 crores in total. Out of this 500 crores, I was able to raise from my existing shareholders an amount of 200 CR. This will be called as right component. Right component is the shares which are offered to my existing shareholders. Other than the right component, rest of the amount will be sold to the public at large. What's the public component in this? The public component will be 300 crores. I am, as an promoter, expected to have 20% of the public offer, 20% of the total issue, excluding the right component. That means I'll be having to purchase how much? 20% of the public's offer, excluding which? Rights issue. So in this particular case, 20% of 300. So what is the wordings used, among? 20% of the proposed issue size, total proposed issue size, excluding the rights issue component. I'll exclude the rights issue component. Excluding that, I'll purchase a 20% of remaining amount. In this case, not 500, not 200, I'll be purchasing 20% of 300. Once you have purchased this, lock-in period. I'll give a small chart for this. Lock-in period, you have to continue to hold the securities. As we discussed, the promoter is expected to give his ideology back to the company. If he doesn't provide his ideology, if he is not invested in the company will incur loss, public will incur loss subsequently. To make sure that public are having enough assurance regarding the promoter, we have something called as lock-in period. You are not allowed to sell your securities until this period has expired. Lock-in period is of two types. Either they have given a mandatory lock-in period of 20%, or otherwise I'll explain in this way. Wait a moment. Now I'll explain this. This is better presentation. Lock-in period of 20%. This 20% of money shall be locked in for a period of 3 years. Why 3 years, sir? We are expecting that in this 3 years, the ideology of the promoter is now being understood by the board of directors. Now, who can manage the business? Board of directors without even the help of the promoter. Hence, the promoter is required for our business only for a period of 3 years, lock-in period. But this was the minimum subscription we have purchased. If you remember, we were using the word at least 20%, at least 20%. Can he purchase more than 20%? Yes. If he has purchased anything in excess of 20%, that excess money will be locked in. Then I'll ask a question. If this excess of 20% was purchased in IPO or it was purchased through an FPO. If it is purchased through an IPO, it will be locked in for a period of 1 year. If it is purchased through an FPO, there won't be any lock-in period. No lock-in period will be applicable for us. Get this clear, Amma? This 20% is mandatory. For this 20%, how much is the lock-in period? Let it be IPO, let it be FPO. It will be 3 years. But if you have purchased anything in excess of 20%, lock-in period for IPO will be 1 year and FPO will be 0. No lock-in period. I'll give an example, quickly answer it. If I have purchased 25% through an IPO, give me the answers here. 20% will be locked in for 3 years. 5% will be locked in for 1 year. If the same question, if I have changed it slightly, this 25% was purchased from not IPO but from FPO. 20% will be locked in for 3 years, but that 5% does not have any lock-in period. Promoter can sell it anytime he wants. That's the lock-in period concept. Go through that. And this 3 years, when is it counted? This is also a very interesting topic. 3 years shall be counted from where? From the date on which the company has commenced its commercial production. Why commercial production, sir? They've raised money, they've sat silently. They have raised money, but after raising money, they did not completely start their business. They sat silently for 3 years. The ideology of promoter was not flown through the directors. They have to commence commercial production, only then the promoter's ideas will be given and will be used, will be understood by the board of directors. Hence, they have used the word either from the date of allotment if you have already started commercial production, or if you have not started commercial production, I'll count it from the date of commencement of commercial production. Now you guys be the judge of it. 3 years from the date of commencement of commercial production, or 3 years from the date of allotment of the securities, whichever is later. Good. Whichever is later. Last topic, book building process. Again, an interesting logic. What is happening in book building process? Let me directly jump into the concept here. As we have discussed in the previous topic, we had three kind of investors: RII, NII, QIB. RII, retail individual investor; NII, non-institutional investor; QIB, qualified institutional buyer. Now, we can go for IPO. While going for IPO, there are two routes in which I can go. Either I have fulfilled the conditions of Regulation 6, Sub-Regulation 1, or if I have failed to do so 6.1, I might have gone through 6.2, right? If at all, expanded. If at all I am coming from 6.1, I have discussed this in the pricing process. We have two ways in which we can fix price. Either it can be fixed price method, or it can be book building process. What is it, Amma? Fixed price method or book building process. If it is 6.2, we have only one option available, that is book building process. Is this clear first of all? Chalo, continue that. Let's start with this point, it will be easy for you to understand. We have three people: RII, NII, QIB. Now coming to this point, we are fulfilling all the conditions. I hope this is visible. We have all the conditions fulfilled under Regulation number 6, Sub-Regulation 1. If you have fulfilled all the conditions, get this clear, less risk is involved. You are a stable company, you have enough assets, you have enough profits generated, you have enough net worth, you are using your money, assets for business activities, you fulfill every conditions there. That means you are actually a stable company, you are having enough amount of resources and having stable. I'll let everybody will be interested to purchase. Are you getting this? Everybody will be interested to purchase in such kind of company. If everybody is interested to purchase and we are allowing everybody to have equal opportunities, QIBs will completely dominate everybody else. They have huge amount of money. They'll dominate the entire set of process by quoting the highest price and getting the price allotted at high price. QIBs will be the only persons invested. Now the company law, SEBI regulation states that will give a reservation to the RII because there is no risk involved. Let's start with the point that RII should be given reservation. RII shall be holding not less than 35% of the public offer. 35% of public offer is reserved for RII. At least 35% should be given to him. Then NIIs can take a little bit of risk. We'll give them not less than 50%, 15%. So up until this point of time, 50% of the public offer is already eaten up. Rest of it, you can give it to your QIBs. So give me the negative framing of this logic. QIBs during 6.1 can hold a maximum of 50% because the rest 50% is reserved for RII and NII. It will be not more than 50% held by the QIBs. But the picture completely changes if you come to this side of the story. Regulation 6, Sub-Regulation 2. You failed to fulfill Regulation 6, Sub-Regulation 1. If you fail to fulfill Regulation 6, Sub-Regulation 1, you are not a stable company, but you are still going for an IPO. I'll allow it, but you have to go through only one concept, book building process. If that is the situation, listen carefully. Will I start with RII? No, sir. I'm not going to let the RII take risk. I'm not going to let the NIIs take risk. We have already discussed this. How much should be given? QIBs must be holding. How much percentage? Not less than 75%. I'll start from the bottom this time. Giving more importance to the QIB, let them take more risk. Because we are under regulation number 6, Sub-Regulation 2. We'll start from QIB from the bottom. Let them take more risk. Then we'll give not more than 15% to NII, not more than 10% to the RII. I hope you are getting this concept. If not, play back this 5-10 minutes properly. You'll understand the reasoning behind it. Chalo. Last category, 6.1. If it is fixed price method, you have fixed it. Go do whatever you want. We have only one condition. the RIA shall be given not less than 30%. At least 30% must be given to the RIA. Rest of it you might give it to your NII or your QIBs. No reservations for them. Whatever you do it, you can do it. A special point. A special point. Listen, this QIBs, I have how much percentage? Not less than 75 or not more than 50%. Out of this QIBs, now the Indian market is booming towards mutual funds. If you have observed it, Government of India is also extensively, aggressively advertising mutual funds, making sure that small investors are able to make a knowledgeable investment. This mutual funds will be given 5% in this 50% or 75. It is not 5% of 50 amount, it is 5% in 50 or 5% in 75 will be given to mutual funds. And anchor investors will be given a maximum of 60%. Because if you're giving entire thing to anchor investors, you're just making noise in the public platform stating that you're going for public offer. Not more than 60% shall be given to the anchor investors. That's your entire book building process. I hope this video is informative. I've tried to keep it as crisp as possible, at the same point of time giving all the logics that are available in this chapter. If you have any other doubts in this chapter, I'm very much happy to answer your doubts. Leave a comment on this particular video, or you can join our Telegram channels. I'll put a link in this particular description. We'll meet in the next session. And also, if you have made this far into the video, guys, like the video, share with all your friends. And let's get started with the next topic, SEBI insider trading. Last session, we have done the topic of SEBI raising of finance from capital markets. Now we are jumping into SEBI insider trading. I'll keep the introduction very short. I hope you guys understand the reasoning behind this chapter before we jump into the procedure and concepts of this particular chapter. Let's take a very small example for this. You're talking about the concept of trading here. What do you mean by trading, sir? In simple terms, trading means buying and selling. But if you're coupling this word trading with the word SEBI, SEBI is talking about trading. That means basically trading of what? Securities. Trading of securities means simply buying and selling of securities on the stock exchange. Buying and selling of securities on the stock exchange will be done where you'll make either profits or losses from stock exchange depending upon one major thing. If you are able to predict the price of the securities, where is it moving? Is it moving upwards? Is it moving downwards? Is it a bullish market? Is it a bearish market? If you're able to predict this particular movement of the securities, you'll be able to make profits. Just imagine, if I have a prediction that price of securities will increase, I'll go to the market, purchase securities today, hold it, and I'll sell it at a higher price tomorrow. Or if I have a prediction that price of the securities will fall down tomorrow, I'll sell my securities today, I'll go back and purchase at a lower price tomorrow in the market. Both the cases, I'll be able to make huge amount of profits. Within days, I'll make lakhs of money. In stock exchange is one particular place where you'll make huge amount of profits, crores of profits. If you are having enough capital in your hand, crores of profit could be made, but this crores of profit will be coming with the fact that you have to take a risk. And we have to underline this word clearly, we have to predict it. But your prediction will not always go right, because there are 100 different parameters in the market which might affect the price of the securities, which might even go up or down. Not one parameter, two parameters, there are hundreds of things associated with the company. Now understand this fact clear. If you're able to predict it correctly, then you'll be able to master the process of stock exchange, master the process of trading in the market. But what if I say this prediction is involving risk, right? What if I say I don't have to predict it, I know it. I, for a matter of fact, know that the price of securities will increase tomorrow. Sir, how would you know about it? I know the fact that we have conducted yesterday a board meeting in which we have approved a contract of merger of our company with Tata Group. If Tata Group is getting merged, if say assuming, not merger, assuming some kind of collaboration maybe, some kind of merger maybe, such information is available with me, and I know for a fact that this information will increase the price of securities. It will have a positive impact once it is given to the public. Now he's not predicting it, he's knowing the knowledge. Now get the words clear, Amma. If at all you are able to predict the information correctly, can I say you will have an advantage in the stock market? Yes, but if you know that it is going to increase or decrease, you'll have an unfair advantage. This unfair advantage is available with such person who we call as a insider, a person who is within the four walls of the company, who has knowledge of such matters which are not available to the public. He can take not advantage, he can take unfair advantage of his information inside the company. Hence, this insider trading must be prohibited, making sure that an insider is not unfairly using the information available to him in a wrongful manner, in a prejudicial manner for the public at large. To do that, we have a regulation altogether. Now, I hope the introduction is very, very clear. Let's get into the technical words of this chapter. Let's start with the word generally available information. If any information is available to the public at large on a non-discriminatory basis, that means nobody has any discrimination, no partiality, everybody in the public has knowledge about that information which is accessible by anybody in the public, it is called as generally available information. Generally available information means accessible by anybody in the market. Now, if this generally available information is there, I cannot take an unfair advantage because it is known to the public at large. Public might have already reacted, public might have already purchased, public might have already sold. The demand supply has already been adjusted in the market, prices have also been adjusted. I cannot take an unfair advantage. When can I take an unfair advantage? When the information is not generally available. What is a contradictory point here? What is something which is contrary to that? Unpublished information. Information is not given to public, but not every unpublished information will have impact on the pricing of securities. If it is merger, dividend, financial results of the company, Mukesh Ambani resigned from his office as managing director, these are some factors which are unpublished and will have a impact on the securities of the market. Same thing, if there is some unpublished information, one of the employee resigned, will it have a negative impact? Nobody cares about it. If it is unpublished but it is not having impact on price of the securities, I don't care about it. What do I care about it? If it is unpublished information and it is affecting the price of the securities, then we call it as unpublished price sensitive information. I'll use from here is UPSI, unpublished price sensitive information. This unpublished price sensitive information, there's a definition. I'll go through that, just listen carefully. Any information relating to the company or relating to the securities of the company, either directly or indirectly, which is not available to the public. Which is not available to public means it is unpublished in nature, and upon becoming available to public, once it is becoming available to public, it is likely to have material effect on the price of securities. Once it is given, it will have an effect on the pricing of securities. Repeat the definition after me. Unpublished price sensitive information means any information relating to the company or the securities of the company, directly or indirectly, which is not available to public, but upon becoming available to the public, which will likely to have material impact on the price of the securities, called as unpublished price sensitive information. And they've given some examples of the process. Now come to the exact point of contact, insider. Who do we call as insider? Is a third party insider, is a board of director insider, is an employee insider, is a key managerial personnel insider, an employee, officer of the company insider, auditor of the company insider. Who will be called as insider? The word insider is divided into two parts. Either you should be connected with the company, associated with the company, I'll call you as connected person. Or if you are not a connected person, listen carefully, one of your friend is a board of director, one of the friend is a connected person of the company, but that connected person forwards that information to you. Now, if he forwards the information to you, you also have unpublished price sensitive information. You also can now take an unfair advantage. Now, the word insider has technically very carefully added this word. Any other person, I don't care. I don't care his relation with the company. Any person who is having possession or access to unpublished price sensitive information, I'll call him as an insider. Even though he's not having any relation as such with the company, he's not exactly associated, but if he's having possession or access, he got it somewhere from the connected person, he'll be called as a insider. Insider can be of two types among. Either he is a connected person, or insider means a person who is having possession or access to unpublished price sensitive information. If you're having such access, you're called as insider. If this insider is having unpublished price sensitive information, he shall not trade in the securities of the company. We are gonna restrict him from taking that unfair advantage. Now, coming to this definition, I'm gonna be very quick into this definition. Connected person. What do you mean by connected person? means any person who is in the present or has been in the past, has been in the 6 months prior to the concerned act in the stock exchange. Whatever trading that has happened in the stock exchange before that, in the last 6 months or during this period, if at all such person is associated with the company on a regular basis, directly or indirectly. This association can come in different manners. Either it can be contractual, it can be employment based, it can be professional based, it can be fiduciary based, it can be temporary, it can be permanent. I don't care how you are connected. If you are associated in any manner of such sort, or even you are having continuous communication with any of these connected people, and you are having possession of unpublished price sensitive information, I'll call you as a connected person. Now, are you getting this concept clear? SEBI wants to make sure that everybody is included in this definition, making sure that this regulation is properly implemented. I want everybody who's associated is included. Get me the words clear, Amma? A person who is or has 6 months prior to the concerned act associated with the company, either directly or indirectly, in any manner as such, contractual, fiduciary, employment, director, officer, professional, any auditor, permanent, temporary, doesn't matter. Only thing that matters is if you're some other way associated slightly and you're having possession to the unpublished price sensitive information, I'll call you as connected person. Now start thinking from the person's perspective, not from SEBI's perspective. I don't want to be called as connected person. I don't want to be called as insider so that I can trade in the securities. Now, for that set of people, we have added a topic called as deemed connected persons. There are certain persons who are deemed, assumed to be connected persons unless you prove it to be contrary. That means, give me example, sir. A banker, X amount of money got all of a sudden deposited into your bank account. X amount of money was transferred to so and so company on a particular date. There's a high chance that your banker has information. Good. Your banker will be called as connected person, deemed connected person. Your relative, immediate relative. Sir, what do you mean by immediate relative? I have drawn some charts for you so that the class will be a little easy, Amma. I'll share this document if required. Do comment if you require. Otherwise, you can pause it and draw this. Otherwise, you have also drawn for other category of points. If you want, you can pause and draw. Otherwise, if you want, comment below. I'll send this document to you. Immediate relative. Let's start with this. Very important. A person. Let's start with the word person. Who is immediate relative? A person, his spouse, his parents, his siblings. You are smart enough to understand this. Children of the person or children of the spouse. I'm not going to explain it, Amma. You guys understand it. Spouse, parents, siblings, or children of the person or children of the spouse. Who are? When will they be called as immediate relatives? If they are financially dependent on such person, or they are consulting such person, asking advices from such person when they're trading in the securities. Two things. Either they must be financially dependent or they are consulting such person while taking decisions in the securities market. While trading in the securities, they're taking their consultation. That means he's helping in securities. Then such set of people will be considered as immediate relative, and an immediate relative will be considered as a deemed connected person. I hope you're able to put everything together. Just an introduction here. Insider means a connected person. Connected person is associated. A person who is associated with this connected person, immediate relative, is also considered as a deemed connected person. If you're deemed connected person, you're indirectly included in the definition of insider. Good. So all the group companies we have, holding company, subsidiary company, associate company, my banker, my mutual fund, my basically intermediaries, my immediate relatives, my venture capital funds, my investment vehicles, all these entities are considered as deemed connected persons. I hope this is clear. Just go through all these points. They can ask it as a MCQ also, who are deemed connected persons. Go through all the points now. Then compliance officer is not much required. We'll go through that later. Let's start the procedure of the chapter. Let's start with the point restrictions. Very easy concept and very straightforward answers. Can an insider trade? Yes or no? That's it. No. No insider shall trade in the securities of the company. That's very clear. But second aspect, I'm an insider, I have unpublished price sensitive information with me. Can I provide this information to another person? Not allowed. No insider shall trade in securities directly. No insider shall communicate, shall procure, shall provide, or shall give access to. Access to what? Unpublished, price sensitive information. I want 4 words, Amma, if possible, in this particular order. I cannot provide. I cannot procure. I cannot provide. I cannot communicate. I cannot give access to. Access to what? Unpublished, price sensitive information unless it is for a legitimate purpose. What is legitimate purpose is defined by the act itself, defined by the company itself through documents called as Code of Fair Disclosure and Code of Conduct. One of the two most important concepts of this particular unit. Code of Fair Disclosure and Code of Conduct. People usually complicate it. It will be very easy to understand. I must stick to the video. What are the 3 things we have learned here? No insider shall trade. Second point, no insider shall, I want 4 concepts here. No insider shall procure, no insider shall provide, no insider shall communicate, no insider shall give access to. What are the 4 points? Procure, provide, communicate, allow. Allow access to what? Unpublished, price sensitive information. If such is allowed, he'll be punished. But it is allowed to be communicated in what cases? In legitimate purposes. What is legitimate purposes is defined in 2 books of the company called as Code of Fair Disclosure and Code of Conduct. Both the words will make sense in a bit. Stick to the concept. Fourth point simply states that, let's remind it. He might have forgotten. Who? The insider of the company might have forgotten that he is in possession of UPSI. Let's remind him, stating that, boss, maintain confidentiality. You have access to UPSI. I'm just reminding you of the fact that maintain confidentiality, not even in a casual way. Don't disclose this any information to any outsider. Maintain confidentiality. Don't trade in the securities. You are an insider now. Point number 5 states that to check whether these persons have actually complied with the regulations of this code insider trading regulations, the company has to maintain a digitalized database of the nature of unpublished price sensitive information, who has it, what is that information, when is that information available, who can use it, misuse it. Every information about this UPSI shall be maintained in a digital database which shall be preserved for a period of 8 years. How many years, Amma? It shall be preserved for not less than 8 years. Now, there's a small problem here. I've maintained it, but if the board of directors themselves are conducting insider trading, they can manipulate that information. We have to make sure that it is put with adequate internal controls, making sure that it is not possible to be edited. It is not possible to be modified in the future. 3 things I want you guys to remember. Digital database having all information about UPSI. It is preserved for a period of not less than 8 years. Third point, we have to make sure that it is set with adequate internal control so that it cannot be modified. Last point. Last and very conceptual logic. We have already stated that who is an insider. There are 2 ways you can be called as insider. A person who is a connected person who will always be suspected. He's associated. He's having very high chance that he might have UPSI. But any person other than connected person, there's a very less chance that he has information. Now coming to this concept, the SEBI regulation states that if at all you are a connected person, we'll take assumption that you're having UPSI. What? We'll take assumption that you're having UPSI. If you actually don't possess UPSI, come prove it. Come prove contrary to the court of law. But we will take assumption that you are having UPSI. Hence, if you actually don't have UPSI, the onus, the burden to prove it will be in the hands of connected person stating that he is not in possession of UPSI. Coming to the second aspect, if it is any person other than connected person, if it is anything other than connected person, now the logic states that we don't assume anything here. He is not associated with the entity. We cannot take assumptions blindly as such. If at all SEBI believes that there is insider trading, SEBI believes that he has possession of UPSI, let the SEBI come and prove it. SEBI has the onus. The onus will be on SEBI. One word answers. There are 2 people, guys. One is connected person, one is any person other than connected person. If it is connected person, we'll take assumption he has UPSI. If he states that he doesn't have UPSI, let him come and prove it. Who will prove it? Who will have the burden to prove it? Connected person, stating that he is not in possession of UPSI. But if it is anything other than connected person, who has to prove it? SEBI has to prove the fact that there is UPSI in his possession. Trading plan. I've drawn a quick chart into it. I've drawn a quick chart into this process, quickly run through that. Trading plan is something which will allow the insider to actually trade. Insider, we've just discussed this, insider is not allowed to trade, but it is unfair for him. He's working in this company, he's putting his hard sweat and tears into this company. He should be able to invest into his own hard work. He will be able to invest, but he has to do a procedure where what happened. Just go through, just listen to me, Amma. The chart will make sense in a bit. Insider, just imagine this. While I'm explaining it, just imagine there is actually insider who is going and submitting documents, etc. So insider has to prepare something called as a trading plan. This trading plan has to be submitted to the compliance officer. Compliance officer, name itself states, he will comply with regulations. Insider preparing a trading plan, he'll present it to the compliance officer. The compliance officer will, the trading plan is presented to compliance officer for two reasons: for approval and for making a public declaration so that public at large will know it. So compliance officer, what will he do, sir? He will approve the trading plan given and he will give it to the public at large. Public declaration will be made. Now, can I say public at large will know that so-and-so director is going to purchase so-and-so securities at so-and-so date in the future? That means it is not misusing the power you have, misusing UPSI, but you are actually genuinely wanting to purchase securities. I'll allow it. I'll allow it. So what's the procedure? Quick answers. Who? Insider. Preparing a document called as trading plan. Presenting it to the compliance officer. For how many reasons? Two. One is for trading purpose. Second is for public declaration. Once this approval is being done, once approval has been given, wait a second. Once approval has been given, the compliance officer has to so intimate this information to the stock exchanges in which the securities of this listed company are listed, so that stock exchange will also keep an eye on this particular person, whether he's coming for trading or not, whether he has submitted this trading plan correctly or not. So what's going to happen? Once approval is received, compliance officer will notify the stock exchange in which securities are listed. Once the trading plan has been given to stock exchange also, you are allowed to trade. But if you trade immediately in one day, there's a chance that you have UPS and you're misusing it. You're not allowed to trade earlier than 6 months. What's the logic behind 6 months? SEBI has taken this assumption stating that you might have UPSI today, but in this 6 months, the UPSI which you have in your hands will some other way will be made available to the public. By the time you trade after 6 months, this UPSI might have already been given to the public. It is generally made available. The public has already reacted. The prices of securities have already been adjusted. You cannot take a unfair advantage. So you're not allowed to trade for how many months? 6 months. So when can you trade, sir? Not earlier than 6 months. Not earlier than 6 months. Let's put in a proper diagrammatic manner. Trading plan is submitted today. From the date on which I have submitted this trading plan and it got approved, I'm not allowed to trade for a period of 6 months. So that's very clear. Then we can trade after 6 months. Yes, you are allowed to trade. But once you are allowed to trade after 6 months, can you make deviations from the trading plan? If you're allowed to make deviations, just imagine this. I don't want to expand it much further, but just imagine this. There's a chance that you might have received new UPSI here. As we were just discussing, the UPSI you had here somewhere might have already made available to the public, but at the same point of time you might have now have access to possession to a new UPSI. If you're having access to new UPSI and you're allowed to deviate from the trading plan originally submitted, you'll basically misuse the power again. Hence the last topic. However, the trading plan is not allowed to be deviated. No deviation is allowed. Quick answers. Put everything together. I pause this particular point. I hope my writing is clear. Try to understand it, Amma. Pause this, zoom it out, write it properly. If not, I'll share this video, share this document. What's the process? Insider will formulate a document called as trading plan, submit it, present it to the compliance officer. Compliance officer for two reasons: for approval and for public disclosure. Once it is approved, the compliance officer will also intimate it to the stock exchange in which securities are listed, and we are allowed to trade, but not earlier than 6 months. After 6 months, I can trade, but after 6 months, I can trade without any deviations being made from the trading plan. That's the entire process of trading plan. Now we have a small topic called as disclosure. To understand whether you're actually trading in securities or not, I want two disclosures to be made very quick: initial disclosure and continual disclosure. Initial disclosure, name itself states, on the date on which you are appointed, give me the disclosure. If On the date on which you are appointed, you are already holding securities, come disclose it. Who is disclosing? Key managerial personnel and board of director. Key managerial personnel and board of director will have to disclose the amount of securities they are holding as on the date of their appointment. Once they're appointed, after they're appointed, now they're actually connected person. They are in certain circumstances allowed to purchase. You are allowed to purchase, but if you are purchasing a specific amount of money, come disclose it. When should I disclose it? Understand the words very clear. It has a lot of technicality into it. If your trading value in a particular calendar quarter is in excess of 10 lakhs on an aggregate basis, come and disclose. There are a lot of technicalities, just listen. If your trading value, how much, what trading value, that means your entire trade value, purchase and sales, trade value in which period? In a calendar quarter. In a calendar quarter, on a aggregate basis, not on a single trench, it can be on a multiple trenches. On a aggregate basis is in excess of 10 lakhs. So I want you guys to remember 4 things. Trade value on a calendar quarter on aggregate basis is in excess of 10 lakhs. Come and report it. Come and report it. Come and disclose it to the company. Come and disclose it within 2, not working days, 2 trading days. Within 2 trading days, come and disclose it. That's your disclosures. Now coming to the last and the most important part of this chapter. And I forgot to tell, this chapter is part of SEBI, as you know, and SEBI will come for a mandatory 7 marks question. And this insider trading has been one of their favorites. ICMA's one of the favorite topic has been SEBI insider trading always. So coming to the code of fair disclosure, very easy concept. Who will formulate this document? Just understand this, Amma. Every company is different from each other. Every company's business is different. Every company's inside information is different. Every company's UPI size is different. Every company's structure is different. So SEBI cannot sit down and draft a single format which is suitable for every company out there. Then SEBI stated that I'll formulate something which is minimum requirements of every single company. On top of it, you guys create your own code of fair disclosure which is more suitable for your company's requirements and your company's structure, your company's mindset. You do it on your own, but I'll give you a format, I'll give you a roadmap on how to draft it. So what are we doing, sir? Here we are learning the roadmap given by SEBI. The SEBI code of fair disclosure is given under Schedule A of the procedures, where Schedule A provides the requirements of code of fair disclosure, which is again company to company is drafted by its own. Let's start with the process. It is drafted by the board of directors. The board of directors of every listed company has to draft a document called as code of fair disclosure, and this code of fair disclosure shall be posted on the official website of the company. Once it is posted, it will give a proper way and the format and the procedure, the manner in which UPSI will be made available to the public on a fair basis, fair disclosure to the public. Board of directors will draft it. Just remember this, board of directors will draft it. Once drafted, it will be posted on the website of the company. Now, what is mentioned in this document, sir? Very simple 6 points. Starts with the topic, a prompt, a proper disclosure of UPSI will be made. But who will make this? This prompt disclosure will be made by an employee of the listed company who is a senior officer. This senior officer will now be called as, designated as, I'm making this sense to you, I hope. I'm not appointing a senior officer, I'm designating a senior officer as a Chief Investor Relations Officer, CIRO. I shortly call him as what? CIRO. What is CIRO? Chief Investor Relations Officer. Chief Investor Relations Officer will be responsible for disseminating this information to public at large, giving this information to public at large. While he is giving this information to public at large, he must not be making a discriminatory disclosure. He must not be making a selective disclosure. He should avoid selective disclosure. He should avoid a partial disclosure to a separate set of people, making sure that it is available to public at large at the same point of time. Once this information is given to the public at large, obviously, public might interpret it in a wrongful manner. Public might understand it in a wrongful manner. Public might have doubts about it. If at all they have any queries, if at all there are any rumors which are running in the market, it is your responsibility. If you don't solve it and sit down and have snacks and watch the rumors around in the market, public might take a wrongful decision. Now, what is your responsibility here? Your responsibility is to give a appropriate and fair response to all the rumors and queries in the market. Respond properly. Fair response will be given. A equitable response shall be given to all the queries and rumors in the market so that nobody will misuse it. Point 5 and 6 are independent points. Whenever you are giving information to analyst or any research personnel, make sure that these people are also given with only generally available information. No UPSH shall be given to them. And always try and make sure that you are developing best practices for the process of code of fair disclosure. You have to remember all 6 points. You have to make efforts on this. This might come for exam. Code of conduct. I've again drafted a small chart for you guys. Code of conduct. Don't look at the chart yet. Let me explain it. You'll make sense as we go forward. Code of conduct is again that particular document which is drafted by SEBI regulations. But again, SEBI stated that company to company it is different. Same story, company to company it is different. Nature to nature of business it is different. You guys draft your own code of conduct. But you follow the minimum requirements given by Schedule B. Schedule A was code of conduct. Schedule B is for code of fair disclosure. This code of fair disclosure will be, I'll give you this minimum requirements. We'll go in a bit into this minimum requirements and all. Let's understand the basics of this code of conduct. This code of conduct is a document which is drafted by whom? CEO or the managing director. I hope you're able to start making differences between both the documents we have. The code of fair disclosure was a document drafted by board of directors. Good. The code of conduct is something which is drafted by CEO or managing director. They're formulating this document for 3 reasons. Making sure that they are not trading, they're regulating it, not making people trade. If they're in exceptional situation trading, I'll monitor it correctly and I'll report it to the higher authorities. 3 things. Regulate, don't allow them to trade. If they're trading, monitor. After monitoring, come and report. Report what? Trading done by. Absolutely wrong. I know your mindset, your subconscious mind has already given the answer. Trading by insiders. No. We have defined a separate set of people called as designated persons. Designated persons and their immediate relatives. Now give me a proper sentence to it. The code of conduct is formulated by the CEO or the managing director of a listed company, which shall be formulated for regulating, monitoring, and reporting of trading done by designated persons and their immediate relatives. Sir, wait a second. What is this designated person all of a sudden? Designated person is also similar to insider trading process. A person who is expected to have UPSI just before it is being declared to the public at large is usually called as designated persons. As of now, for your clarity on exam perspective, because the time is not sufficient enough, let's just assume that insider and designated person are one and the same. We are using a different name, that's it. We are having a different name, but basically both of them are one and the same. But who will be called as designated person exactly? They will be prescribed, specified by the board of directors, but board of directors will do it in consultation with this compliance officer. I hope the introduction is making sense. Formulated by CEO, managing director. It is for 3 reasons: regulating, monitoring, and reporting of the trading done by DP or their immediate relatives. Who is DP will be specified by the board of directors in consultation with compliance officer. But again, the minimum requirements are mentioned under schedule B. Schedule A is for code of fair disclosure. So what are the minimum requirements? Rob, point is, just understand this before we go into this chart. Wait a second, just understand this. If information is UPSI, that's where the problem lies. If information is already given to the public at large, there's no problem in it at all. If information is not yet given to public and it is unpublished, I'm not allowed to trade. But once the information is generally made available, there's no problem at all. I can actually trade. But the point is, if say assuming the information was made available to public at 11 a.m. in the morning, we have made an announcement. At what time? 11 a.m. Before 11 a.m., it was UPSI, I agree. After 11 a.m., once the information is given to public at large, I cannot call it as UPSI. It is generally available information now. If it is actually generally available information, can I trade at 11:01 a.m.? Public might have not understood the document yet. All public might have not read the document yet. Public might have not have reacted on it. Stock exchange demand supply is not yet affected. Price of securities are not yet adjusted. Can I trade immediately? If I'm trading immediately, technically speaking, it is not generally available information. Technically speaking, it is generally available information, but I'm still misusing my position. Hence, you are not allowed to trade immediately after the information is made generally available. That's where the code of conduct comes in. Now, with this introduction, come to the topic. Information is made generally available. Once information is made generally available, if you want to trade, make an application to the compliance officer. Who is making application? DP, not insider. DP. DP is making, what is DP? Designated person is making application to the compliance officer stating that I want to trade in the securities. Compliance officer, after verification of this application, he'll allow the trading at such time intervals as he may decide, he may determine correct. But in any event that shall not be less than 48 hours. What do you mean by this sentence, sir? Can the compliance officer mention more than 48 hours? Yes. Can he mention 60 hours, 72 hours, 100 hours? Yes. Can he mention anything less than 48 hours? No. What's the minimum time limit gap you should have? 48 hours. That means, can I trade after 48 hours? Yes, I'm allowed to trade. But a small condition. If your trade value, if you're allowed to trade, but the trade value is in excess of the threshold specified by board of directors, it is exceeding the limit specified by board of directors. If it is below the limit, go trade. I'm not gonna doubt it. But if it is exceeding this limit, there would be a very good reason behind which you are actually intending to purchase huge amount of money. Now, I have a little suspicious that you might have actually any other UPS in your hand. This UPSI has been made generally available, but there's a chance that you might be having access to another UPSI which is influencing you to purchase higher than the limit specified by board of directors. I have a little suspicious. So what you do is, if it is exceeding the threshold limit, come make an application to compliance officer and get something called as pre-clearance from the compliance officer. You have to obtain what? Pre-clearance. Now, this pre-clearance will be given by compliance officer. Compliance officer also states that I also doubt this person. He might be having access to another UPSI. How to prove it? I'll ask the designated person to give a declaration stating that he's not in possession of any other UPSI. After giving the declaration that he's not in possession of any other UPSI, that situation, the compliance officer will agree and give a pre-clearance. And one extra point, this application which you are talking about will be made in the format as specified by board of directors. So I'm allowed to trade, right? I'm allowed to trade. Now come back to this point. I'm allowed to trade. Can I trade after 7 months, 6 months? Imagine, I might not have possession to any other UPSI today, but if I extend this trading for 6 months, I might get something new in the future. That means I have to complete the trading as early as possible. Once a pre-clearance have been received, you have to complete your trade within 7 days. It shall not be in any event more than 7 trading days. Completed within 7 trading days. That's your entire code of conduct. I hope it is clear, guys. Go through all the words which is there in the material. Last concept, and I wouldn't say the most important, but for the matter of fact, it's been already asked. It's already been asked in exams now. So what is this? We have to prevent. End of the day, entire topic. We spent 35 minutes on it already. What is this topic? We are trying to prevent insider trading. What is the company doing to prevent it? The CEO of the company, Chief Executive Officer of the company, shall put in place an adequate internal control system to make sure that we are following and complying with the compliance of this particular regulation. Whether these are complying with the regulations or not, whether it is fulfilling the compliances or not, will be reviewed by the audit committee at least once in every financial year. Once in every financial year, they'll review it. It is formulated by CEO, reviewed by the audit committee. Now, I'll be able to prevent it. Last 2 points more. Stick with me. I'll be able to prevent it only when I know that there is insider trading happening. If any employee of the company knows, if any of the lower employee knows, if any of a third party knows, they should be having enough facilities to come and inform it to the top level management so that they can take action. So we have to establish something called as whistleblowing policy. And this whistleblowing policy must be made aware to all the employees of the company. Employees should know that this mechanism is existing so that they can report to the top level management. If at all they report, I'll also have to formulate a proper procedure in which I will conduct inquiry about leak or a suspected leak of UPSI. If at all they have reported, employees have reported the whistleblowing policy, I have to formulate policies and procedure in which I'll conduct a inquiry about a leak or a suspected leak of UPSI. While I'm conducting this inquiry, all the fiduciaries, all the intermediaries, all the other connected persons of the listed company shall provide their assistance. They have to cooperate with the listed company for the purpose of conducting an inquiry and going deep and understanding the origin of this insider trading to make sure that we are taking proper action against such insider trading. That's the entire chapter, Amma. They have to cooperate. I hope the chapter is clear. If you have any doubts, I'll be very much happy to solve them. Leave a comment on this particular video. If you like the video, share it with your friends. Like the video, comment on the video. Will be very appreciated. Thank you, guys. Let's get started with the last part of your SEBI regulation, SEBI Takeover. It's actually called as SEBI Substantial Acquisition of Shares and Takeover Code. So what's about this chapter, sir? This is a very interesting topic, Amma, and it is one of the important parts of the SEBI regulations again. Now, let's understand what is takeover and why takeover is required before we dive into the technical terms of takeover. So just imagine this. We have already established this fact in Companies Act itself. Company is a democratic entity. What do you mean by democratic entity, sir? It is by the shareholders, for the shareholders, of the shareholders. It is of the shareholders. It is belonging to the shareholders. It is run by the shareholders. It is run for the shareholders. It is a democratic entity. And knowing the fact that it is a democratic entity, we can't practically get the consent from all shareholders. We depend upon a concept called as majority will rule, minority will follow. Repeat it after me. Majority will rule and the minority will follow the decision taken by this majority. So can I indirectly say these minority shareholders are trusting the decision which is taken by majority, which will be now having an impact on all the shareholders, including those minority. That means, simple terms, the majority takes the decision, but it might have an impact on the minority. This is what democracy is, but the minority have to listen and have trust upon the majority, only then I'll invest. So assume this, I am a person who is having control over this entity. I'm a person having control, I'm a person having majority in the company, and you guys having trust upon me. You guys trust me, right? Having trust upon me, you guys have invested in the company so that I'll take rightful decisions, is what your intention is. Now, all of a sudden, overnight, a random person comes and acquires my control. He purchases substantial shares from me. He takes over the company. You might not have trust on that person who is acquiring. If you're not having trust on such person, your investment was made based on the trust on a particular person, and the particular person sold his security, he'll get benefit, but the public at large who invested on the trust of this person will incur loss. To make sure that the public are not affected, the minority is not affected, takeover code states that acquisition is not bad, but this acquisition must be done in such scenarios where this minority, the public at large, are not being affected. Do acquisition with a concept where the minority and the public must be given an exit opportunity. Make something called as open offer. Give an open offer, asking them to come sell their securities if they are not interested in this person acquiring the securities. Hence, we'll make sure that this entire chapter makes sure that who is not affected, the minority shareholders are not affected by change in the control of these companies. Let's get into the technical words from here. I've drafted a lot of charts for you on this particular chapter. We'll go through them slow one by one. We'll start with the technical understanding of words. What's happening here, sir? A person who wants to acquire a company, acquire the control or the majority of the company, is called as an acquirer. The acquirer is targeting a company. He's wanting to get control over that company. The company which he is targeting is called as a target company. And obviously, SEBI regulations arises only if target company is basically a listed entity. They have raised money from public at large. If public are getting affected, SEBI regulations come into place. What is this acquirer trying to do? If acquirer comes and acquires 1%, will it have impact? Will it change the control? Will it change the management? No. When does it change the management? When he acquires what? Control. So takeover is very simple. Acquirer acquires control in the target company. It is called as takeover. Control can be established in target company in couple of ways, either by purchasing shares or having voting rights in the target company, or otherwise through the management I can get control over the target company. So control can be established by the acquirer in the target company, either by acquiring, obtaining shares, voting right, or the control by management of the affairs. Now this usually what happens, knowing the fact that he's going to be applicable with takeover code, the acquirer doesn't do it in his name. Acquirer does it with the help of an agent of his who is called as person acting in concert. Person acting in concert is nothing but a person who is cooperating with the acquirer with his intentions of taking control over the target company. How can the acquirer purchase, sir? There are a couple of options. Let's understand the first category. Acquirer goes and gets the control over target company. Straightforward, I get control. I myself get control over a target company. That's the first option. Second case, I myself don't get control completely. Say I purchase certain percentage, which is not giving control exactly. I'll ask my friend to purchase some other part. I can influence my friend. I can influence my co-person who is purchasing it along with me. There's a process which is called as acquirer with the person acting in concert. First option, acquirer himself on his own. Second case, acquirer with his person acting in concert will get control over the target company. Last case, where the acquirer purchases nothing, zero, but the acquirer purchases, gets control only through the person acting in concert. So I want three words: either by himself or with a PSC or through a PSC, he obtains control. Control over what? Shares. Control over what? Voting rights. Control over what? The management of the company. Then he's called as an acquirer. Are you getting these words clear, ma? Let's get into the technical words of this chapter now. Takeover. Underline the keywords as we are going through this document. Acquirer. Takeover means acquirer takes over. What? Control over what? Target company. It is simply called as takeover. Now, who is this acquirer? Just understand this word. I don't care what designation you carry. I don't care what reputation you carry. I don't care whether you are individual. I don't care whether you are a company. I don't care whether you're a businessman. I don't care who you are. Starts with the word acquirer. Means any person who directly or indirectly agrees to acquire or actually acquires. Acquires or agrees to acquire. Agrees to acquire how he wants to acquire it, either by himself or through a PAC or with a PAC. Are you getting these points clear, Amma? Himself or through a PAC or with the PAC, he's trying to acquire what? Acquire shares, acquire voting rights, or acquire control over the target company. Then he is called as an acquirer. Sir, acquirer definition is very, very clear. Then what about this PAC you're talking about? Person acting in concert. Person acting in concert is very simple logic, Amma. Simply remember this word, he is cooperating. Cooperating with whom? The acquirer. Cooperating with acquirer for what purpose? Taking the control. Control over what? Same story repeats. Taking over the control over shares or voting right or control over the management of the target company, where he is cooperating because of an agreement or arrangement existing between this person and PAC. Now, to avoid regulations, to avoid SEBI rules and regulations, people will not do it formally. So, the word agreement arrangement, as you have learned in Competition Act as well, it can be either formal or informal, it can be written or oral, doesn't matter, it will be still considered as a PAC. So, what's the definition here? Underline only the keywords, you don't have to go everything. Person acting in concert means a person who has a common objective. Common objective with whom the acquirer, because of an agreement or understanding, whether it is formal or informal, directly or indirectly, he cooperates. What's the keyword you have to remember? He cooperates. Cooperates with whom? Acquirer for what? Acquisition. Acquisition of what? Shares, voting right, control over the target company. I hope both the definitions are clear now. Just repeat it for me once. Acquirer means any person who directly or indirectly acquires or agrees to acquire, whether by himself or through a PAC or with a PAC, acquires what? Shares or voting right or control over the target company. Second, PAC. PAC means a person who has a common objective. Common objective of acquiring shares, voting right or control over a target company pursuant to, because of what? An agreement or arrangement, whether it is formal or informal, whether it is directly or indirectly, he cooperates for acquisition of shares, voting right or control over a target company. He is called as PAC. This PAC will also be applicable with the takeover code. Now, if this PAC is applicable with takeover code, lot of people out there will not wanting to be called as PAC. Then law came with the concept of deemed person acting in concert. Remember the deemed connected person? Similar topic. Deemed person acting in concert. Sir, who will be included in this deemed person acting in concert? all the group companies, all the directors of the company, managers of the company, all the promoters of the company, immediate relatives, merchant banker, venture capitalists, the intermediaries, the banks of the company, the portfolio manager, the collective investment scheme, mutual funds, all the set of people will be deemed to be companies, directors, and the group companies. All these people will be deemed to be what? Deemed to be person acting in concert. That means if they are deemed, they are be applicable with the regulations of SEBI takeover. Last category, last definition before we start the procedure. What is target company? Nothing but such company who has got its securities listed on the recognized stock exchange. Let it be a company registered under central government or state government or any provincial act of India, doesn't matter. If you have been registered under any law in India and your securities are listed, what securities specifically? Shares are listed on the recognized stock exchange, I'll call you as a target company. I hope the definitions are very much clear. Let's start with the concept here. I'll come back to this. These definitions you will cover in the process itself. Let's start understanding the types of takeover we have. 5 types of takeover, very important question. There are 5 types of takeover, starting with something called as friendly takeover. Friendly takeover is something where the acquirer offers an attractive price to the promoters of the target company, asking them to sell their securities. And the promoters happily, willingly are ready to sell it out. So the sale process is happening with the consent of the promoter, with the intention or with the acceptance of the promoter. It is called as friendly takeover. It is happening friendly. There is nothing to be forced. Second, hostile takeover, which is completely opposite, where the promoters don't want to sell their securities off, but the acquirer, using using the stock market, is trying to acquire control over this target company. It is called as hostile takeover, where it is being done without the consent of the promoters. Twitter, for example, what happened? It was acquired on a hostile basis. So friendly and hostile is the first 2 categories. Then next 2 categories we have are something called as horizontal and vertical. We have done this multiple times. Competition Act also we have done this. Horizontal is something where you're in the same industry and you're in the same level, same stage of the business. Basically, you're 2 competitors. They're called as hostile takeover. If, for example, let's take something which you will actually understand. Say Tata Motors. Tata Motors acquires Mahindra. They're competitors. Mahindra and Tata Motors. If Tata Motors acquires Mahindra, then this will be called as what? Same industry, same stage. They're called as hostile. They're called as horizontal takeover. Then second category, same Tata Motors, if they are acquiring the MRF tires which you are purchasing, this is called as vertical. They're in the same industry, but they're in the different stage of the business. It is called as vertical takeover. This vertical takeover is what? Vertical takeover at the back end. So backward integration. It is backward integration in vertical. Same concept. MRF purchases Tata Motors. It will be called as forward integration, vertical takeover. So give me the 4 takeovers as of now. One is friendly takeover with the consent of promoters. Second, hostile takeover. Promoters are not willing, but we are still acquiring the control. Hostile takeover. Horizontal, same stage, same industry. Vertical, same industry, but different stages. It can be either forward integration or backward integration. And the last, if Tata Motors goes and acquires Amul, are they in the same industry? They're not even in the same industry. That is called as conglomerate takeover, where the takeover happens between 2 different industries altogether. It is called as conglomerate takeover. 5 takeovers, give me the just headings. Friendly takeover, hostile takeover, horizontal takeover, vertical takeover, conglomerate takeover. Vertical has 2 parts, backward integration and forward integration. Then come to the disclosures. This being an important question, this can be asked. Disclosures. First and foremost, you have to understand who is this disclosure concept applicable to. Disclosures are not applicable to a target company. The concept of disclosures, either for acquisition or selling or purchasing, is or ceasing to hold it, is applicable only to the person acting in concert acquirer along with the person acting concert and the promoters. Target company, it is not applicable to. There's an MCQ on this, be aware of it. Target company is applicable or not applicable? Not applicable. Who is only applicable? Acquirer with PAC and the promoters are applicable. Sir, if they are applicable, how should they disclose? There are 2 types of disclosure we have. We call it as continual disclosure and encumbrance disclosure. What are the 2? Continual and encumbrance disclosure. Start with the continual disclosure. States that the name itself gives the topic. We have to continuously year on year basis, we have to disclose it. Disclose your shareholding in this target company as on 31st March. On which date you have to disclose it? As on 31st March, disclose it and disclose it. Is it possible for you to disclose immediately on 31st March? You have to prepare a proper report and disclose it. Disclose it within 7 working days from the end of the financial year. Give me the two answers here. When should you disclose? Within 7 days from the end of financial year. As on which date should you disclose? 31st March of the year. Now the point is, to whom should I disclose? I'll disclose it to whom? I'll disclose it to two set of people. I'll disclose to the stock exchanges in which the shares of the target company are listed, and I'll also disclose to the registered office of the target company. Two people, one among stock exchange where the shares of the target company are listed, and I'll also disclose to the registered office of the target company. But the point is, sir, who should disclose it? Disclosure is required to be made by two set of people. First, acquirer along with PSE only and only if they are holding more than equal to 20. That's the reason why I call it as acquirer, more than equal to 25%. And promoter has to disclose irrespective of his shareholding. I hope all the points are clear. I've put it in point-wise basis. It should be very clear with the topic. Repeat it once again, rinse and repeat it. How many types of disclosures are there? Two. Continual disclosure and encumbrance disclosure. Continuous disclosure as on 31st March within 7 working days from the end of financial year, disclosed to the stock exchanges and the target company, registered office of target company, disclosed by acquirer PSE and promoter. Promoter irrespective of his shareholding, acquirer PSE only if they are holding 25% or more than equal to 25% of the shares, I'll disclose it. Second point, encumbrance. We know this word encumbrance. When you are putting the securities as a pledge, when you're creating or ceasing to create such pledge or lien over the securities, you have to disclose. This disclosure is required to be made to same copy paste. Give me the answer. Stock exchanges in which shares of the target company are listed, or second option, it is the registered office of the target company. But who should disclose it, sir? It is required to be disclosed by the promoter irrespective of his shareholding. And when should I disclose? Within 7 working days from the date of acquisition or ceasing to hold such encumbrance. Put everything together quick. Disclosed by promoter to stock exchange and target company within 7 working days. Is this clear, Amma? This can be question, Amma. This has been question for 7 marks already. This can be asked again in the exams. That's your disclosure topic done. Then comes the topic of actual requirement of open offer. Spend a little time with me here. The process is very difficult for you if you don't understand it completely in a chart format based. So we'll have a couple of charts for this entire process. Probably we'll spend a good amount of time here with this chart, because this is basically the core and heart of this entire chapter. The open offer process and the open offer requirements, trigger points, and the open offer process. Start with the concept. We have a couple of open offers. We have two open offers, two types of open offers. They are called as mandatory open offer and voluntary open offer. Let's start with mandatory open offer. When am I required to make open offer? What is open offer, sir? We are giving an opportunity to the public at large to sell their securities to a specific person, which is not going to affect the stock market prices. No fluctuations will happen. I'll come out with the offer stating that I'm ready to purchase your securities at this price. Open offer is given. Who is giving the open offer? Acquirer is giving open offer to the public at large, the shareholders of the target company. When is he giving this open offer and when is it mandatory? Open offer is mandatory when you meet something called as trigger point. It triggers the concept. It starts the concept. Trigger point 1. What is trigger point 1? If the acquirer along with his PAC, I hope this is okay. How should I put it? Try to adjust with this, Amma. I hope this is visible. Chalo. The acquirer along with his PAC acquires on an aggregate basis 25% or more shares in a target company. Then he meets the trigger point 1. How much percentage? 25% or more on an aggregate basis. So year 1 I have purchased 8%. Will I meet it? No. Year 2 I have purchased 20%. Will I meet it? Yes. Aggregate basis, on a whole you are holding 25% or more in the target company, you will meet the trigger point 1. If you have met the trigger point 1, what shall I do, sir? The acquirer shall make an open offer Open offer for acquisition of additional. Sir, I'm already holding 25%. I should now make open offer for additional 26% of shares to be acquired. How much? 26%. Now, if public respond back and want to sell only 5%, I'll have to purchase 5. If the public respond back with 20%, I have to purchase 20%. If public respond back with 40% to be sold, I'll purchase only 26%. I'm going to purchase an additional of maximum 26% of shares. So that's fine. Trigger point 1 is good enough. What is trigger point 2? Trigger point 2 states that you've already met trigger point 1. What do you mean by that? You're already holding more than equal to 25% of the shares in the target company. Already holding 25% and you have acquired more than 5% in a particular financial year, you'll meet trigger point 2. So trigger point 2 can be met only when you've already met trigger point 1. Trigger point 2 can be met multiple times over a period of years. Trigger point 1 happens only once in the life. But trigger point 2, can it happen more than once? Absolutely. When you're acquiring how much? You're holding how much first? Holds 25% or more already and has acquired how much? More than 5% in a particular financial year. You'll have to make the same concept again. Make an open offer for additional 26% of the shares of the target company. This is mandatory open offer. Now, how does open offer happen? The process of open offer will start in a bit. But what is voluntary open offer, sir? No trigger points are met. Not the trigger point 1, not the trigger point 2, but I want to go for open offer. Can I go, sir? Yes, you can go for open offer, voluntary open offer, but there are some conditions to be satisfied before going for voluntary open offer. That's the reason I call it as preconditions for open offer. Preconditions for voluntary open offer. There are 4 preconditions which we have to satisfy. First and foremost, you should already hold more than equal to 25%. Already hold more than equal to 25%. Yes, your thinking is right. You have already met what? Trigger point 1 already. Once you have already met trigger point 1, then you are eligible either to go for voluntary open offer or you may start trigger point 2. So the point is, you don't want to go for trigger point 2 and make a mandatory open offer. You have an alternative. You can go for voluntary open offer. But this door of voluntary open offer opens only when you have already met trigger point 1. Are we getting this clear? Already holding. Prior holding of more than equal to 25%. Then comes the interesting part here. Let me draw a basic example for this. This is, say, the voluntary open offer period. Now the next, as we discussed, 4 conditions are there. First condition, your prior holding must be 25%. Second point, third point, fourth point. Second point, before open offer. Third point, during open offer. Fourth point, after open offer. Before open offer, the acquirer shall not have made any creeping acquisition during the 52 weeks before the voluntary open offer. So what is creeping acquisition? Creeping is what? Basically crawling down. I'm crawling at such level which is not meeting trigger point 2. That means I'm purchasing, but purchasing less than 5% in a cautious situation where I don't want to meet trigger point 2. That kind of acquisition is called as creeping acquisition. Purchasing less than 5%, I'm crawling, I'm creeping below this limit, called as creeping acquisition. I should not have made creeping acquisition in the last 52 weeks, basically 1 year, 52 weeks preceding the voluntary open offer. This is point number 2. Then point number 3, during the voluntary open offer, I should not go to the market and purchase more shares. I should not go to the market and purchase more shares. So that means, sir, am I still allowed to purchase securities during open offer? From the open offer? Absolutely. But outside open offer, can you purchase more securities? No acquisition other than the open offer during the open offer period. Are we getting these words clear? Other than open offer, I shall not purchase it. Fourth point, after completion of voluntary open offer, you shall not purchase securities for a period of 6 months. I hope all 3 conditions are clear, ma. 1, no creeping acquisition for the last 52 weeks. No acquisition during open offer except from the open offer. Last, no further acquisition after completion of open offer for how many months? 6 months. Any doubts? Now, special note point in case of voluntary open offer. Bear in mind, this happens only in voluntary open offer where Again, open offer again is for how much percentage? 26%, additional 26% shares. Now I can put something called as minimum level of acceptance, stating that I'll accept this voluntary open offer only when I've received a minimum of 10%. So what is this? Give me some examples, I'll understand it better. Fine. 26% is what we have made a voluntary open offer for. Once you have made voluntary open offer for 26%, say assuming I've put a minimum acceptance level of 10%, and I have received applications from the public amounting to 12%. Am I satisfied? My point was I should get at least a 10%, and I got 12%. I'm satisfied. I'll purchase. Purchase how much? 12%. I'm not putting maximum limit, I'm putting minimum limit. If the same, I'll purchase how much? 12% in this case. Next case, I have received, say, assuming 20%. I'll purchase how much? 20%. I have received only 8%. Is it fulfilling my expectations? If it is not fulfilling my expectations, the topic here states that if it is voluntary open offer and it is not meeting the minimum acceptance level, the acquirer need not purchase that 8%. He can cancel the entire open offer process. So he'll purchase or completely cancel. A tricky question for you. If I have received, say assuming 28%, how much should I purchase? First of all, should I purchase? If yes, how much should I purchase? Correct. I should purchase, and I should purchase how much? 26, because open offer in the first place was made only for 26%. Now we are comfortable with mandatory open offer and voluntary open offer. Let's understand the open offer process, the heart of this chapter, and that is the place where a lot of students fumble across. So let's get into the process very, very clear. Lot of concepts will come through. Don't look at the chart until I have taught it. The chart is basically including every concept combined together. Don't read it until I have explained about it clearly. Let's start with here. The acquirer along with his PAC. He'll not do it on his own. He'll appoint a person who will do it for him, a person called as manager to the open offer. This manager to the open offer starts with the topic that I'll make a public announcement. Who is making public announcement? Basically acquirer. Acquirer makes a public announcement stating that we are going to go for open offer. We have not done open offer, we are announcing the open offer. Once this public announcement is made, detailed public announcement is made, I have to prepare the offer letter. But the point is, this offer letter can manipulate the shareholders. We have learned it from our Companies Act every day. Every concept of Companies Act is drafted in this sense that shareholders are fools. Shareholders don't understand, they don't have enough knowledge, they can be easily manipulated. Now this offer letter I'm talking about, giving to the shareholders public at large, I can manipulate them. If I'm able to manipulate them, entire takeover code is of waste. The intention of takeover code is to protect whom? The shareholders, the public. If they are being manipulated, there's no use of takeover. Hence the logic states that will not prepare offer letter of offer, will prepare draft letter of offer. A temporary draft document and submit it to SEBI, not to the public. Let the SEBI check it first. If SEBI is satisfied, they'll give you approval. Then you can go give it to the public at large. I hope the concept is clear. What's happening here? The acquirer along with his PAC, with the help of the manager to the open offer, will first make a public announcement announcing that we are coming for open offer. Then they'll prepare something called as draft letter of offer and give it to SEBI. They have to give it to SEBI within 5 working days. Entire concept of open offer is concept of working days. If I use the word 5 days also, let's assume that it is always 5 working days. They'll have to send it within 5 working days to SEBI. Along with SEBI, simultaneously also forward to 2 people. This is very common. Stock exchange and the registered office of target company. Stock exchange in which securities are listed, shares are listed, and registered office of the target company. So give me the flow quick, acquirer along with will make a public announcement, then within 5 working days, they'll prepare a document called as draft letter of offer and send it to SEBI, simultaneously also forward it to stock exchange and the registered office of target company. Now SEBI has a time limit of 15 days. In this 15 days, the SEBI has 2 options. Either they have commented or no responses received at all. If the comments are received, make suitable changes which are being given by SEBI. If no responses, we'll assume that it is accepted unconditionally. Now give me 2 situations. If comments are received within how many days? 15 days. I'll wait for how many? 15 days. If no response is received within 15 days, I'll assume from the expiry of that 15 days, it has been accepted. So give me the two. This is very important to understand. If comments are received, I'll start the next process from the date of receipt of comments. If comments are not received, I'll start the next process from the expiry of 15 working days. I mean, am I making sense here? If comments are received from the date of receipt of comments, from that date, I'll start the next procedure. If comments are not received, I'll actually wait for how many days? 15 days. After 15 days, I'll know that there is no responses. I'll start the next process from the expiry of 15 days. So, from the date of receipt of comments or from the expiry of 15 days, I have to make, draft is gone, I'll make the exact letter of offer and dispatch it. Dispatch the letter of offer within 7 working days to the public and give the public enough amount of time to read it, understand it, research about it, and take decisions whether to sell or not to sell. So what's happening? The letter of offer has been dispatched. Dispatched within how many days? 7 working days. Once it is dispatched, from the same date on which comments are received, I have to open the period in which the public can come and sell their securities. That period is called as tender period. Are we getting the word clear? The period during which the public can actually make applications to the acquirer for their intentions to sell it is called as tender period. The tender period shall be opened within, tender period shall be opened within 12 working days, 12 working days from the date on which we have received comments. Once the tender period is open, it shall be open for a period of 10 days. I hope this is making sense. If not, just watch the last 2-3 minutes little slowly again, once again, it will make clarity for you. Once comments are received, dispatch it within 7 days. From this date itself, we have to open the tender period within 12 days. Once it is open, it shall be kept open for 10 days. After the expiry of 10 days, the date on the expiry of 10 days is called as identified date. From that identified date, I have to make payment. That means I have received applications, right? I have received application during which period? Tender period. Once I have received applications, I'll verify the applications correctly, and from the identified date, from the expiry of these 10 days, I'll have to make payment within 10 working days then. Is that fine? Now, how should I make payment? How should I make payment? There are 4 options in which I can make payment. Either I can make payment in cash directly, easiest option. If I don't have cash to pay, I can pay in securities. I can pay in listed equity shares. I am purchasing shares, listed equity shares. I am giving you what? Listed equity shares of the acquirer, listed equity shares of the PAC. Give me the words. Either I am paying in cash, or I am paying in listed equity shares, or I am paying in listed convertible debt instruments. Listed equity shares or listed convertible debt instruments, or get this word clear, ma? If it is listed debt instruments, it will be converted into equity shares. That means they are also own fund. But the last point, they are secured debt instruments. That straightforward, they are debt of the company. If it is debt of the company will have to repay principal and also pay interest on periodical basis. Whether they are able to pay or not, whether they are credit worthy or not, the company should obtain the acquirer should obtain a credit worthiness, the credit rating from recognized credit rating agencies. Are we getting the point, Amma? In these two logics, I did not call about credit rating because they're equity, their own fund. They're nothing to be repaid. But when it is talking about debt instrument, it is actually debt fund of the company for the purpose of giving assurance to the investors, the public at large, that this amount will be actually repaid. I have to obtain a credit rating. Credit rating shall not be lower, inferior than the minimum investment grade mentioned by SEBI. It shall not be lower. It shall not be inferior than the minimum investment grade mentioned by SEBI. That's the payment process. But sir, what happens if the applications are made, shares have been acquired by the acquirer, and he's not having enough money to pay? We have done all the process, and end of the day, money is not there, public are affected. So before you start this entire process of public offer, even before the draft letter of offer, before public announcement, even before public announcement, 2 working days before public announcement. This is happening when, Amma? Before public announcement. How many days before public announcement? 2 working days before public announcement, we have to create an escrow account. What is escrow account? Which will be used only for the purpose of payment of this open offer, and deposit this escrow account with cash. That means money is already available. This creates the assurance for the public at large that their money will be paid as soon as the open offer is completed. We have to create an escrow account at least 2 working days even before making the public announcement and deposit with what? Cash. Or if not cash, we can also pay in what? Securities. Then deposit securities. Deposit what kind of securities? Frequently traded securities. What is frequently traded securities? This is again an important definition, can be asked as an MCQ. If you're talking about open offer being made in the month of, say we are making open offer in the month of November, then we'll check the preceding 12 calendar months. I'm not taking calendar year, I'm taking 12 calendar months. Which 12 calendar months? The calendar month, the 12 calendar months preceding the month in which open offer is made. In this 12 calendar months period, there must be a trade turnover. That means trading should have happened for at least 10% of the shares of the target company. That means they are regularly being purchased and sold. That means selling securities will be easier for me if it is frequently traded securities. Once the public at large are given with the securities, they should be having enough possibilities to go sell it in the market. Hence, they must be frequently traded securities. Given the wordings, the trade turnover of such securities in the 12 months preceding the month in which open offer is made shall be at least 10% of the shares of the acquirer's company. I hope that is clear. Then, I don't have cash, sir, I don't have securities, but I have given bank guarantee. That means bank is gonna give a 100% guarantee for such payment if acquirer doesn't make payment. Bank guarantee, or last and the best option, partly in any of the options you have, partly in cash, partly in securities, partly in guarantee, whatever you do. But this escrow account, this is also an MCQ. Escrow account, once it is opened, it will be released, it will be dismantled only when, only after expiry of 30 days from the date on which payment is made. From the date on which payment is completed, it will be released only after expiry of 30 days, making sure that amount is not being misutilized by the acquirer, not his PAC. That's your entire process of open offer. Open offer process, one of the most difficult but one of the most interesting parts of the open offer logic. I'll remove all the small examples I've written in this document, and I'll share this PDF for you. So that's your open offer process done. Let's get into, where is this takeover? Let's get into the rest of the chapter. We'll be very quick. There are 2 more questions which are important. Probably 10 minutes from here, we should be done with SEBI. SEBI takeover and entire SEBI also. Let's start with this category. Let me get the document fine. Let's start with this topic. There are situations where the open offer once announced can be withdrawn. Withdrawal of open offer. Sir, when will it be withdrawn? There are 4 circumstances in which the withdrawal is allowed. Where the statutory approvals which are required from the authorities are not been obtained, have been refused. The statutory approvals have been refused, or the acquirer who is being an individual. Remember, acquirer can be any person. If he is an individual and he dies, we'll close the open offer process. Acquirer being an individual natural person, he dies, or the conditions for the open offer of the agreement have been contravened, they have not been fulfilled, they have any conditions to the stipulated agreement for acquisition have been contravened, or any other situation where SEBI believes that it is actually beneficial for the open offer to be withdrawn, they'll pass an order for open offer withdrawal. Once open offer has been withdrawn, now give me the topic clear, Amma. This is very important to understand the next topic also. Who is withdrawing is acquirer. If acquirer is withdrawing it, he has to come and inform it. Inform it to whom first and foremost? Good. It has to be informed to the public at large, for which I'll make a public announcement within 2 working days. Within 2 working days, the acquirer, but acquirer doesn't do it on his own. Who does it for acquirer? The manager to the issue, the merchant banker. Merchant, I hope this is known, Amma. Manager to issue is nothing. Okay, I've written it. Manager to open offer is nothing but the merchant banker. The merchant banker will make a public announcement in a newspaper within how many days? 2 working days. Once a public announcement has been made, simultaneously he should also inform. Inform whom? Same 2 topics as usual. Stock exchange and the registered office of the target company, and also inform it to the SEBI. SEBI, stock exchange and registered office of the target company. Now, how much ever you might have given open offer, the open offer is not completely trustworthy, because it was prepared by the acquirer, and acquirer obviously wants you to get a positive mindset on the acquisition process. He might have used certain words or certain phrases which might manipulate it for his own benefit. Hence, will not completely believe the acquirer, will believe a independent party. The independent director has to give his recommendations about how beneficial this open offer might be for the investors. Recommendations of independent director. Obviously, when should I give it? After tender period or before tender period? Before tender period, it has to be given at least 2 working days before the commencement of tender period. Recommendations of the independent director shall be given at least 2 working days before the tender period. It shall be made announcement in the newspapers and it shall be simultaneously sent. Now think about it. Independent director is a part of the company. That means company already knows it. Then it will be informed to whom? SEBI, stock exchanges. These are common points. SEBI and stock exchange. It's not required to be informed to the company. Company knows it, but it will inform it to the acquirer. What do you mean by acquirer? Will inform it to the merchant banker. Are you getting my points clear? Withdrawal was done by acquirer. It was informed to SEBI, stock exchange, and the company, target company, registered office of target company. Independent director recommendation is coming from the target company. It will be informed to SEBI, stock exchanges, and the merchant banker. Indirectly, acquirer will be getting information of it. SEBI, SEBI, stock exchanges, and merchant banker. Obligations of target company and obligations of acquirer. Both of them are important, number. Any one of them can be asked a 7 marks question, or both of them combined together can also be asked a 7 marks question, but both of them are very easy to understand. Obligations of target company. Who is acquiring? Acquirer. During this open offer period, during this open offer process, the target company has to make sure that the business of target company is being carried out in the ordinary course of business as per their past practices. They're not doing anything unorthodox. They're not doing anything out of the box. They're continuing business as a going concern. They have to make sure that during this open offer period, they're carrying on business in the ordinary course consistent with their past practices. Are we getting this point? Second category. Now, the target company is being prohibited. This is important topic. Just before the tender period, if the target company fixes a record date for bonus shares, nobody will be willing to sell it. If nobody is willing to sell it, the acquirer has put in a lot of efforts, time, and money into the open offer process. He'll be at loss. The target company is prohibited to fix a record date 3 days within 3 days prior to the tender period or during the tender period. Two logics, Sama. First of all, he is prohibited. Who is prohibited? Target company is prohibited to fix a record date. When should I not fix a record date? Within 3 working days prior to the tender period or during the tender period until the expiry of tender period. I'm not allowed to fix any record date. This can be MCQ, a beautiful concept. Second category. Next category. After the tender period process is completed, after this tender period is completed, if you remember the process, after tender period is completed, we'll have the identified date. Within 10 days from the identified date, we have to make payment. But there's a chance that a person might have made a bogus application. He's not even a shareholder of the target company, but he made application during the open offer period stating that I want to sell my shares. Will I pay blindly to every person who makes an application? I'll have to verify it clearly. For the acquirer to verify it clearly and make payment, acquirer doesn't have knowledge on who are the shareholders. Then who has knowledge? Target company. Then the target company within 2 working days from the identified date has to provide the list of all the members along with their details on number of shares, folio numbers, what's the joint holders, who is the owners, etc. All the information must be provided within 2 working days from the identified date. But there are situations where the shares are not yet transferred, but transfer is not yet registered. There's a dilemma on who is the shareholder. Given the list of that also, the shares which are pending on registration. List of those which are pending registration, or the list of all the shareholders of the target company, which will help whom? Acquirer, to make sure that he'll identify the rightful applicant. And the last and the most important part, the target company is being acquired for its business. If during this target company open offer process, if the target company goes to the market and starts selling, disposing, leasing, or doing anything with their assets of the target company, by the time acquirer comes and controls this business, assets will not be left. He's not just acquiring the target company's brand name or cash in it. He's acquiring what? The business, for which Assets must not be disturbed. We'll use a technical word. The assets of the target company must not be alienated by the target company. It can be done if they have obtained prior approval from shareholders. First line of answer, can they alienate the assets? No, unless they have obtained prior approval from shareholders by passing a special resolution through postal ballot, making sure that higher participation is received. Given the wordings, alienation is allowed or not allowed? Not allowed unless you got a prior approval from the shareholders by way of a special resolution through postal ballot. Then I can alienate the assets. That's your obligations of target company. Then obligations of acquirer. 5 minutes should be done. Obligations of the acquirer. What does acquirer do? Acquirer, and the first and foremost responsibility of acquirer is to make sure that he had made firm proper arrangements for making payment to the public at large. Financial arrangements have been made for fulfillment of payment. Who made the financial arrangements? Acquirer. Second category, during this open offer process, he has to obtain lot of statutory approvals. If you link it, if you don't obtain the statutory approvals and these are refused, you will go for withdrawal of open offer. Very good. Statutory approvals have to be obtained with. Then the alienation topic. This is again very interesting and very logical concept. Try to answer this. Who is not allowed to alienate this time? Acquirer. After acquisition, after takeover, he is not allowed to alienate the assets of the target company, because who believed that business will be continued? Public at large. The public believed that assets will be held, assets will be continued, assets will be used for business. If this acquirer comes and alienates everything, it's a loss for the public. Then acquirer is not allowed to alienate the assets unless he has intimated his intention to alienate even before purchasing securities in the open offer itself, in the draft letter of open offer itself. In the open offer letter itself, letter of open offer is already disclosed that will alienate a specific asset. Then he can do it. If it is not mentioned in the open offer, can he alienate the assets? No, unless we got a prior approval from the shareholders, same topic, by passing a special resolution through postal ballot. Give me all three stages. Can the acquirer alienate the assets? No. Can the acquirer alienate the assets if it is already mentioned in the letter of offer? Yes. If it is not mentioned in the letter of offer, can he alienate? No, unless it has been approved by the shareholders by passing a special resolution through postal ballot. Last couple of points. Then once alienation topic is done, the acquirer during this open offer period cannot sell his shares of the target company in the stock market, in the open market, while fulfilling all these responsibilities. Who should fulfill all the responsibilities? Acquirer along with his PAC. If they don't fulfill any of these responsibilities, they will be jointly and severally responsible for those fulfillment of responsibility conditions of this open offer process. Exemptions. Whatever we have learned in the last 47 minutes will not be applicable for the following categories. What is it not applicable to? First and foremost, underwriter. Where? Why is it not applicable? Underwriter is purchasing securities because of a contractual obligation, but is not purchasing because of the intention of taking over control over the target company. He purchased, but purchased only for the purpose of contractual obligation to be fulfilled, not for taking over the control. Stockbroker. What is happening with stockbroker? I hope you have heard about margin purchases. A client, say I'm a company, I have asked the stockbroker of mine to purchase securities on margin, where I'll not invest money, but you purchase it. If the margin amount is not paid back to the stockbroker on timely basis, the stockbroker has a right to exercise lien over the shares. On a temporary basis, I'll acquire lien. If the amount is still not paid, I can sell it. So what's happening? Stockbroker is holding shares by exercising lien over the shares of the target company. He never had the intention to take over the control. He's doing it because the margin amount was not paid by the target company. Stockbroker exercising lien over the shares of the client. Client means the target company here. Merchant banker. The merchant banker, for the purpose of making sure that the responsibilities of this open offer is done, sometimes the shares on a temporary basis are held in the name of merchant banker for reasons such as safety net or stabilizing agent. I'll come to that. So basically, merchant banker purchasing will not be considered as a takeover, will be considered as an exemption to takeover. Then safety net. What is safety net? The market right after public offer. Right after making public offer, the market is very, very volatile in nature. It may fluctuate heavily up or down. Now, I have made a safety net. I'm giving a promise to all investors, boss, you don't have to worry. If at all, the price of, just an example, Amma, if at all, the price of the securities just after open offer, maybe say assuming within 1 month of open offer, falls below rupees, say assuming 70, I'll purchase at 70 rupees from you. That means you'll incur loss, but you'll have a safety of 70 rupees. You'll not fall below 70. You have a safety net. You'll catch at 70. So what is the topic? After open offer, because it is not stable in nature. If the prices fall down and fall down below 70 rupees within say 1 month, I'll come and purchase at rupees 70. Safety net is created. So why am I acquiring? To provide you safety, not for taking control. I never had an intention to control. I acquired it only for the benefits given to the public at large. Similar topic, stabilizing agent. The merchant banker doing acting as a stabilizing agent. What is it? Same topic, right after the public offer is done, lot of people, because of the gray market premium, they start selling securities. If lot of people start selling securities immediately and nobody is purchasing, obviously the demand is low, demand is low and supply is more, prices will fall down and prices may drastically fall down. What does this merchant banker do? Merchant banker on a temporary basis goes to the market and purchases them, not to resell but to hold it, so that the demand supply will be a little negated and the prices will be stabilized. Once the prices are stabilized, he'll slowly start selling those securities back into the market. He's not doing it for the purpose of control. He's doing it so that the market prices is not fluctuating heavily, stabilizing the market prices, called a stabilizing agent. Or the shares have been acquired pursuant to multiple categories. Disinvestment. I'll be quick on this. Disinvestment. Government is selling its securities. Say Air India. Government was holding 51%. They sold the securities to Tata Motors. Even though control is shifting, it is done by government on a transparent basis. If it is done by government itself on transparent basis, there is no requirement of making a open offer process, anything. Takeover code does not apply. Second case, merger amalgamation. If you remember, the compromise arrangement amalgamation process, the merger amalgamation happens with the consent of the shareholders having majority and having 3/4 in value. That means the merger amalgamation happened with the consent of the shareholders itself. If it is happening with consent, that means there is no problem for shareholders. There is no need of protecting shareholders. If the merger amalgamation is an order passed by the court and which is happening on a voluntary basis with the consent of shareholders, I don't have to go for again an open offer as such. Or the provisions of SERP are applicable. If you are comfortable with SERP Act as of now, I hope you are comfortable. Reconstruction of financial asset. While reconstruction, one of the point is I'll take over the management, I'll take over the control over the borrower business. Taking over this, borrower's business is not done for control, not done for obtaining benefit out of the borrower's business, but I'm doing it for the recovery of my loan, recovery of my financial asset, which is not gonna trigger any of the open offer procedures. Delisting of securities. A listed entity, as per the SEBI regulations, want to delist itself. That means they want to exit the listing procedure. If they're exiting listing procedure, existing public securities must be repurchased. That buyback of the existing securities is going to give control to a person. It is not considered as open offer. It is not going to be considered as a takeover because they are not even listed entity anymore. They're not going to affect the public at large. They're delisting and exiting from the listing market. Not required. Shares being forfeited. Slightly negative point, what's happening here? Say there are 100 shares in total and I'm holding 20 shares. I'm holding 20 shares. That means I'm holding how much percentage? 20%. Any doubt in that? Now, all of a sudden, what happened? Say 25 shares on which calls were not paid have been forfeited. If those are forfeited and they're not reissued again in the future, the total number of shares have been dropped down to 75, out of which I'm holding how much? 20 shares. My percentage automatically goes up. I did not actually acquire anything, but my percentage in the company is going up because of the reduction in the total number of shares because of share forfeiture. Are we getting my point? Share forfeiture has reduced the total number of shares and my percentage in the company has increased without me acquiring anything. I never had an intention to get control. Because of forfeiture, I'm getting this 25% shares. I don't have to go for open offer. It has been exempted from the trigger point topic. I hope all the concepts are very, very, very clear. It took us 55 minutes, a little more than expected, 10 minutes more than expected. But still, I hope the entire concepts are very, very clear with the charts. I hope you guys draw the charts. If you don't have time, at least take this PDF and practice it when you're doing this takeover code. Thank you. This will be the end of your SEBI regulations. Let's start with the next chapter in the next session. Thank you, guys. Let's get started with the most hated chapter of your syllabus. CMA Final Law has a lot of topics to it, but I would say that one of the most hated topics for students is always been IBC, Insolvency Bankruptcy Code. There are multiple reasons why students hate it. It's huge, first and foremost. It has a lot of numbers and a lot of procedures to remember, and on top of it, it's a completely new world. Students don't understand the flow of this chapter clearly. Once I've understood it, I agree, trust me, this is one of the easiest and one of the most interesting chapters out there. I know until this point of time, before we start IBC, usually students go through the Companies Act first. And they're comfortable with Companies Act. They've been learning this Companies Act from years together. At inter level, we have learned Companies Act. We had the introduction of Board of Directors. We had the introduction of basic companies procedures. We know Companies Act. Continuing the same format, we have an extension of Companies Act at your final level. And it was comfortable for you to act such. But all of a sudden, within a switch of a button, we'll shift into a different world altogether. Names are different, parties are different, authorities are different, procedures are different, numbers are different, processes are different. Everything becomes different, and it is not difficult, not so easy for the student to adapt to this different procedures all of a sudden. So what we'll do here is we'll have a little extended time. I'm not gonna restrict myself to a specific time limit for this IBC. I want to go a little more detailed into it, not completely detailed as would we be doing in the regular class. I'll try to end up within 1 or 1.5 hour of time. This IBC, before we start it completely, I want you guys to understand the reasons why it was implemented first. So that the mindset of this law, the way in which the law was drafted, is clearly understood for you guys. So we'll start with the topic: what is insolvency? What is bankruptcy? What is this word called as code, and why 2016? And what happened before 2016? If you can answer these set of questions first, then we'll be able to start the procedure of this chapter. It will be lot easy for you. So what will you guys do? Take a pen, paper, we'll draw charts if required. Pause the video whenever the charts been shown. Draw the charts, take a water bottle, sit down and make sure that you're watching till the end of this video. Trust me, I'll make sure that this is one of the easiest chapter for you, but you have to spend time with me. Well, let's start with the first category, 2016. So what happened before 2016? Did we not have insolvency laws in India? No, we actually had insolvency laws in India. We had insolvency laws before 2016. We had close to, insolvency was dealt by 13 different acts in India. More than 13 different acts in India used to deal with insolvency procedure. Are you getting this point clear? 13 different acts means 13 different authorities, 13 different procedures, 13 different manners in which, or the perspectives in which insolvency was looked at, 13 different procedures in which a person can be called as insolvent. Because there is always a chance of dispute between laws, there was overlapping of laws. One law would agree, the other law would not agree for it. There was overlapping of laws. This overlapping of laws has eventually led to the process where the insolvency process before 2016 was able to be treated only on an average of more than 5 years. It used to take more than 5 years for the insolvency process to complete in India. Imagine 5 years of time. Imagine where were you guys 5 years back? Still in school, wearing the school uniform, enjoying your summer holidays, enjoying your winter holidays, no homeworks, no Sundays, happy life. But there's a lot that has changed in the 5 years time, a lot for the good. But end of the day, 5 years is a huge amount of time. If an entity goes for insolvency process for before today, assuming they'll complete the process of insolvency 5 years from now. 5 years from now, it's a huge amount of time. And the problem is, the basic definition of insolvency, you guys know, our liability is more than assets. This is wrong, Amma, but just for the time being, if liabilities are more than assets and you're taking 5 years to complete the insolvency process, the assets in this 5 years may deteriorate even further. The value will be even reduced, and in this 5 years, the person who has went into insolvency cannot start a new business, cannot indulge into new businesses. His focus will be on the process of insolvency. And also get this perception wrong: a person who has been declared as insolvent is not always a wrongful person. Just imagine this: We have, say for example, purchased a huge piece of land for a real estate project. Once a project has been initiated, once you have purchased a land with huge amount of investment, all of a sudden the government has changed its policies and changed its procedures. Orders have been passed where now what happened? The land which we purchased all of a sudden fell with its value, and now we are unable to pay our debts. So the process of not able to pay our debts, liabilities more than assets might not always be with the default of the person being declared as insolvent. It may be also the circumstances in which he is declared insolvent. So if a person is declared insolvent, he must be released from this insolvency as soon as possible so that he can start a new business entity. So what is the process now? So what have we done is, the 13 different acts which we had in the past, all of those 13 different acts have been consolidated together into one book, one simple book called as Insolvency Bankruptcy Code. Why do we call it as code, sir? The reason why it is called as code is that it is not a new law that is introduced. It is combination of multiple different laws together combined in one book, is called as a code. So we don't call it as act, we call it as code. This code was passed in both the houses of parliament in the year 2016. Passed in both the houses of parliament, assented by the president. It is a central act. But before 2016, what's the background, sir? It was introduced in the both the houses of parliament in the year 2015. Once introduced, we had discussions about it and we passed it. Passed in which house? Both the houses. Passed in both the houses in which year? 16. Introduced in which year? 2015. But the background process actually started in the year 2014. In the year 2014, the Ministry of Finance has established a committee called as Bankruptcy Laws Reforms Committee, BLRC. What's the full form, Mama? Bankruptcy laws. The bankruptcy laws has to be reformed. Reforms Committee, Bankruptcy Laws Reforms Committee. That committee was established in the year 2014. Just give me the flow of the process. Committee was established in 2014. They have given some draft recommendations of the code, which was introduced as a bill in the House of Parliament in the year 2015. Discussed, we have approved it, and we have assented it in the year 2016, the IBC Code 2016. So, sir, this word is fine. It's a combination of different acts. So, it's a consolidation of different acts. It's a combination of different acts. We call it as a code. And it was passed in 2016. So, hence 2016. Now, coming to these two words, insolvency and bankruptcy, very, very important to understand. For them to understand, there's a small chart I've drawn. We divide the process of insolvency into two parts now, corporates and non-corporates. Before I start that, wait a second. The 13 different acts, as we were discussing, we had multiple acts. We had the basic acts which you can relate to. We have something called as Companies Act, obviously. We have the Indian Partnership Act, which used to deal with insolvency procedure. We had the process of LLP, which used to deal with the process of insolvency. We had Provincial Insolvency Act. We have Presidency Towns Insolvency Act. We had Sikh Industries Act. There are multiple different acts which were there for dealing with insolvency. Just take the consideration here. LLP used to deal with only LLPs. Companies Act used to deal with only in companies. Presidency in Towns Insolvency Act or the Provincial Insolvency Act used to deal with individuals. So what happened here? Different set of people used to go for insolvency at different level of authorities, different category of laws. Now what happened? All these have been combined together and brought into a single book. Now the benefit of IBC, one of the major benefits of IBC is this entire set of people, everybody will be covered under one umbrella. Everybody will be covered under one umbrella. Everybody will be covered under one authority. Everybody has to follow the similar procedure, which makes it easy for us to supervise and regulate insolvency as well. So what happened? Everybody falls under one category. For the purpose of the law making, we divided them into two parts. One we call it as corporates, other than corporates, that is non-corporates. So who are included in corporates? We have our companies included, all the companies, as well as all the LLPs are included in the corporate part. If it is other than corporate, it is usually individuals and partnership firms are included in the point of non-corporates. So what are the concepts? If the insolvency definition is slightly changed now, it is not liabilities more than assets. It's a process where if you are unable to pay your liabilities on the due date, then we call yourself as insolvent. What is insolvent? If a person is able or unable to pay his liabilities when they become due, When they become due in the future, if I'm not able to pay it, then I'm called as a insolvent. Let's take a small example for you to understand this. If the liabilities are, say, assuming 15 lakhs and assets are assuming, say, 12 lakhs. As of now, if you talk about it, my liabilities are more than assets, but these liabilities will not become due today or tomorrow. They are becoming due after a period of, say, assuming 5 years. And I'm pretty much confident that in this 5 years, I can actually generate more assets and I'll be able to pay all my liabilities. If you're able to pay your liabilities, you're still called as solvent. When will you be declared as insolvent? When you are able or unable? Unable to pay your liabilities. Now give me the process. If a corporate entity is unable to pay its liabilities, then it is called as they are in the process of insolvency. They have went into insolvent. They're called as insolvent. Now, this insolvency, you know the answer. What will be done after insolvency? You will go into liquid. No, sir. Liquidation is not the right answer. Just understand this. Once an entity goes into insolvency, the IBC law now states that will not liquidate everything. If at all we liquidate, can I say the GDP is reduced, unemployment is created? To start a business with the same scale and level, it will take a number of years to start again. So liquidation is not my option. Liquidation is my last resort. Last option available is to liquidate, but before I liquidate, I'll try to revive the company. I'll try to treat the process of insolvency. So a lot of people get this wrong. Insolvency is not the conclusion of an entity. It's not the end process. It's not the end. It's not a conclusion. Insolvency is not a conclusion. Insolvency is a situation in which you are able to pay or unable to pay. Unable to pay. Now, this situation can be revived, can be treated by a concept called as, if it is for corporates, we call it as CIRP, Corporate Insolvency Resolution Process. Now, this CIRP, Corporate Insolvency Resolution Process, is a effort made by the IBC law to revive the entity, corporate entity. The word is very clear, corporate's insolvency resolution process. We will try to resolve it. If the resolution process fails to be implemented, then we have no choice left. Then we'll go into liquidation. Second aspect, non-corporates. If it is non-corporates, again, if they're not able to pay it, they're still called as insolvent. But the process in which we'll treat the insolvency, I cannot use the word corporate insolvency. I have a different name. They'll try to revive themselves by a concept called as repayment plan. They'll repay the money. A plan will be created on how to repay the money. If repayment plan fails to be implemented, then they will go into no, sir, they're not called as liquidation, they're called as bankruptcy. Now, I hope these words are clear for you. What's the conclusion if I ask? Liquidation is a conclusion, bankruptcy is a conclusion, but insolvency is a situation. If the situation is not treated correctly, then we'll go into liquidation or bankruptcy depending upon whether it is corporate or other than corporates. So come back. Now give me the meaning of this. Insolvency means a situation where a person is unable to pay his debts. Bankruptcy is a conclusion when used for other than corporates. If it is corporate, we use the word liquidation. But how to treat it? We have a concept called as CIRP, Corporate Insolvency Resolution Process. I hope this 13-14 minutes of introduction is very, very clear. Let's jump into the process now. I'll be a little quick on the introduction part. It is not that important for exam perspective. We'll focus and spend more time on the CIRP logic here. So what happened? As we just were discussing, this was introduced as a bill in the year 2015. Then it was signed by the president and when passed in both the House of Parliament in the year 2016. Then they introduced 2016. Before this, they have established a committee called as Bankruptcy Laws Reforms Committee. Bankruptcy Laws Reforms Committee was established. They have not mentioned it here, but it is established in the year 2014 by whom? The Ministry of Finance. Before the Insolvency Bankruptcy Code 2016, before 2016, we used to have multiple laws. These multiple laws were overlapping with each other, which is creating a dilemma on the completion of the process. Then we introduced IBC. So what's the benefit of IBC now? We'll have one authority or multiple authorities. One, and they've established a new authority called as IBBI, Insolvency Bankruptcy Board of India. This one authority will take care of every aspect of the insolvency process. Now it will maximize the value of assets because we can sell it quicker. It's done in a time-bound manner. I'll come to this. It includes corporates, other than corporates, partnership firms, individuals. Everybody is included in the IBC. Now, as we were discussing about it, The insolvency process used to take on average more than 5 years in the previous law. Now, sir, it is obvious that once the new law has been introduced, removing all the authorities, removing all the problems of the previous regime, can I say the time limit will be reduced? It used to take how many years? 5 years. Now the time limit obviously will reduce, and they have brought it down to a period of 180 days. How much? 180. A mere 180 days will be sufficient to complete the entire process of CIRP. Now, where is 5 years? Where is 180 days? They've reduced this drastically. It shall not exceed 180 days. Maximum 180 days is given to you. So it is a time-bound process. We have to be very efficient with the utilization of time. Of 180 days, you'll get to it in a bit or so. Now, we have discussed this already. Partnership firms, individuals, LLPs, companies, or any other entity as the central government may notify. And we will also include our Vijay Mallya. You might know this. Kingfisher has taken loan from SBI, but the loan was guaranteed. Personal guarantee was given by Vijay Mallya. If the Kingfisher goes into insolvency and liquidation process, Vijay Mallya will also go into insolvency process, provided he was available to take an action in India. But a personal guarantor of corporate data will also be going through insolvency process. Then we have the 5 pillars of insolvency bankruptcy code. What are the 5 pillars? These are called as what? 5 pillars. This can be an MCQ. What are the 5 pillars we have? First and foremost, we have IBBI, Insolvency Bankruptcy Board of India. Underneath IBBI, we have 3 authorities called as IPA, IP, IO. Don't worry, I'll explain it. Start with IP. IP is Insolvency Professional. What is Insolvency Professional, sir? It is nothing but a qualification as similar to your qualification as CM. You're qualified as a CMA. As a qualified cost accountant, you can enter into multiple roles. You can maintain books. You can conduct cost audit. You can conduct internal audit. You can conduct stock audit. You can conduct maybe something regarding cost records to be maintained. So give me the point clear here. A single qualification get you multiple roles as such. Same process is used for IP also. IP is a qualification. This qualification will let you to be appointed as multiple different persons during the process of CIRP. You can be appointed as interim resolution professional. You can be appointed as resolutional professional, or if you're going into liquidation, you can be appointed as a liquidator. Your 3 roles which you have as a IP. And if it is other than corporates, we call you as a bankruptcy trustee. 4 different options. IP is a qualification. That qualification will allow you to be appointed either as a IRP or RP or liquidator or bankruptcy trustee. But this IPs will be regulated and supervised and controlled with a agency called as Insolvency Professional Agency. Then we have IU. IU basically contains a centralized database. It's a centralized database containing all the financial debts accepted by everybody. If a financial debt is accepted, that information will be uploaded in the IU, a central database. To verify it easily, we have something called as information utility. So what happens here? Four pillars are done: IBBI, IPA, IP, IU. All of them, 4 of them combined together will help the process of insolvency to be completed. But sir, you told us 5 pillars, right? What's the next pillar we have? We have something called as adjudicating authority, decision making process. Adjudicating authority, I'll divide them again. It is 2 types: corporates and non-corporates. If it is corporates, the NCLT itself will take care of it. Who is the authority? NCLT. If not NCLT, if you're not satisfied, you can go make appeal to the NCLAT. If not NCLAT, you can go to the Supreme Court. When it comes to non-corporates, we cannot go to NCLT. The words are very clear: company law. We will not go for corporate and other than corporates. For NCLT, we'll go to something called as DRT, Debt Recovery Tribunal, Debt Recovery Appellate Tribunal. Then we'll end of the process. We'll end it with Supreme Court. So I hope the pillars are also clear. Give me the 5 pillars we have: IBBI, IPA, IP, IU, and adjudicating authority, AA. I want full forms here: Insolvency Bankruptcy Board of India, Insolvency Professional Agencies, Insolvency Professionals, Information Utility, Adjudicating Authority. Who is adjudicating authority for corporate purposes? NCLT. Or you can go to a higher court, NCLAT and Supreme Court. We have some definitions given, Amma. I don't think these definitions are required for you to understand, but basic points are: corporate means company and LLP. If they're owing any money to another person, they're called as corporate debtor. The person to whom they're owing money is called as creditor. This creditor here is of two types. Either they can be financial creditor or can be a operational creditor. If they're owing a financial debt, I've taken a loan from bank, they're called as financial debt, they're called as financial creditor. I owe a salary to be paid to my employee. It is operational debt, that will be called as operational creditor. Very basic points. Now, I hope the introduction is fine. You spent 20 minutes into the introduction, and I hope that is worth for the rest of the chapter. The rest of the chapter, I would now coming to the most important and the most interesting part of this chapter, IBC CIRP, and obviously one of the most hated of the students as well. But let me clarify this. I'll make it the most easiest part of yours. CRP will be very easy if you understand the flow of it. Stick with me for the next 5 to 10 minutes. I'll give you an overview of this entire chapter. Once the overview is completed, we'll come back and expand each category of topics, which will actually make sense once the introduction is done for you. Stick with me for the next 5 to 10 minutes, and I'm not going to go in detail into the process. As I've said, this is a disclaimer. This is not a regular class. Regular class, this overview itself takes me around 2 hours of session to complete. Just an overview takes 2 hours of session to complete it. To make sure that the overview is very much understood and the flow is created for a student, it takes 2 hours in the regular class. But here I'll be trying to sum it up within 5 to 10 minutes of time. So stick with me. If you're not getting comfortable with the flow in the first time, repeat this part. Repeat this 5 to 10 minutes multiple times so that it will be easy for you to understand the rest of the chapter in a very smooth manner. So what happens here? CIRP, Corporate Insolvency Resolution Process, is a process where we try to revive it. We try to revive it by preparing something called as a resolution plan. The ultimate goal of this logic is to prepare a resolution plan, a plan to resolve ourselves, a plan to revive and treat this situation of insolvency. But to prepare this resolution plan, the process starts from making an application to adjudicating authority. As we have discussed, for corporates, who is an adjudicating authority? NCLT. So we go make application to a NCLT, the adjudicating authority, and adjudicating authority, if after verification is satisfied that actual revival, actual resolution is required for such corporate entity, then the adjudicating authority will admit the application, initiating the commencement of CIRP will begin. So commencement of CIRP depends upon the admission of application by adjudicating authority, which will be done after verification. But for this whole process to start, we have to make an application. Who will make this application? Application can be made either of three people. It can be made either by a financial creditor or by an operational creditor, or application can also be made by the debtor, the corporate entity itself. A company can go to the adjudicating authority, state that, sir, it's enough, we are not able to pay. Start the process of CIRP, will go for resolution plan. Who can also make application? Corporate debtor. So we have three options: either financial creditor or operational creditor or corporate debtor can go make application. To whom? Adjudicating authority. The adjudicating authority, after verification, they will pass an order. If they are satisfied, they will admit it. The date of admitting that application is called as commencement date. Insolvency resolution process commencement date. On this commencement date, from this commencement date, we have this time limit of 180 days to complete the entire process and submit this resolution plan. So how does it work, sir? I've drawn some charts for you. I'll share this document with you guys. So what happens? We'll go make application. As we have said, there are three different applicants. There are three different ways in which applications are made. Financial creditor makes in a different format, operational creditor in a different format, and corporate debtor in a different format. So just give me a briefing of it. I'll go in details of it when the chapter actually starts. Financial creditor will go make application to the adjudicating authority. Once an application is made, adjudicating authority will verify. After verification, if the adjudicating authority is satisfied, they will admit it. The date on which is admitted is called as what? CIRP, the Insolvency Resolution Process Commencement Date, from where we'll have a time limit of 180 days. This is a briefing amount. This same thing happens for financial operational creditor as well as corporate debtor. Once an application has been accepted, what happens after the application has been accepted is very important to understand. Now, the application has been accepted, it's been admitted. Now we are starting CIRP. Now in the CIRP process, we have to clearly get this into our mind, stating that the situation which we are standing in now, the insolvency situation, happened because the board of directors, can I say, have failed to manage themselves. They have failed to manage the business of the corporate debtor in a proper manner. That's the reason the liabilities are more, the liabilities are unable to be repaid. The board of directors failed. Because of the fact that the board of directors have failed, we cannot rely upon board of directors anymore. We have to appoint a person called as resolution professional. What is it called as? Resolution professional. But this resolution professional will carry on the business activities in place of the board of directors. But at the same point of time, I have another doubt, sir. If board of directors were unable to manage it, who should have stopped them? Who should have taken action upon them? Who should have removed them? Who should have understood the business in a better manner? Good. Shareholders should have done this. Shareholders have the ultimate power in the company. If shareholders, can I say shareholders also failed to do so? If shareholders have failed to do so and the shareholders are given power to control this RP, can I say this process will repeat again? And shareholders will think about their personal benefit rather than the resolution plan for repayment of creditors. Then, because of the fact that shareholders also failed, we'll create the process where powers are given to creditors. And we just were discussing about this. We have two types of creditors: financial creditor and operational creditor. But not all creditors will form part of this powerful activity of shareholders, where we segregate some of those creditors. How and why, we'll discuss it later. We call them as committee of creditors. Call them as what? Committee of creditors. These committee of creditors will appoint the RP. We know this. Shareholders appoint the board of directors. Now the committee of creditors will appoint the RP. But the committee of creditors, as we were discussing right now, it is not all creditors, it is only certain part of creditors. So it is not readily available in the company. We have to establish it. We have to create it. The establishment of COC will be essential to start the procedures. But after the COC is established, then what? We appoint an RP. That means, sir, we have a doubt here. Until the COC is established, we can't appoint an RP. You're absolutely correct. That's the reason we start not with RP, we start with a person called as IRP on a temporary basis. On a temporary basis until the COC has been established. COC will now decide after establishment to appoint an RP. Until that point of time, we'll have a temporary person called as IRP, interim resolution professional. The name itself gives it interim. It is only for a time being. It is only before the COC has been established. Now, let me get this also clear. You should be able to understand this now. We have a total time limit of how many days, guys? 180. Now, this 180 days period will be distributed between two set of people. The initial stage will be taken care by IRP. Later, IRP's responsibility and the ultimate agenda of IRP is to constitute this COC. Once a COC has been constituted, IRP will vacate and COC will appoint this person called as RP. So can I say the 180 days is distributed between two people? First, initial stage will be taken care by IRP. Later, it will be taken care and carry forwarded by the RP. Now, if this is clear, start the procedure. Give me 5 minutes of time. You'll be entirely done with the entire CIRP overview. This should clear every doubt you had for IBC. Once an admission has been accepted, who accepted the admission? Adjudicating authority. As soon as it is admitted, the adjudicating authority itself will start the process by declaring something called as moratorium. Sir, what is this moratorium? We have a time limit of 180 days. Remember, in the previous regime, we used to have a time limit of 5 years. Now, these 5 years have been reduced down to how much? 180 days. So, 180 days is very little amount of time. Because of the fact that 180 days is not even self-sufficient for preparing this resolution plan correctly, the process states that we have to create a clear playing field for the RP and IRP to prepare it. Hence, let not everybody, let not outsiders, let not third parties disturb them. We'll suspend every single activity during this 180 days period, helping and making sure that the RP and IRP have a calm period, a suspended period where they can focus on the resolution plan more. A moratorium will be declared. And now give me the words clear. IRP is appointed by adjudicating authority. Later, RP is appointed by, wrong answer. RP is not appointed by COC. RP is again appointed by adjudicating authority on the decision made by COC. Get this word clear, Amma? IRP is appointed by adjudicating authority. RP is also appointed by adjudicating authority, but on the decision taken by whom? COC. Are we getting this clear? Then this IRP, get this chart clear, Amma? IRP will make a public announcement stating that, sir, the books of accounts of this corporate debtor you are talking about, those corporate debtors who have done a default in the past, I cannot believe those books of accounts clearly. There's a chance that creditor might not be mentioned at all. If the creditor is mentioned, amount might be wrongfully mentioned. If mentioned, they might have calculated interest in a wrongful manner. I cannot believe the books of accounts of corporate debtor completely will make a public announcement informing everybody that we are going for a CIRP process. If you have any claim from this corporate debtor, come send this claim. Submit this claim to the IRP. IRP will collect it. So I'll call for all the claims to be collected. I hope the colors are clear. I'll collect all the claims. So what will happen? All the creditors, financial creditor and operational creditor will start sending their claims. Claims to whom? IRP. IRP, as soon as the claims are received, he'll verify, he'll check it, and he'll collate everything and put them into a single book. I'll call it as a list of claims. This list of claims will be prepared by IRP. In the meantime, while it is being received simultaneously. Get this logic clear? Because 180 days is very less in time. We cannot do one work after the, we have to do simultaneous progress of the solutions. Hence, while the time we are waiting to receive all the claims, simultaneously, the IRP will manage the affairs of corporate debtor. Now, we were just discussing this. The board of directors of the company have failed to do so. They will be suspended from the office. Not disqualified, not removed, not vacating, just suspended. They'll be suspended from the office, and their chair, their powers, restrictions, duties, responsibilities, obligations will be given to the IRP. Now, IRP will manage the affairs of the corporate debtor while putting the responsibility he has taken is from whom? Board of directors. Get this word clear? Board of directors are replaced by IRP. Now, by the time this all happens, IRP has two things in his hand. He has all the claims and he has also understood the financial position of the corporate debtor. Now, having every information in his hand, now he'll start creating the COC. He'll constitute the COC. Once the COC has been constituted, he'll conduct the first meeting of COC. In this first meeting of COC, the COC itself will decide to appoint a person called as RP. But who will be appointed as RP? The best option will always be IRP being appointed as RP. We were discussing this in the last category. IP is a qualification. This qualification is letting you to act in 4 different models. You can either act as an RP. The same person IRP can also act as an RP, or the same person will act as a liquidator or bankruptcy trustee. We'll come to the bankruptcy trustee later, but he can act as an IRP or RP or liquidator. 3 of the categories can be allowed for the same qualification of IP. So what happened here? The person who was appointed as an IRP will be able to continue as an RP if decided by COC with a voting share of 66%. Second category, a new IP can be appointed as an RP. Either IRP is appointed as RP, or new IP is appointed as an RP. Once RP is appointed, IRP will vacate the office. Are we getting the flow clear? Board of directors vacated, replaced by IRP. IRP is vacating, RP is replacing that position. Now all the powers, duties, responsibilities of IRP will now be the powers, duties, responsibilities of RP. RP will manage the business activities. Now RP will manage the affairs of the corporate debtor. While he is managing the affairs of the corporate debtor, he has to take certain permissions similar to board of directors. He cannot do everything on his own. He has to take certain permissions from shareholders. But the word shareholders have been already replaced with whom? Committee of creditors. He has to obtain prior approval of committee of creditors. To get the prior approval, he'll conduct meetings of COC. While he is trying to manage the business, try to understand this. We were not appointed, we did not start the CIRP for managing the affairs of corporate debtor. Our ultimate agenda was to prepare what? Resolution plan. For the preparation of resolution plan, because RP doesn't have enough time to do so, is responsible in managing the business activities, he will appoint a person called as RA, resolution applicant. This resolution applicant will prepare the resolution plan. But the problem is, the resolution applicant might not have knowledge of the corporate debtor. To give him knowledge of the corporate debtor, which will facilitate him, who? The RA, to prepare the resolution plan, we will prepare a document called as IM, Information Memorandum. That is very, very clear. RP is not preparing the resolution plan. He is busy in the process of managing the affairs of corporate debtor. So who will prepare it, sir? A person called as RA, resolution applicant, will prepare resolution plan. But for him to prepare it, he needs certain information of the company, which comes from a document called as Information Memorandum. This information memorandum is prepared by the RP. So the process starts with the RP will prepare information memorandum. He will appoint a person called as RA with the prior approval of COC again. then he'll provide this information memorandum to the resolution applicant. I hope the shortcuts are easy for you. Information memorandum is given to the RA. Once the information memorandum is given to the RA will prepare what? The resolution plan. Once the resolution plan is prepared, he'll submit it to the RP, not COCMA, RP. The RP, the resolution professional, will now verify whether this resolution plan is meeting with the requirements of the code or not. Once if it is meeting with the requirements of code, if it is not meeting, he'll reject it. Sir, what happens if it is rejected? We'll go ahead with another RA. We'll appoint another resolution applicant, we'll prepare another resolution plan. But if at all it is satisfactory in nature, who believes it? Get this clear, this will be useful for the next topic. RP, after verification of the requirements of the code, is satisfied that it is fulfilling the requirements, he will forward it to the COC. Now the COC will check whether it is feasible or viable to be implemented or not. If they believe it is not able to be implemented, they'll reject it. If they believe they are able to implement it, they'll accept it, admit it. Once admitted, the RP will submit it to the adjudicating authority, the final process. Once submitted, AA, adjudicating authority, will verify the requirements. Once the requirements have been verified, if it is satisfactory, they will approve the plan, approve the resolution plan. If they are not satisfactory with the requirements, they'll pass an order for. We tried to recover it. If you are not able to recover it, we'll go into liquidation. That's the entire process of CIRP. Entire chapter is being summed up. I've given some acronyms. You can take a screenshot of this particular category and you can read it when if you are not comfortable with all the acronyms here. Chalo. It took us 15 minutes of time, but trust me, it's very worthy to understand this process. So I hope this is clear. If not, go through this again, last 8 to 10 minutes of time. Go through this process again, understand this logic very clear, then we'll come back and expand it. Chalo, expand this topic from here. We are making application. Who is making application? Either a financial creditor or a operational creditor or a corporate debtor. A financial creditor can make application when he has eligibility if they are either 100 financial creditors or 10% of the total financial creditors of such class, whichever is lower, can go make application to the adjudicating authority. Adjudicating authority has to verify and verify within 14 days because 180 days is a time limit, but this process of application it also have happened on time bound basis. They have given a time limit of how many days? 14 days. After verification is done, if they are satisfied, then they'll admit it. If they're not satisfied, there are 3 reasons why they might not be satisfied. The application was not complete, there was no default at all from the corporate debtor, or the IRP which you have proposed to be appointed as, IP you have proposed to be appointed as IRP, write the full form if you are requiring it, having disciplinary proceedings pending against him. Some kind of disciplinary action is pending against such person, we cannot appoint such person. If it is not satisfactory, they'll give you a time to resubmit it within a time frame of 7 days. After resubmission, if they're satisfied, they'll admit it, and from the date of admission, it is called as what? CIRP commencement date, and you have a time limit of 180 days. Sir, everything is same, only thing is this application format changes. Quick, what happened? Quick answers, don't look at the tab, just look at me and give me the answers. Financial creditor made an application to adjudicating authority. Adjudicating authority will now verify within 14 days. There are 2 options. If they are either satisfied or not satisfied. If they are not satisfied, they'll not reject it completely. They'll give you a chance to within 7 days, and after it is being satisfactory in nature, they will admit the application on the date on which it is admitted is called as CIRP commencement date. From that date, I'll count how many? 180 days period of time. This is for financial creditor. And he has to submit certain documents while he is making application: proof of claim, record of default, name of an IP who is to be appointed as an IRP, such other as may be prescribed. Just go through them all. These are not much important. You can understand them. Second category is slightly different. This time the application is made. Initiation is made by a operational creditor. If initiation is made by operational creditor, he cannot directly go make application to the adjudicating authority. He has to make a demand notice to the corporate debtor first. Who is making? Operational creditor will make a demand notice to corporate debtor, asking and giving him a last chance to pay the money. And they're giving them a time limit of 10 days to pay money. Within 10 days, if payment is received, can I say there's no default at all? If there's no default, there's no need of initiating CIRP anymore. There's no need of revival. If payment is done on time, the problem arises only when payment is completed or not completed. This should be fine, right? The problem arises only when the payment is not completed. If payment is completed, there is no need of CIRP. Second aspect, there is no payment, but there is existence of dispute. Adjudicating authority states that, boss, we are IBC. We are not here to solve your disputes. We are here to revive it. If at all there is an actual dispute, actual default, and there is no dispute between the parties for default, then I'll start the process of CIRP. You can start CIRP only when there is no payment and there is no dispute. Then we'll start the process of CIRP. Or if at all there is no response at all within 10 days, that means we'll assume that there is no dispute, no response. If there is dispute, the corporate data will inform that there is an existence of dispute. If there is no response, we'll assume that there is no dispute, and obviously there was no payment. We'll make an application. Entire application process remains the same except the application documents which you are filing. We'll submit the copy of demand notice giving information that demand has been sent. We'll submit the statement from IU and statement from banks and financial institutions stating that payment has not been received. We'll submit the proof of claim we have. We'll submit the fact that there is no dispute from the corporate data. We'll submit the name of the IP who will be acting as a IRP. But here the point is, we may submit. It is not mandatory. Previous concept, if you remember, it was mandatory. We must submit. Here we'll may submit the name of an IP who will act as an IRP. The rest of the process remains same amount. Then last and the easiest part, who is making application? Corporate data. Rest of all concept remains same. Only thing is we have to make application. Now to prove that there is default, to prove that there is claim, no other external document is required. If the corporate debtor himself comes to the adjudicating authority, only thing he'll bring is, sir, my books of accounts. From this books of accounts, it is very clear that we have some amount which is due to be payable and we have not paid it. We have made a default. This is enough to prove that there is default, books of accounts. But you'll also recommend the name of an IP who will act as an IRP, but who will make application. Corporate debtor is not a natural person, it is an artificial person. For the application to be made, the shareholder should agree, or if it is an LLP, the partner should agree. What is the proof that they have agreed for it? Shareholders, they have to pass a special resolution. Special resolution. If at all it is an LLP, it's a partnership, they have to get the consent of, approval of 3/4 of the partners. Submit this information and the rest of the process remains the same. I hope the applications are clear. Once application has been made, we'll start the process of CIRP as we were discussing. The adjudicating authority will declare moratorium, appoint IRP, make a public announcement and call for all the claims to be collected. Once this is done, start the moratorium period. During the moratorium period, there are 4 things which are not allowed. First, no new legal proceeding shall be initiated, instituted, nor the existing legal proceeding shall be continued. Institution or continuation of pending cases is not allowed during the moratorium period. Second point, sir, we have an asset. Can we sell the asset, transfer the asset? If we sell, transfer the asset during this moratorium period, if it goes bad, if it could not be recovered, if the company could not be revived, this asset should be helpful to pay the creditors in the future. We are not allowed to transfer, we are not allowed to create encumbrances. Disposing of assets of the corporate debtor is not allowed during the moratorium period. Then third category, we have an asset which was put as a security with a third party. Say assuming we took a bank loan, and for this bank loan we have put this property of the company as a security. Can the bank come and recover this asset? Can the bank come and foreclose, recover money before the expiry of term? Bank cannot disturb this corporate debtor. Foreclosure or recovery of this security interest, the property which is put as security by a third party, is not allowed for the third party. Last case, we have a property in our possession which is not our ownership. We took it on a lease, we took it on a rental basis. Get me clear? Property is in whose possession? Corporate debtor, but corporate debtor does not have ownership of such property. Can the third party come and recover, the lessor, can he recover this property? If he recovers, who will do business? How would I carry on business if he recovers all the assets? Can he recover the asset? No. The lessor is not allowed to recover assets from the corporate debtor in possession of corporate debtor. These are the 4 things which are allowed or not allowed. Not allowed during the moratorium period. There is one thing which is allowed. What is allowed? The usual goods and services, essential goods and services for running the business in ordinary course of business. Those transactions shall not be interrupted. Don't disturb it. Shall not be suspended. Don't cancel it for a certain period of time. Or shall not be terminated. Don't cancel it permanently. 3 categories. Interrupted, suspended, or terminated shall not be done during this moratorium period. That means they must continue in the ordinary course of business. Essential goods and services shall continue. But sir, This moratorium period shall continue till what point of time? Concept is very clear if you have understood the flow. It should continue until CRP process ends. CRP process is for how many days? 180 days. If CRP process is for 180, moratorium, the non-disturbing period shall also be for 180 days. It will continue until the completion of the CIRP. But sir, not every time CRP will take 180 days. There are chances where CRP might have completed within 150 days. If it is completed within 150 days, what do you mean by completion within 150 days? The resolution plan has been approved by adjudicating authority, or the order of liquidation has been passed. We could not revive it. Order of liquidation was passed by adjudicating authority, and if this has happened before the process has completed, moratorium period is no more required. So concept is, it is still the completion of CIRP. However, if the approval, the resolution plan has been approved or order of liquidation has been passed by adjudicating authority before this period, the moratorium period will cease to exist. What will it happen? It will cease on the date on which resolution plan is approved or the liquidation order has been passed. Passed by whom? Adjudicating authority. Good. That's a moratorium period done. Then we'll make a public announcement. Our syllabus doesn't have details as may be prescribed. We'll make a public announcement basically inviting everybody to come send their claims to the IRP. I'll collect all the claims. Now comes the process where IRP has already done the public announcement, is waiting for the claims to be received. In the meantime, simultaneously, he'll start managing the business of the corporator. Who will be responsible for the management of affairs? The IRP, Interim Resolution Professional. During this interim resolution professional being managing it, the board of directors office stands suspended. If they are vacating their office, suspended from the office, will replace their office? IRP. Now all the officers, employees at the ground level, are they still existing? The managers, officers, employees, they'll report to whom? Report to the IRP. The IRP will have access to all the books of accounts of the company. Whether those books are maintained in a physical form or they're maintained in an electronic form, I'll have access to it. If the books are maintained by outsourced financial institutions, I have a right, IRP has a right to give instructions to such financial institutions on how to maintain the books. So can I say he has the ultimate power now? Every power which was in the hands of board of directors will now be in the hands of IRP. Now at the same point of time, we should not deny the fact that we are trying to revive it, but revival is not certain. There's a chance that revival might not happen. If the revival does not happen, the assets shall be available to pay the creditors. I agree they are not fully available, but we are indirectly, can I say, 180 days period is delaying the process of liquidation. We are trying to revive, but the process of revival is taking time of 180 days. In this 180 days period, there is a chance that property's value might deteriorate. IRP has to make as much as efforts as possible. He must endeavor. He has to take efforts to protect and preserve. I want two quick keywords here. Protect and preserve the value of the properties of corporator. Whose responsibilities again? IRP. Protect it and preserve it. While doing so, all the powers of board of directors are given to IRP. All the restrictions placed on the board of directors will be on the IRP. Just a linking of Companies Act, 179 powers are with IRP, 180 restrictions are with the IRP, which were applicable to whom first initially? Board of directors will now be applicable to the IRP. Now IRP will continue to manage the business activities. He'll have books of accounts. He'll get information from external parties, government, information utility, banks, financial institutions. Every place he'll get information from. Last point for IRP. Not only managing business, because he's replacing board of directors, the compliances of this corporator, the rules, regulations to be followed, the concepts of Companies Act, the concepts of SEBI regulations which are required to be complied with are also the responsibility of IRP. So you're putting a lot of headache on IRP. He's also paid in the same manner. He's paid lakhs of rupees for this IRP process or RP's process. So he has a lot of burden. At the same point of time, he is also going to enjoy a lot of fruits from this insolvency process. Last, conclude everything. What has this IRP done? So this IRP has collected information regarding the assets, finances. The person has collected information regarding the creditors. He's collected claims. He prepared the list of claims. He has constituted something called as COC. He has monitored the assets of the corporator and performed such other duties as may be prescribed. Simply speaking, whatever we have learned, put them in words, that's it. Everything should be sorted out. This is something interesting. all the information about the financial creditors will be uploaded in the IU. We have discussed this already, information utility. Now, the IRP has received certain claims from the public. He'll send this information to the IU to make sure that they'll reconcile with each other. Is it matching or not? The information available with IRP, information available with the IU, is it matching or not? I'll send it to the IU. Let the IU check it. This is one of the logical and very important logic, very important concept. Now, during this is again a little extension to the powers of IRPMO. As we discussed, the managers, officers, CEO, the high level authorities who is existing in the company, the corporator, have to provide their assistance to whom? The IRP, while he is performing his duties. If they don't provide their ultimate assistance, all assistance, this IRP's ego got hurt. He'll not speak with you, he'll go to the adjudicating authority. Adjudicating authority, what happened? These people are not assisting with me. So what happens? Adjudicating authority will pass an order taking action on such persons as the adjudicating authority may deem fit. Whatever feels correct for adjudicating authority, they'll pass an order taking action on such person who do not provide extensive assistance to the IRP. Now IRP, can I say, has come to that situation where I know the assets, I know the financial position, I know the creditors, I have prepared the list of claims, I have all information ready in my platter. Now I'll constitute the COC. COC is constituted with all the financial creditors of the corporate corporator, not operational creditors, only the financial creditors. Which financial creditor? All the financial creditors will form part of the COC, but there are two people who are excluded. If such financial creditor is a willful defaulter, or such financial creditor is a related party of the corporator, then he will be excluded from the process. Sir, what happens if I am an operational creditor? Am I included? No. Then my rights might be suppressed by financial creditors? No. We have created enough amount of provisions under IBC which is going to make sure that operational creditors' rights have not been suppressed in nature. But COC will be a constitution of only what? Financial creditors other than defaulters and related parties. Sir, what happens if I am a financial creditor as well as operational creditor? Will I become part of COC? I'll become part of COC only to the extent of the financial debt. Say, assuming I'm having 10 lakhs of financial debt and say 5 lakhs of operational debt. In total, I have total debt of 15 lakhs, financial debt is 10, operational debt is 5. I'll become part of COC only worth rupees 10 lakhs. There is second point. We have something called as consortium agreements. Where is it? Consortium agreement, sorry, third point. Consortium agreements. What is consortium agreement, sir? It is a single loan agreement, single concept, but this single agreement, single loan agreement has multiple financial creditors. Then all the financial creditors will combine together, form part of COC respectively for their amount of money contributed to the financial debt. If say assuming SBI has given a loan of 10 crores and say assuming HDFC has given a loan of 5 crores. In a single agreement, 15 crores was given to the company. Now both of them, SBI and HDFC, will become the part of COC, but SBI will have right voting share amounting to 10 and HDFC will have voting share amounting to 5 crores. Every decision of COC is taken based on majority, 51%, not less than 51%. But don't remember this, Amma. My suggestion is our syllabus covers only those scenarios where COC's approval are required with 66% voting share. So wherever you see the approval of COC, just blindly remember that it is 66% from here. We have constituted COC. My responsibility as an RP is coming to an end. The last responsibility I have as an RP is to conduct the first meeting of COC. The first meeting of COC, this has been an MCQ. The first meeting of COC shall be conducted within 7 days from the date of constitution of COC. Once a COC is established, within 7 days I have to conduct the first meeting of COC. In this first meeting of COC, the COC, while passing a resolution with 66% voting share, will decide whether to continue this IRP as an RP or they'll appoint a new IP as an RP. Then we have also discussed this. If you're appointing a new person, this appointment is done by whom? Adjudicating authority, but adjudicating authority will do it in consultation with, because IBBI has overview over you. If you remember the pillars of IBC, we have discussed about it. The powers of over IPA is given to the IBBI, so it will be appointed by adjudicating authority in consultation with IBBI, but decision taken by COC with how much percentage? 66%. Now, once a person has been appointed, who is replaced? IRP is replaced with appointment of an RP. Now, this RP will take care of the process from here on. But sir, after appointment of RP, I felt that RP is also not the right person to complete this process. Can we replace the RP also? Yes. With the same procedure followed, we have to get approval from the COC with 66% voting share, appointed by adjudicating authority in consultation with IBBI. Same process will be followed. Now, once a IRP has been appointed, the powers, duties, rights which are in the hands of IRP will now be the powers, duties, rights, obligations of the RP. Now, RP will manage the business activities. While doing so, if the IRP is appointed as RP, there's no problem. But if at all, and new person is appointed, he doesn't have any clue about the financial position. He doesn't have clue about the creditors of the company. Whatever documents, records, information that has been collected by IRP shall be provided to the RP, letting him continue the process of CIRP. What is it? The information, documents, or records collected by the IRP shall be provided to the RP. Now, IRP, based on this information, will continue the process to prepare the resolution plan. Now, for the purpose of resolution plan, he'll continue to manage business, but can he do every activity on his own? There are certain transactions which can be done only with the prior approval of COC. What are the transactions? They, again, how much percentage, Amma? 66% voting share. I can do certain transactions only with the prior approval of COC. What are the transactions? Just go through them very, very quick. You have to remember them. You have to do writing practice for them. You have to remember. This can be asked as a question as such. So what are the topics here? They are raising interim finance required to run the business activities. They're putting the assets of the corporate debtor as a security interest, giving them as collateral and raising money, changing the capital structure, changing the ownership, or otherwise linking the same point. They're disposing of the shares of the shareholder, disposing or permitting to dispose the shares of a shareholder, making changes in the operational constitutional documents of the company, entering into any related party transactions, or managing the business of the corporate debtor, changes in the management, appointing or removing the CEO, manager, officers, or changing the terms of contracts of such, or appointment or changing the terms and conditions of the auditors, internal auditor or statutory auditor, and the most important and the essential point of this entire CIRP will appoint a resolution applicant. Applicant is appointed by the RP with the decision taken by, with the prior approval of the COC. Pause this, take a look, read it on your own, all the points, get through all the logics. We have spent a lot of time in the regular class. I don't have enough time to go through each point here specifically with an example, Amma. I hope you understand that. Go through this entire process. But for that to be done, we have to conduct a meeting. Meeting of COC shall be conducted whenever it is required. Who will conduct the meeting? RP. IRP is executive office, Amma. Who will do this from here? RP will conduct the business. RP will conduct the meetings. Whenever RP is conducting meetings, the RP has to send notice of this meeting. Notice of meeting is obviously sent to whom? Members of the COC. But the problem is, members of COC never had the experience to manage business. They never had the knowledge of running the business activities. So they can take the help of suspended board of directors. The suspended board of directors will also be invited. We know this. They will be invited, but they will not be allowed to vote. Will have the voting right only the members of COC. The suspended board of directors will not have the right to vote, but they'll have the right to attend and speak. They'll share the knowledge so that COC can take a better decision. At the same point of time, if you're an operational creditor and you're holding not less than 10%, how much? Not less than 10% of the total debt, then you're also invited, but you're not allowed to speak. This voting share will be depending upon the amount of financial debt you're holding. Meetings will be conducted. Then we have to appoint this person called as RA. Coming to the point of RA, this is important, Nama. I'm expecting this question to be asked. Who will appoint the RA? RP, but with the prior approval of COC. They'll appoint a person called as RA. Who can act as RA? The answer is any person. There are no qualifications. Any person can act as an RA, but there are certain disqualifications. There are certain people who are not allowed to act as an RA. A person who is undischarged insolvent, obviously. If the person himself is insolvent, he's trying to recover the company now. It doesn't make any sense. A person is a willful defaulter. He has made a default intentionally in the past. If this person himself has a wrong intentions and defaulted his creditors, how would he prepare a resolution plan and help these creditors of corporate debtor? If he himself is a willful defaulter, he cannot act as a RA. Connecting to the same point, if he has been debarred, prohibited from accessing capital markets. We have done this in IP raising of finance also. If he's been debarred, prohibited from accessing the securities capital market, then he's not allowed to act as a RA. Wait a second. He's not allowed to act as an RA. Give me the couple of points we have discussed now. Either he is a undischarged insolvent, or he is a willful defaulter, or he is a person who has been debarred from accessing capital markets, or a person who is disqualified to act as a director under section number 164 of the Companies Act, or he has at any point of time has an account on in his name which has been classified as non-performing asset, which is overdue for more than 90 days. From the due date, if it is more than 90 days and he has still not paid the money, that means he is again a defaulter. If it is classified as non-performing asset, he is disqualified as a director, or he has done an offense for which he has been imprisoned. If it is 12th schedule of this code, if he is imprisoned for 2 years, or any other law, if he is imprisoned for 7 years, he is not allowed to act as a RA. Are we getting these all points clear, Amma? Undischarged insolvent, willful defaulter, debarred from accessing capital market, disqualified to act as a director under section 164 of Companies Act. He has been imprisoned. He has an account imprisoned for how many? 2 years under schedule to 12, or otherwise 7 years. He's been imprisoned for a period of, he's been account of his has been classified as a non-performing asset. Any of these activities have been done either in India or may be done outside India, he is still considered as disqualified. Or this is again an interesting topic. A person who has given a guarantee to the creditor against the corporate debtor. What is it? If the corporate debtor doesn't pay money to a creditor, I have given guarantee to the creditor stating that if he doesn't pay, I'll pay it. Now, can I say if I prepare the resolution plan, I'll prepare in such a manner that this particular creditor will get favorable answer. Hence, I'm not allowed to act as a RA. This point you'll understand only after liquidation is done. Wait for it. Just wait for it after liquidation is done. So we'll prepare the IM. Very, very simple point. Who is preparing IM? Who is preparing the IM? RP. RP will prepare IM. Very, very simple answer and one of your favorite logics. Prepare in such manner as may be prescribed. In such form as may be prescribed. Containing such particulars as may be prescribed. Once prepared, give it to the RA. This information memorandum will facilitate, will help, assist the RA to prepare the resolution plan. Once a resolution plan has been prepared, he'll submit the information back to the RP. But RP has to clearly inform that documents may be either physical form, provided in physical or electronic form, but you are getting internal information of the corporate debtor. You have to maintain your confidentiality, have to make sure that information is properly maintained without being disclosed to third parties, and have to also mention that the intellectual property, copyrights, patents, etc. are protected properly. You're not going to disclose, nor you're going to misuse such intellectual property, or to protect them properly. So what is relevant information? They have not again given anything. Such information which is relating to the corporate debtor, which will help the RA to prepare what? Resolution plan, including financial information, disputes, any investigations pending, etc. information. Now we are entering the last stage of the process. Give me 10 minutes, it should be done. Okay. I hope you're sticking to this video until this point of time. It's close to an hour already. Actually, more than an hour. 1 hour, 10 minutes that we have started this particular chapter, but 90% of the chapter is done. Liquidation is going to hardly take maybe 15 to 20 minutes to complete, and personal insolvency is hardly going to take 5 minutes to complete. It's not a big deal from liquidation and personal insolvency, and if you look at it, we are done with CIRP. Last page of CIRP process. I hope you're enjoying this process of CIRP. I hope your doubts have all been clarified. If not, leave them in the comments. I'll be ready to answer that. So coming back, what happened? Where are we standing now? Not in your home, not in the classroom, not in the studio room. You're standing where? We have prepared the resolution plan. Who prepared it? RA, and gave it to whom? RP. Now the RP has to prepare it. RP has to verify it. Is it meeting the requirements or not? He has to verify 4 specific points. What are the 4 specific points? They are very actually drafted in a very conceptual basis. First and foremost, what used to happen in the previous regime was the government dues were given priority, forgetting about the creditors and the resolution process itself. If at all the company the corporate debtor gets revived, who is the responsible person for this revival? Who should be given the credit for this revival? Me? What do you mean by me? Resolution professional and the IRP interim resolution professional. That is the reason why we were able to revive it. Their cost, or less insolvency resolution process cost, must be given the priority. Sir, what is this insolvency resolution process cost? Includes the amount of salary you are going to pay, the fees we are going to pay to whom? Resolution professional. The cost the RP has incurred to raise interim finances, the amount he has incurred to make the public announcements, the amount he has incurred for running the business activities, managing the business of the corporate at, or the amount incurred by the government entities to complete the process of CIRP, their assistance, or such other costs as may be prescribed by IBBI. All this combined together will be called as what? Insolvency resolution process cost. This resolution process cost must be properly accounted for as a priority. First priority must be given to this. So has it been given or not? Insolvency resolution process is given a priority or not? Second point, talking about the operational creditors. If it is not revived, we'll go into liquidation. If the company, the corporate debtor, goes into liquidation, the liquidation estate will be distributed between the creditors, and acting as an operational creditor, if I assume I'll get 10 crores, if the company, if the corporate debtor had gone into liquidation, then the resolution plan must be prepared in such a manner that I should get at least 10 crores. If I'm getting only 8 crores from the resolution plan, as an operational creditor, I would say better liquidate the company. Actually, liquidation is going to give me better amount of recovery. So the resolution plan shall provide provision for payment. Provision for payment to whom? Operational creditors, which shall not be less than the amount that could have been paid if the corporate debtor had gone into liquidation. If they had gone into liquidation, if they could have been paid 10 crores, at least pay him 10 crores through this resolution plan. If the operational creditor is paid less than that, the resolution plan will be rejected by RP itself. That's the second point. Third point, assuming this was accepted, assuming this was implemented, if assumed to be implemented, RP will vacate the office. RP was here only till the resolution plan is submitted. Now who will resume their office back? Board of directors. But board of directors never had this idea, never had a clue about what's happening in this company, because as of now they're suspended. Give me the way in which the affairs of the company will be managed after the resolution plan has been accepted and implemented. The management of affairs of the corporate debtor, if the resolution plan is approved, then not only the management of business, we should also try to revive it. We have to implement the resolution plan, the process in which we'll implement, and the process in which while implementation will supervise it. Implement and supervise the resolution plan. 4 things. I'll have to check 4 things. Priority given to insolvency resolution process cost. Operational creditors must be paid such amount which will be paid at least in the liquidation process. The management of the corporate debtor after the resolution plan has been accepted. Implementation and supervision of this resolution plan. 4 points. Verified by whom? Resolution professional, RP. Once verified, he'll also make sure that it is meeting all the requirements of this IBC code. Once the code has been fully satisfied, he'll give it to whom? Committee of creditors. Now this committee of creditors will conduct meeting, in which again by passing a resolution of 66%, they may either accept or reject after checking the feasibility and viability of such requirements and the code, of the applicability or the implementation of this resolution plan. Once they've checked the feasibility and viability, they'll pass an order. Once they've passed an order, they'll be giving it to whom? RP. RP will forward it to the adjudicating authority. But there's a small extra point here. This meeting in which you are conducting for the purpose of approval of resolution plan, who has better knowledge about it? COC? No. RP? No, because he didn't prepare it. Who has better knowledge about it? RA. RA will also, resolution applicant will also be invited into this meeting of COC where it is being tried to be accepted. Now, once it is accepted, it is given to the adjudicating authority. Adjudicating authority may either approve the plan or he may reject it. If he is rejecting, he'll pass an order for go into liquidation. We have tried it. We have made our efforts to revive it. It is not possible to revive. Go into liquidation. If at all they're approving it, they're gonna pass an order for approval. Once they have passed an order for approval, this order of adjudicating authority will be binding, will be applicable on everybody, corporate debtor, operational debtor, financial debtor, government, employees, everybody will be applicable with this order passed by the adjudicating authority. That's your entire CIRP process. It took us 50 minutes just to complete CIRP and maybe close to 20 minutes to complete the introduction part. I hope everything is clear. These are the keywords which I have used throughout the process of our explanation through CIRP. Make sure that you are able to understand them in a proper manner. Watch the introduction 8 to 10 minutes we have done about the overview of CRP in a very brief manner. And my suggestion would be pause the video, write this down. Once you write it down on your own, it will be a lot more easy for you to understand the process, Amma. So make sure that you write it down. I'll share this particular document. Leave a comment if I forget about it. If I forget, leave the comment on this video. I'll share this document. But still, my preference would be to make you guys write it rather than just to spend just to take a screenshot and keep it in your mobile. Write it. Okay. We have left one particular point in the CRP logic. What are the situations in which an application for CRP cannot be made? We have learned this. Application for CRP can be made either by three people: a financial creditor, or operational creditor, or corporate debtor. But these three set of people are not allowed to make application in certain circumstances against a corporate debtor. When are we not allowed to make an application? Simple, guys, just understand this. We have already made an application for CIRP. The adjudicating authority has admitted your application. The commencement of CIRP has been started. It basically started CIRP procedure, and the IRP has been appointed, or RP is doing his works. In this 180 days period of time, while the CIRP is already being going on, the corporate debtor is undergoing CIRP. Can you make another application? Another application doesn't make sense until this CIRP is actually completed. So if it is a corporate debtor against whom the CIRP process is still being carried out, they are undergoing CIRP, another application for initiation of CIRP cannot be made. Second category, where the application has been made, it is admitted, we are going through CIRP, CIRP has already been completed, the resolution plan has been prepared, it is approved by the COC, and it is also admitted, accepted by the adjudicating authority. Now comes the phase where we'll start implementing it. If it is completed, CIRP has been completed, now the plan is ready on paper, we have to start implementing it. Give it a little time to implement it. Can you make application right after the approval of plan? No. We have to give it a minimum time of 12 months for that plan to be implemented and the consequences of such plan to be understood. If the consequences are not as per the expectations of the adjudicating authority or the creditors, then they may again make an application after how many months? 12 months. So coming to the negative aspect, when am I not allowed to make application? If on the date of making application in the preceding 12 months, if the CIRP process is completed, that means it's not more than 12 months from the completion of previous CIRP, I cannot go for another CIRP. Give me the wordings here. From the date on which I am making application, if in the how many months? Preceding 12 months, the CIRP is completed. The completed CIRP, it's been 12 months preceding the date of making such application. I'm not allowed to make another CIRP application. I cannot initiate another CIRP. Third category, it was being implemented. While it was being implemented, the resolution plan, we violated it. Either the financial creditor or the corporate debtor himself violated the resolution plan, and this resolution plan which is being violated was accepted, was approved 12 months preceding the date of such application. In the last 12 months, you have violated it. I'm not going to allow you to start another CIRP process if it is being violated. Last category, a resolution plan was prepared, assuming given to the adjudicating authority. Adjudicating authority rejected it, stating that the requirements of the act are not fulfilled, and passed an order for liquidation, appointed the liquidator. If the liquidation process is already initiated and liquidation process is being started already, we cannot go for another CIRP. There's no revival left anymore. We tried it, but the revival failed to be completed, and we are already going in the process of liquidation. We cannot go for another CIRP. It is one of the important questions, Amma. You have to go through all the 4 points. Must remember them. Chalo, come to this liquidation category now. The last topic we have, IBC liquidation. Liquidation is that phase where the CIRP failed. If you have failed to implement the CIRP correctly, then we'll go into liquidation. There are 4 circumstances in which the liquidation might happen. How many? 4. 4 circumstances in which the liquidation procedure might be initiated. We'll go in order and try to remember them in the same order. It will be easy for you to remember. First category, the time period of CIRP 180 days, we were unable to prepare the resolution plan. We were unable to prepare resolution plan, and 180 days period has expired. Now the adjudicating authority was waiting in their office for you to come submit resolution plan within 180 days. But you have failed to submit it. Now the adjudicating authority will pass an order. Pass an order for the purpose of liquidation if the resolution plan was not submitted on the expiry of the maximum period permitted for CIRP. That's the first situation. Second situation, sir, the resolution plan was prepared. Once it was prepared, it was given to the COC and COC rejected it, and COC felt that this resolution plan is not something which is viable, it is not feasible to be implemented, it is not possible for this corporate data to be revived anymore. Who felt it? Committee of creditors. And this committee of creditors, by passing a resolution with 66% voting share, decided to go for liquidation. Who decided for liquidation? Committee of creditors. With how much voting share? 66% voting share, have given information and orders to the RP to go make application to the adjudicating authority for passing an order for liquidation. Who decided it? Committee of creditors. With how much voting share? 66% voting share. They gave information to the RP. RP made an application to the adjudicating authority stating that the corporate creditors want to go for liquidation. A will pass the order. Third case, plan was prepared, plan was approved by COC, plan was submitted to the adjudicating authority. Once it is submitted to adjudicating authority rejected it. What was the first example? Plan was not even prepared. What was the second example? Plan was prepared, but it was rejected by COC and COC decided for liquidation. Third case, it was prepared, it was approved by COC, but it was rejected by the adjudicating authority. And adjudicating authority rejected this plan, stating that this plan is not fulfilling the requirements of the IBC law. It is not fulfilling the requirements of the code. Last case, fourth case, it was prepared, resolution plan was prepared, resolution plan was approved by COC, it was also approved by adjudicating authority. Sir, wait a second, everything is fine? Yes, everything is fine. We started implementing the resolution plan. While we were implementing the resolution plan, during the implementation process, we violated the terms and conditions. On violation, the creditors will be affected. Any aggrieved party other than the defaulter, the corporate debtor, can go make application to the adjudicating authority asking for liquidation. Then adjudicating authority will pass order for liquidation. They'll pass an order for liquidation. On top of the passing of order for liquidation, they themselves will declare the announcement regarding liquidation process. They'll publicly announce it that this particular corporate debtor is now going into liquidation. And they'll also state clearly that they'll inform the authority under which you are registered. What do you mean by authority under which you are registered? Talking about corporates, companies or LLPs, both of them are registered under ROC. So three things are happening, guys. One, liquidation order has been passed. Second, public announcement has been made informing everybody that this corporate debtor is going into liquidation process. And we also inform the authority under which this corporate debtor is being registered, basically the ROC. Now, once a liquidation order has been passed, the date on which this order is passed is called as liquidation commencement date. Now, if you remember, we have already done 2 days. Initiation date, the date on which application is made. CIRP commencement date or insolvency resolution process commencement date, the date on which application was admitted. Now, the date on which a liquidation order is passed is called as liquidation commencement date. From the date of liquidation commencement date, no new suits shall be instituted. Are we getting the word clear? No institution of suits. That means the pending suits which are already there can be continued, but the institution of new suits is allowed or not allowed? Not allowed. We are not going to allow new cases to be filed by the corporate debtor or against the corporate debtor unless the liquidator has taken a prior approval from the adjudicating authority. Then they can file a case. Otherwise, not allowed. Now the point is, we are done with the topic of IRP, we are done with the topic of RP. Now we have to come to the point where we have to appoint a liquidator. But point is, a liquidator has to sell all the assets. This is very simple. Sell all the assets, settle all the liabilities. As simple as that. But to sell all the assets and settle all the liabilities, who knows this company better? RP. RP has been associated with this procedure for the last couple of months now. He actually in detail understands the company better. So it's always better to appoint whom? RP itself will automatically act as a liquidator unless he has been replaced by the adjudicating authority. Give me the wordings here. Who will act as a liquidator? RP, who conducted the CIRP process, will continue to act as a liquidator unless he has been replaced. Replaced by whom? Adjudicating authority. And adjudicating authority states that I'll replace you in three different scenarios, three different circumstances. I don't want you to act as a liquidator. Adjudicating authority replaces if, first case, the resolution plan which you submitted did not fulfill the requirements of the code. We have discussed this in the last category, where the resolution plan was prepared by the RA, resolution applicant, submitted to the RP. RP will check the requirements of the code. Once he is satisfied with the requirements, only then he'll forward it to the committee of creditors. That means if he doesn't even check the requirements correctly, he doesn't even have the basic knowledge of the IBC law, how can he continue as a liquidator? He'll not act as a liquidator if the resolution plan was rejected because of the reasons that it is not fulfilling the requirements of the code. It fails to meet the requirements of the code. He cannot act as a liquidator anymore. He'll vacate his office as a RP. A new IP, insolvency professional, will be appointed as a liquidator, appointed by the adjudicating authority. Same topic, appointed by adjudicating authority in consultation with the IBBI. Very good. Then second category, where this resolution professional to act as liquidator, he'll have additional obligation now. Can we force him to act as a liquidator? No, he has to provide his written consent to act as a liquidator. Obviously, he'll get additional fees, etc. But he has to provide his written consent to act as a liquidator. But what happens if he fails to provide written consent? If he's not giving his written consent, we'll assume that he's not willing to act as liquidator. That means we have to replace the adjudicator, replace the RP, and will appoint a new person as a liquidator. He does not, fails to submit his written consent. Last category, IBBI recommends it to the adjudicating authority. Boss, we don't want this person to act as a liquidator. Who states I don't want this person? IBBI provides information, recommends it to the adjudicating authority, stating that this person shall not act as a liquidator. Then adjudicating authority will replace this person and will appoint a new IP as an RP. New IP as an liquidator. Once this liquidator has been appointed, the powers of directors, managers, CEO, everything will now vest in the powers of liquidator. All the officers of the company shall provide their assistance to complete the process of liquidation to the liquidator. Now, once a liquidator has been appointed, what are the powers of this liquidator? It's a very easy answer, but one of the hot answers for this particular attempt will be very important for exam perspective. What powers and duties of a liquidator are existing? Very simple as storyline. We'll start with the fact that the liquidator, once appointed, he'll take the assets into his custody. Once he has taken the assets into his custody, or into control, all the properties and assets will be taken into his control or custody. Once he has taken them into his custody, he will make evaluation of these assets to understand the market value of the assets in the current date. He'll make evaluation of the assets and properties of the corporated act. While he has made the evaluation, now he has the value of the assets known. Value of the assets is known. It is not easy for them to sell the asset overnight. It will take a number of months maybe to sell a huge machinery, a huge factory, a huge piece of land. It will take time to sell it. So until they have been sold, we have to take measures to protect and preserve the value of these assets. Protect and preserve the assets. But protecting, preserving the assets is not something which I am an expert in. This is not my domain. There's a chance that I might not be having knowledge about that machinery. How to protect and preserve that machinery might not be known to me. I might take professional assistance from any other person for the purpose of performing my duties. Now, while it is taking time for the process of liquidation to complete, I'm not going to sit idly. I'm going to still carry on the business. Imagine there were raw material which were in the process of production left out. Rather than selling them in, rather than scrapping them out, I will continue the business activities of the corporate art in order to make it beneficial for liquidation process. If I sell that, if I scrap the raw material, I'll not get any money out of it. If that raw material is converted into finished good and sold during this liquidation process, I'll get at least a basic income out of it, and that amount will be increasing my amount of assets available, which is used for my huge liabilities to be paid. So I'll carry on the business. Sorry. Carry on business for what purpose? Not for Going concern requirements only for the purpose of liquidation benefits. Underline that also if possible, if it is beneficial for the liquidation process. If it is beneficial for liquidation process, I'll carry on the business. Now, during carrying on process of business, I may draw, I may accept, I may endorse negotiable instruments. Now I am ready with everything. I'll go sell it. Sell what kind of assets are movable, tangible, intangible, immovable. In India, outside India, doesn't matter. Sell all the assets. Now, once you have sold all the assets, can I say you have money ready? You have huge bag of money ready in your pocket. Now, this huge bag of money has to be distributed to all the creditors. So, you will not pay to every random person who comes to the company and states that I am creditor. You have to properly verify all the claims. Once verified, if you're satisfied, you'll invite them and you will pay. So, what's the logic? Verify, invite, settle. Verify them, invite them, settle them. Verify, are they correct creditors of the company? Invite them, settle them. After settlement is done, there is extra powers we have. During this process of liquidation, we'll come to this. They are called as preferential transaction, unavoidable transaction, undervalued transactions. Any kind of preferential or undervalued transactions have been entered. I'll explain this in a bit more. Keep your patience. In this category of, if this kind of transactions are entered, it is a loss for liquidation process. So I can conduct investigation to find out if there is any transaction which has negatively detrimental to the process of liquidation. I'll try to stop such transaction. I'll conduct investigation for it. If at all any cases are pending on the corporate debtor, I'll be the person who will defend any suit or prosecution against the corporate debtor. While I'm performing my duties, I'm on a regular basis in contact with the adjudicating authority, providing information to adjudicating authority on a regular basis. Such are the functions as may be prescribed by IBBI. I hope the story is clear. Quick answers. I have first collected the custody or control of the properties and assets, evaluated the assets and properties of the corporate debtor. I have taken measures to protect and preserve the property's value. Then I have taken professional assistance if required. I have carried on the business for benefit if it is beneficial for liquidation process, made, endorsed, or transferred, or held on with the negotiable instruments. Then sold all the assets, tangible, intangible, movable, immovable, invited claims, verified claims, settled the claims. Then done investigation if it is required. I have defended the corporate debtor if required. I have intimated to adjudicate it on a regular basis. Such other duties as may be prescribed by the IBBI. Now, once my powers are clear, let's start settling now. It's enough of discussion regarding powers and duties on paper. Let's implement them. Let's start settling the process. What's happening? I'll have to sell all the assets. So to sell assets, I have to determine what assets I do have. Just a basic example. I am a lessee who has a possession of a machinery which is belonging to lessor. Can I sell that asset? No. So what could be sold and what could not be sold, what should not be sold is a concept called as liquidation estate. Liquidation estate includes those assets that could be sold by the liquidator and those assets which shall not be sold, which is not belonging to the liquidator. I hope this word is clear, but before I clarify that, let's come to this category, secured creditor. As a secured creditor, you have some kind of asset which is put as a security. This asset which is put as security can be sold, but there are two options. You can either relinquish, what is it? Relinquish your security interest and give it back to the liquidator. Let the liquidator sell it on behalf of you. You might not have enough knowledge to sell it. Relinquish it and give it to this liquidator. Liquidator will sell it on behalf of you and he'll put you on the top of the priority list when the liquidation estate is being distributed. Second category, you can realize. You can take the property and sell it on yourself. Once you have sold the property on yourself, there are two possibilities. Either you have excess money, that means you have surplus, or otherwise you have deficiency. If you have surplus, no issue. Properly come and give accounts of that amount and give that surplus amount back to the liquidator. Liquidator will use it for other creditors. But if at all there is deficiency, you will come back to liquidator for the rest of the money, and the liquidator will not give you priority this time. He'll keep you in the last logic for payment of your rest of the money. So it is always beneficial for you as a creditor to relinquish it, because you'll have higher priority, and also you'll not have the headache of going and selling this assets and putting extra time and efforts into it. So you have two options. One is relinquish, one is realize. Relinquish, give it back to liquidator. Realize, sell it by yourself. But relinquish, you are given a higher priority, second priority to be specific. If you realize it, you are given the least priority for the deficient amount. If there is surplus, account it, properly give information to the liquidator, and provide that money back to the liquidator. While if you want to realize this asset, the corporate debtor has to provide assistance for selling the asset. If they have any resistance, they're not allowing you to sell it, you can make application to the adjudicating authority. With that knowledge, come back to this liquidation estate topic. Another maybe 7-8 minutes more should be done from here. Liquidation estate states that what is included in the liquidation estate. The first category we'll discuss about things which are included will comprise in the liquidation estate all things which are in ownership of the corporate debtor, whether he has the possession or not, may or may not be in possession of corporate debtor, everything that is in his ownership. Let it be a mobile property, immobile property, tangible property, intangible property, doesn't matter. Or any asset which is not in my ownership, the ownership of such asset will be decided by the order passed by a court. If the court passes an order in the favor of corporate debtor, then that asset will also become my liquidation estate. And we were just discussing it. If any asset is relinquished by the secured creditor, that asset comes to the liquidator. That asset could be now sold. Sold by whom? The asset can be sold. Sold by whom? Liquidator. If it is relinquished, if the same answer, if the secured creditor has not relinquished it, has realized it, will it be included or excluded from liquidation estate? Good. It will be excluded. Good. And if at all, we were discussing about it, if any preferential avoidable transactions have been done, avoidance of transactions is done, and you have done investigation, found out them, those assets will also be recovered, and those assets can be also sold. It will make sense in a better amount. And what are the liquid assets which are not included, shall not be included in the liquidation asset? Basically everything which is in possession but not in ownership. If I am holding that property as a trust, if I am holding that property in a bailment contract, not having ownership but I am having possession, or I am holding money in respect of the workman, I am collected as some amount of PF or something belonging to my workmen or employees which is not been deposited yet. Amount is in my possession but ownership is not mine. I have to exclude this from the liquidation estate. Or any other contractual agreement which is giving you only possession but not title. No title is there. Or any asset on which a collateral has been created and it has been net off. That means realization of security interest. Security creditor has realized it. It has been set off against the loan which is pending from the security creditor. I am not allowed to sell it. Any asset belonging to shareholder, separate legal entity, cannot be sold. Any asset belonging to the partner, separate legal entity, cannot be sold. Any asset which is in India or any asset, this is a important topic. We have a subsidiary company, and obviously subsidiary company has a lot of assets. Now this holding company is getting into liquidation process. Can the holding company sell the assets of the subsidiary company? Absolutely not. The assets of subsidiary company belong to the subsidiary company. What do you hold in subsidiary company? Shares. Can you sell the shares in the subsidiary company? Yes. Can you sell the assets in the subsidiary company? No. Such as may be specified by the board. Basic concept here is you have possession but you don't have title, you don't have ownership, you cannot sell them. Once this is clear, we'll start collecting the claims. For this collection of claims, I've made a small chart here. So what happens? The liquidator, the liquidator shall collect or he will receive claims within 30 days from the liquidation commencement date. What is liquidation commencement date? The date on which the liquidation order has been passed by the adjudicating authority. From that commencement date, the liquidator shall collect everything, receive everything within 30 days. Who will pay? Who will submit this information? The creditors. Either it might be a financial creditor or a operational creditor. If it is a financial creditor, as we discussed it in the beginning point, the financial creditor's financial debt information will be available with the IU, information utility. So he'll provide information, he'll submit the claim along with the information of IU, information of records of IU, information utility. But there are certain cases where it is financial debt, you are financial creditor, but your information is not available with the IU. If the information is not recorded in IU, you will cry, but you can still recover the money. You have to submit such other evidences which are supporting the fact that you are still a creditor of the corporate debtor. Such other supporting documents shall be submitted. But if you are an operational creditor, your information is not a loan exactly. This information is not available with the IU. Submit such supporting documents as may be prescribed, it shall be sufficient. But once you have submitted documents, if at all you have submitted wrongful claims, you can also withdraw that amount of claims within 14 days from the date of submission. I hope this is clear, Amma. Once it has been collected from the expiry of those 30 days, the next 30 days will be used by the liquidator to verify the claims. After the verification is completed, there are two possibilities. Liquidator may either admit or reject. If it is admitted, everybody is happy. If it is rejected, if it is being rejected, the liquidator has to record the reasons for rejection, and also admission or rejection can happen either for whole amount or for a part of the amount. Say I have applied for 10 lakhs. They've accepted, admitted 8 lakhs, rejected 2 lakhs. If they have rejected 2 lakhs, they have to provide reasons for the rejection. They have to record the reasons. And these reasons must be communicated to the creditor within 7 days. Once it is communicated, I'll not sit silently. I believe that I have 10 lakhs to be receivable, but liquidator agrees only 8 lakhs. He rejected 2 lakhs. It is communicated to me within 7 days. I'll not sit silently. The creditor will go make an appeal within 14 days from the date on which he has received it. The entire claims has been collected. But while the liquidator is verifying them, within how many days, Amma? 30 days, he can get information from multiple different people. He can get information from IBBI. He can get information from banks or financial institutions. He can get information from IU. He can get information from any government authorities. He can get information from any local authorities. He can get information from such other places as may be specified by the IBBI. Once the entire information is collected, he'll verify and he'll complete the process. Then we have certain unavoidable transactions. Will come to that. Distribute the assets first. This is one of the most important parts of this chapter, distribution process. So what's happening here? The distribution process, we'll start with the process. We have already discussed this. Insolvency resolution process cost and the liquidation cost will be given the first priority. Second priority is given to two of them equally, pari passu, equally ranked two people. Workmen dues for the last 24 months, the workmen daily wages for the last 24 months, and such secured creditor who has relinquished are given the higher priority. He is put in the second category. Secured creditor who has relinquished his security will be second priority. Once the second priority is completely paid off, then comes the third category, those employees who have not been paid for the last 12 months. Point number 2 covered only the workmen. Point number 3 covers the employees for the last how many months? 12 months. Then any amount of unsecured creditors existing, then the point number 5 is given to the government. Remember, as per the old regime, government was getting the priority under liquidation process. Now they are given basically the least priority. Government, for the government dues, central government or state government dues for the last 2 years from the liquidation commencement date will be paid. And there comes a secured creditor. That secured creditor who had deficiency, who could not recover money by the realization of his security interest, that amount which is unpaid will be recovered as per point number 5. Give me all the points, Amma. Insolvency resolution process cost or liquidation cost. Second, priority is equally given between workmen dues for last 24 months and secured creditor who has relinquished their security interest. Third, amount is given to the employees for the last 12 months, unsecured creditors. Fifth, equal importance given to the government dues for the last 2 years, and the secured creditor who has realized, enforced his security interest and the amount is still unpaid. That unpaid value will come under point number 5. Point number 6 and point number 7, preference shares and equity shares. Once this all settlement has been completed, the liquidator will go inform it to the adjudicating authority. Boss, I have done my work. You appointed me for the purpose of settlement. I have done my work. Liquidation has been completed. Once this has been completed, it will inform it to whom? Adjudicating authority. Then adjudicating authority, after verifying everything, they'll pass an order for dissolution of the corporate debtor. Who is passing the order? Adjudicating authority. Once adjudicating authority passes an order, from that date on which order is passed, it is official that the corporate debtor has been liquidated, has been dissolved in nature. But we have to go inform it to the authority under which it is registered, so that they will also remove the corporate debtor's name from their registers. Inform it within 7 days. Forward the information to the authorities under which the corporate debtor is registered within how many days? 7 days from the date of passing of this order. That's your liquidation process. Dissolution was also done. The last step of categories we have is the avoidance transactions. Avoidance of preferential transaction. Very simple topic, Amma. The board of directors of the company or the top level management of the company already have a little bit of future prediction about the company, that this company might go into liquidation. They might have entered into a transaction which might have put a creditor on a preferential position. in a beneficial position, the transaction for transfer of any property which is putting a creditor in a beneficial position is called as preferential transaction. Such preferential transaction, can I say, is beneficial for such creditor, whereas it is a loss for the rest of all creditors. To make sure that it is not done so, we have to cancel those transactions. What will happen? We will get the property recovered, will get such, ask such person to pay such money back, will put such creditor, will realize or will discharge the security interest which is created. If say there was an unsecured creditor, but the corporate debtor has created security for him, that security will be released and discharged, security interest will be cancelled. Or if you're a guarantor for that, I don't want to go much details into this example. A corporate debtor gave loan to a creditor, and this creditor's loan was given as a guarantee by me. The corporate debtor, for my benefit, has repaid this creditor. Now, if the creditors are recovered, my guarantee is also recovered and put in place back. Guarantee will also be recovered. So all these activities will be done. We will pass order adjudicating authority on an application made by either the liquidator, or this could be also found out by the RP while he is managing the business. So application can be made either by RP, or application can also be made by the liquidator to the adjudicate authority for passing any of these orders. Same concept, something called as undervalue transaction. You have to remember the fact that undervalue transaction can happen in two ways. Either it is the asset is transferred as a gift free of cost, or asset is transferred for consideration but which is significantly lower than the market price, significantly less than the market price, then it is called as undervalued transaction. I can link it back to the liquidation process if it happens in the relevant period. What is relevant period? If it is happening 1 year before the commencement date. What do you mean by insolvency commencement date? CIRP commencement amount, the date on which it is admitted by the adjudicating authority, or if at all it was related party transaction, I'll put it as 2 years, and the orders remain the same as for the preferential transaction. And this is very simplified topic. If there is any kind of defrauding of creditors, the action will be taken by adjudicating authority to make sure that the creditors are not affected, putting them back in the rightful position, and punishing the persons who have done such wrongful transaction, protecting such victims, that is basically the creditors, restoring everything in the position it was before such transaction. Go through them, it should be sufficient to complete. Personal insolvency is not that important, no questions can be asked out of it. And problem is, I don't like teaching personal insolvency. It doesn't have sense to it. They've given only some part of the concept of personal insolvency. It doesn't have full-fledged of concept. So go through it. It doesn't require much of explanation as well. 1.5 page of content. Go through that amount. Okay. Let's start with the next chapter, Competition Act 2002. Before Competition Act 2002, we had competition laws in India which were dealt by an earlier law, a repealed act called as Monopolies and Restrictive Trade Practices Act 1969, which was effective from 1970, act called as what? MRTP, Monopolies and Restrictive Trade Practices Act 1969. Later, because of this globalization which happened, globalization, liberalization, and privatization, you call it as LPG, right? Liberalization, privatization, and globalization, which happened in the year 1991, it basically changed the entire economic reforms of Indian market, the Indian perspective about business activities, Indian perspective of goods and services have tremendously changed. Now we have become a global market. Now we are a market which is open to the global. We are doing exports out of India. We are allowing imports into India. A lot of businessmen who were settled outside India had a huge amount of resources, huge amount of backup, started coming and setting up their business in India. Thanks to our population, we had close to 94 crores of population when this globalization happened. This was an attractive market for a lot of businesses outside India. So they started setting up their businesses in India. Hence, the market in India has dynamically changed so much. Now, because of these dynamic changes in the market and the new perspective of the Indian government, MRTP Act was not able to keep in pace with the development of India. MRTP was focused on the point that we have to restrict monopoly, but was never focused on the topic of promoting or increasing competition. Then a committee was set up in the year 1999. The committee have researched the processes and have brought in a new procedure, new bill, and it was passed in the parliament in the year 2002. It was effective from the year 2003, early of January 2003, but act is called as what? Competition Act 2002. In the same year 2003, when it was effective, we also have established Competition Commission of India a regulatory or administrative body for this Competition Act to make sure that the objectives of Competition Act have been properly taken care of, have been properly implemented. We started CCI, Competition Commission of India. And a lot of people have this wrong perception regarding this compact. What is compact, sir? Competition Appellate Tribunal. We usually call it as compact, Competition Appellate Tribunal. Problem is, people misunderstand the Competition Appellate Tribunal. This is not existing today. Compact is no more existing today. But while reading the material, study material, or any other book you have, you might get a misconception here. Compact was not established in the year 2003, first of all. When the act came into existence in 2003, the first line of authority was always CCI. If the order passed by CCI was not satisfactory in nature, we did not have compact. We used to make an appeal to the high courts till 2009. In the year 2009, compact was established. Once compact was established, the high court appeals which were made to high court are now being made to compact. But compact was established in which year? Established in 2009. So what was the concept? Before 2009, it used to be high court. From 2009, it was not it is, it was compact. But in the year 2017, when the NCLT got established, we have shifted the compact and given the powers of appeal to the NCLAT, National Company Law Appellate Tribunal. Now, compact is not practically existing today. Compact was introduced in the year 2009 and abolished in the year 2017. So, give me the hierarchy, guys. From the introduction to 2009, it was taken care by High Court. From 2009 to 2016 or 17, compact. From 2017 to till date, it is now being taken care by NCLAT, National Company Law Appellate Tribunal. Is now not only going to deal with appeals of NCLT, but also CCI, Competition Commission of India. Now, how does this Competition Commission of India pass orders? What adjudications will they do? We'll come to the point of the process in this chapter itself. Starts with the objective of this act. The objective, the act has 5 objectives. I hope the introduction is good enough, Amma. We'll go through a little quick from here on. The objectives, there are 5 objectives of Competition Act, or I would say the responsibilities and duties of the Competition Commission of India. Both of them are same. The responsibilities of the Competition Commission of India is nothing but to fulfill the objectives of the Competition Act. 5 points. First is to promote and sustain competition in India. Not only maintain, sustain competition, but also to promote competition in India. To make sure that I am promoting competition in India, I have to ensure that there is freedom of trade. Anybody can come and start selling their goods and services. Anybody can become a supplier. There is ensure that there is freedom of trade. While doing all this, there might be some practices in the market which are trying to reduce, which are trying to suppress competition. I have to prevent them. Prevent anti-competitive practices. For the first 3, promote and sustain competition. Second, ensure freedom of trade. While doing so, I'll prevent anti-competitive practices. Why am I doing all this? To protect the interest of the consumers, not customers. We have only one word, consumer. Every person, either he is purchasing it for commercial purpose or reuse purpose or personal use. Doesn't matter whether he is a customer or consumer as per other act. As per competition law, everybody will be called as consumer. Say, I am purchasing a chocolate from a supermarket, I'm using it for my own consumption. I'm a consumer. I'm purchasing a cocoa bean from a farmer for the purpose of manufacturing chocolate. I'm not gonna use it personally, but I'm reusing it, or I'm using it for commercial purpose as a business entity. I'm still called as a consumer. Everybody is a consumer for Competition Act. So protect the interest of the consumers. How can I do all this? India, we all know this. India has introduced a lot of new schemes. If you have watched the MSME video also, we have a lot of new schemes that are introduced and a lot of very, very beneficial schemes introduced by the government. But the problem is nobody has awareness of it. Now the Competition Act states that I'll able to implement all this by creating awareness among all the consumers, entire industry, that is suppliers and etc., and the government departments as well. 3 set of people I'll create awareness. My 5 objectives: promote and sustain the competition in India. Second, ensure there is freedom of trade so that competition will increase, and I'll prevent anti-competitive practices. I will ensure that the interests of the consumers have been protected properly. I'll create awareness among consumers, industry, and government. The objectives have to be sought out. Objectives will be able to be implemented with the instrumentality, with a tool, instrument called as Competition Commission of India. Now, this coming to the rest of the chapter, this is depending upon this word. Anti-competitive practices. There are three categories of anti-competitive practices called as anti-competitive agreements, abuse of dominant positions, and combinations, respectively from section numbers 3, 4, and 5. You don't have to remember section numbers, that's fine. Anti-competitive agreements, abuse of dominant position, and combinations. We'll start with the agreement category. What do you mean by agreement? We have learned this in Contract Act, obviously, but a little more detailed answer about agreement as per Competition Act. Agreement as per Competition Act states that it may include anything. It may be arrangement, it may be understanding, or it may be an action in concert. Together we are taking an action. Arrangement or understanding or action in concert where it need not be, whether or not it is in a formal basis, whether or not it is in letter, written format, whether or not the parties to such agreement have an intention to legally proceed against the other party, whether it is legal or legally enforceable or not, whether it is written or not, whether it is formal or not, it is still called as an agreement. We know this topic, but put it in the words of Competition Act: an arrangement or an understanding or an action in concert. Whether or not such agreement, such arrangement or understanding or action in concert is formal or writing, or the parties have an intention to take a legal proceedings, doesn't matter, everything is called as an agreement. Now, if this agreement is entered between a group of people to control production, it is called as cartel. Cartel is one of the most important definitions. What is cartel? Cartel is basically an agreement between what, not one and two suppliers. Just giving you a basic understanding of it. If I, one supplier, reduce my production capacity from the market, what will happen? Market prices will increase or decrease. If I am one of the supplier and I reduce the production capacity and supply less goods, the demand remains the same, but the supply is being reduced from my side as a supplier. If I reduce the supply, the prices will increase or decrease. Prices will neither increase nor decrease, because there are other competitors in the market who will increase their production. The market will not be affected by the decision taken by a single supplier or one or two suppliers. If in the same case, an association of suppliers, association of producers, association of distributors, association of traders, or association of service providers come together and they enter into an agreement. They enter into an agreement stating that we'll limit the production, we'll limit the distribution, we'll control the supply, we'll control the rendering of services. In that case, the entire association deciding to control the price or the production or the distribution or the supply, it will have a major impact on the market. That imbalance that will create in the demand and supply will fluctuate the pricing. There can be a chance that multiple people might come together to affect the entire market. If market is getting affected, consumers, end of the day, the consumers are getting affected. Our entire objective of this Competition Act is to do what? Protect the interest of consumers. So what will I do? Cartels are valid or void? Absolutely void. We'll take action against cartels, will impose fines. A huge amount of fine will be imposed against cartel. We'll come to the fine category later. But get the word clear, it's an association, not a single person. Association of producers, suppliers, distributors, traders, or service providers who have agreed by an agreement. By an agreement, they have agreed to do what? Limit or control. Limit or control what? Production or distribution, sale or price of goods or providing of services. Then it is called as a cartel. Rest of definitions are not much important. Consumer, we have just discussed it. Either using it for resale purpose, commercial purpose, or personal use. You're still called as a consumer. Go through the rest definition, should be very easy to understand. Coming to this part, relevant geographical market and relevant product market. To understand this, understand the fact clear, CCI, for the purpose of determining whether a agreement is having adverse effect on competition in India or not. This is one of the keywords we have to remember. Having an appreciable adverse effect on competition in India or not. To define this appreciable effect or not, the CCI has defined what is geographical market and what is product market. What is product market? Basically, if two products are interchangeable in nature, they are substitutes or alternatives to each other. The price of one product, if it is increasing, or demand supply of one product which is being altered, will have an impact on the other product. Then both of them are called as relevant product market. Relevant geographical market is nothing but they are homogeneous in a category where demand supply or the pricing of the goods or services in a particular locality or a particular city is similar to each other. Then they are called as relevant geographical market. The relevant geographical market and product market will be determined by the CCI to understand whether there is adverse effect or not. Coming to the first category of discussion, we'll have anti-competitive agreements. Anti-competitive agreements are such agreements which are having an, this word you must remember, appreciable adverse effect on competition in India. Then such kind of agreement shall be considered as void. So not every agreement is done for the benefits of consumers, not done for the benefits of their own business. There are some agreements which are trying to reduce competition, reduce the benefit given to the consumer at large. So remember this, competition is always good for the consumer and market. It reduces the prices. It makes sure that the competitors are working on their toes to upgrade their business activities as regularly as possible, which is indirectly going to benefit whom? Consumers. So starting with agreement category, we have two types of agreement, horizontal and vertical. If you have seen the takeover chapter already, you should be comfortable with this. Horizontal, they are in the same industry and they're at the same stage of business, same level of business. They're basically nothing but competitors to each other. If competitors are entering into contract, there's a high chance that they're entering into contract for abuse of market. Competitors usually don't enter into contracts, don't enter into transactions. If the competitors are entering into transactions or agreements or contracts, there's a high chance that they're going to misuse their position or misuse the agreement and abuse the market at large. Horizontal agreements are always looked at in a negative manner. Then coming to the second category, vertical agreements are nothing but same industry but different level of the market. Say Tata Motors goes and enters into contract with MRF. This is the contract which is vertical, backward contract, where this is very usual. This actually happens on a regular basis in the market. So we don't look at vertical agreements in a negative mindset. We have this skepticism only when it comes to horizontal agreements, but we'll usually assume that vertical agreements are valid or void. Assume that they are valid unless you have proven them to be void in nature or abusing market as such. Horizontal agreements are usually assumed to be void in nature. Then you have two categories, tie-in agreement. Tie-in agreement, you might not have heard it, but you might have experienced it exactly. Say Microsoft. Microsoft doesn't sell. If you, I as a faculty, I don't require Microsoft access. I don't require much of Microsoft Excel as such. I as a faculty for theory subject, I'll require my PowerPoint, I'll require my Word document, a little bit of Excel sometimes. But understand this, if I had to purchase Microsoft Office, Microsoft Word, the Microsoft company doesn't sell me the Word application alone. They sell me all of the other bundles combined together and they call it as Microsoft Office. Can I say I don't have any economic value for purchasing Access? I don't have economic value for purchasing rest of the processes, rest of applications except Microsoft Word. But they are tied in with this Microsoft Word. To purchase Microsoft Word, I have to I've been forced to purchase rest of applications. I'm paying excess for the product which I'm not even required to purchase, which is not even adding value to me. They are called as tie-in agreements. Again, don't come to conclusion somewhere. Tie-in agreement, whether it is bad or good, will be determined by the CCI whether it is having adverse effect on competition or not. After inquiry investigation, if they feel it is having adverse effect, they'll take an action, they'll impose penalties, etc. Tie-in agreements. We have done the anti-competitive agreements. Come to some agreements which have been defined here. These are the four agreements. This is note point. These are the four agreements which are going to talk about horizontal category, horizontal agreements. These are the four agreements which we're going to talk about vertical agreements, which are usually valid in nature. Starts with the first horizontal agreement, where they're trying to determine the sale or the purchase prices. Basically, prices are being determined by the agreement entered between couple of people. Prices are being increased or purchase prices have been decreased. Then it is called as a horizontal agreement where competitors have agreed to increase the selling price. Second category, where this is something but nothing but cartel. Limits or controls the production or supply or technological upgradation into the market. Nothing but cartel, which is done by association of people called as cartel, or otherwise done between two set of people simply called as an agreement, which is again having adverse effect on competition, which is usually entered between two competitors. Horizontal agreement, which is considered as void. Then if at all, say assume mama, this is, I know you're gonna be starting to laugh now already, but if you're my student, you know this is India. This is India. Now what happened? We were two competitors in the market. We decided why to fight between ourselves and reduce prices and increases competition and have the burden of competition. Let's share India. You take one part of India, I'll take the second part of India, we'll distribute, share the geographical markets and do business. This is killing competition and indirectly might be establishing monopoly in the market, which is bad for the consumers. This is a contract again entered between two competitors, horizontal agreement, which is again valid or void? Void. And again, auction sales. Auction sale is nothing but the prices of the goods which are in auction sale will increase based on the competition during the bidders. If there is high competition in bidders, prices will increase. If there is no competition, prices will reduce. I entered into contract with my fellow bidder, that is my competitor, stating that, boss, you don't bid. Whatever profit we make out of it, I'll share with you. This is called as bid rigging. Bid rigging or collusive bidding, where all the bidders collusively combine together, bid on a particular product to intentionally, artificially reduce the prices, which is bad for the seller, auction sale, but it is good for the competitor, buyers, bidders. So it is again void. We have learned this in Contract Act also. Bid rigging, auction sale, it is void. Contract as well as Sale of Goods Act also. Then the next four categories, we have vertical agreements. Exclusive supply agreement, stating that I'll supply only to a specific set of persons. Come to this words exactly. Other than those of the supplier. If you want to purchase from other than supplier, I'm not going to sell it. If you want to purchase from me, you have to purchase entire goods you require from me only. Exclusive supply agreement. Domino's. The material of Domino's comes from where? Domino's company itself. I've purchased a franchise of Domino's. I should not purchase the material from any other person. I should purchase it only from Domino's company. All the franchises work in this model itself. Exclusive supply agreement. Then exclusive distribution agreement, stating that you should distribute product only in a particular locality. How will you distribute it? I'll put restrictions on it. Car manufacturers. Once a car has been manufactured, he sells it to a dealer and dealer sells it to the customer. And he puts a restriction on how to and where to distribute this product. So exclusive distribution agreements, where to sell and withhold the selling procedure. Exclusive supply, exclusive distribution. Then while I am distributing it, I can also put a resale price method. While resale price maintenance, while you are selling it to the customer, you have to maintain a minimum price so that I'll maintain my reputation or prestige in the market as a company. You have to maintain the pricing. Resale price maintenance. Then refusal to deal is nothing but I don't want to sell the goods to you. It is my intention. I can do whatever with my goods and services. If I refuse to sell the goods, it's my right to refuse it. I can refuse to a specific group or specific group of people or a specific person, not to sell the goods to a person. That is refusal to deal. All of these transactions are vertical agreements, which are usually valid, but if they're having adverse effect, then they're considered as void. Then there are two categories which are never considered as anti-competitive agreements. If you have intellectual property, copyrights, patents, they're giving you exclusive rights. Can I say if they're giving you exclusive rights, that means indirectly it's a monopoly, nobody else can use it? Say, assuming my material here has a copyright. My material has a copyright, nobody else can use this wordings in this material except me. If anybody else is using this material, this is considered as copyright infringement, where I can charge, I can take charge on such person. So copyrights is giving me exclusive right to use this material. Whatever words are used, whatever diagrams are used, if it is general nature, that's fine. If anything is drafted specifically from my side, I cannot. Nobody else can use it. This is giving me exclusive right. This is creating monopoly for my specific work, but that's what intangible assets are for. That's what patents, copyrights, designs are generated for, which are not considered as anti-competitive agreements. Or if you're making exports out of India, if you're making exports out of India, market will be affected, but where? Outside India. I don't care about it. If market is being affected in India, then I'll consider that this is a problem in competition. Otherwise, I don't care about it. So two exceptions there. Abuse of dominant position. First of all, what is dominant position? Simple topic, I am an enterprise who is having a strength in the market. With the strength I have in this particular market, I'm not being affected by the market forces. I'm not being affected by the market conditions. Rather, the decisions I have taken are affecting the market, affecting the competitors, affecting the consumers. I'm basically speaking, the market is not able to affect me. I am able to affect the market. I'm called as having a dominant position, where they act independently of the market competitive forces. I don't care about the market. I am not affected by the market, but I affect the competitors, consumers, and the market in my favorable situations. I'm called to be having a dominant position. A person is having dominant position is not bad. If the person is having dominant position and he misuses, he abuses the dominant position, then it is considered as void. When will it be assumed as dominant, abusing of dominant position? If he directly or indirectly fixes unfair prices in the market. If he is making a fair share of profit, it's fine. If it is unfair or discriminatory pricing of goods or services, then it is called as abuse of dominant position. Artificially very high prices are charged. Thousands of percentage of profit margin is kept in artificial prices, unfair prices, then it is called as abuse of dominant position. Or you are putting restrictions on the market access. Nobody is able to enter the market. Entry barriers have been created. You are restricting new competition to be created. Abuse of dominant position. Or you are putting conditions in purchase of products or services, putting a lot of additional conditions which are in favor of you but which are affecting the consumers as such. Unfair trade practices not allowed. Or you're using your dominant position in one market to abuse or enter into or protect another relevant market. This was done by Jio. Reliance Jio has given Reliance Jio SIM as well as the internet services, unlimited internet services for not unlimited if I'm not wrong, 1 GB per day if I remember it correctly, for 1 year free of cost. So they could have incurred a lot of losses in that 1 year. A lot of people purchased Jio SIMs, a lot of people got converted into Jio SIMs, where they might have incurred a lot of cost, lot of loss. They've incurred a lot of losses, but they were able to sustain those losses because they were backed up by the Reliance Industries, their holding company. Reliance Industries have enough amount of resources in their hand to make sure that Jio is able to sustain the market with losses. The dominant position in one market is being abused to enter or protect the other relevant market, Reliance Jio. And they have also done something called as predatory pricing. What is predatory? What is prey? What is predatory? Predator is someone who kills. Prey is someone who is being killed in the ecosystem. Predatory pricing is putting the price at such level which is trying to kill the competition. What is such level? I'm putting the price at a level which is lower than my cost of production. If it is less than my cost of production also, I'm making not profits, but I'm making actually losses in the process. No competitor will be able to sustain that losses for a longer period of time. If the cost of production is 10, but I am continuing to sell the product at rupees 5 for next 1 year, rest of my competition will not be able to sustain that price and they'll slowly exit the market. Tata Docomo, Aircel, Vodafone, Idea, Uninor, BSNL was never there, MTNL, Reliance. What happened to all these telecom industries, telecom companies? They all got killed by predatory pricing used by Reliance Jio. Was it ethical? Absolutely not. But two-edged sword, it actually benefited India in one aspect, that it has digitalized India. But at the end of the day, it was predatory pricing, which was not ethical in nature at all. But sir, what was Competition Commission of India doing while Jio was doing this? That's not something where we'll focus on for exam perspective. So combination. The last category we have is combination. When is it? Combination is basically merger amalgamation between two or more enterprises. This merger amalgamation between two or more enterprises might have an adverse effect on competition. It will basically kill competition. If there are only two competitors in the market and they merge with each other, they're killing competition and creating monopoly, which is again affecting the market in a negative manner. So which is not allowed. Hence, combination has to be verified by the CCI. So topic is, we have put a threshold limit. We have put a limit. If this limit is exceeding, if it is exceeding the limit, you have to get a prior approval of CCI. If it is below the limit, no approvals are required. If it is exceeding the threshold limit, you have to get a prior approval of CCI. Now, I know there is a lot of debate in the market regarding these numbers. I absolutely agree with you. MCA has brought in new numbers in the year 2024 itself. More than 1.5 years from here, they've already brought in the new numbers. They have been updated already. They have increased these limits now. But point is, ICMAI has not increased it yet. They have not given it in their latest study material, nor they have given in the supplementary document. As per the norms of ICA, you have to follow the study material given by ICMAI. So you will continue to read these numbers itself. I know in the market there are rumors that new numbers should be learned and new numbers will be applicable for your exam. But I'll give me 2 minutes of time here for you to understand why is it wrong perception. When the Code on Wages Act was introduced Code on Wages was introduced in the 2020, the CMA inter-syllabus continued to have bonus act. Bonus Act was abolished, and in place of Bonus Act, they have brought in Code on Wages. Code on Wages was practically implemented, but Bonus Act continued to be a part of your syllabus, and exams were also conducted, questions were also asked from Bonus Act. Was it practically existing? Forget about numbers being amended. Act itself was not existing, but questions were being asked. It's not the practical approach you require as of now for exam perspective. It is what ICMA is expecting from you as a student from study material. So my belief that these numbers are what they are going to be applicable. If at all you are still in dilemma, write both of them. I know you'll find it on the internet. Otherwise, I'll share this table which is given by MCA. I'll share that. But that numbers is, as per my perspective, my opinion, they are not to be learnt. These are the numbers which are there in your study material, and no supplementary document was issued on this yet. MSME supplementary document was issued by our ICMA, so that you have to learn, but this not yet. So I'll continue the old numbers. If you don't believe my perspective, you can go through the other material. You can go to the MCA website, or you can simply type in the competition new limits as per MCA. You'll find this table given by MCA. Otherwise, come to this. If at all the merger amalgamation combination is happening only in India, the joint assets of all the enterprises into this combination, enterprise level. I'm not going through all the holding subsidiary associate companies of it. Only the enterprise which is getting combined with, which is getting merged or amalgamated at the enterprise level, the joint assets of all enterprises, if it is 2000 crores, exceeding 2000 crores, or at the group level, all the group entities combined together, if it is exceeding 8000 crores, you have to remember this number amount. I'll make it easy for you to remember numbers. This is what you have to remember: 2000 crores. For group level, you will multiply that by 4. So 8000. For as turnover, obviously turnover will be more than your assets, you will multiply that by 3, 6000, and multiply again by 4, 24,000. That's the limit you have to remember. What's the limit you have to remember? Everything is in India. Joint assets and joint turnover. Enterprise level and group level. Enterprise level, you have to remember one number. How much? 2000 crores. Now for group level, you will multiply that by 4. You'll get 8000 crores. For joint turnover, you will multiply that by 3, 6000 crores, and multiply by 4 again. 24,000 crores. This is if it is entirely in India. If it is outside India also, if any one of the parties to the combination, enterprises to combination, is located outside India, will calculate not in rupees but will calculate in dollars, $1 million. What's the numbers here? You have to remember again one number: $1,000 million multiplied by 3, $3,000 million multiplied by 4, $4,000 million, and $12,000 million US dollars again. This is fine, but if combination is happening majorly outside India and the Indian component to which merger amalgamation is happening, combination is happening, if it's very minute in nature, they'll not exactly have a effect on the Indian market. If they're not exactly having an effect on Indian market, combination is not going to affect India. If it is not affecting India, why would a CCI care about it? I'll care about it only when this combination has an Indian component, Indian business entity which is having at least 1000 crores rupees, because we are talking about Indian entity back again. We're gonna calculate that amount in rupees. 1000 rupees. Sorry, 1000 crores. Group level, because they are one and the same, we will continue with 1000 crores. Then into 3,000, and no multiplications, 3000 crores is continued. These are taken at the book values as per the book values, but adjusted with depreciation, but includes all your intangible properties. You have every intangible property added, book value adjusted with your depreciation, minus with your depreciation. Now the entire regulation process, I've drawn a chart for you guys for the entire regulation process. Where is it? Where does it start? Here. Shalom. I hope this chart is visible. Now it might be a little better. It will be a little better from here. Chalo. Option 1. I've given 2 charts for our class students, so this is the best option you have. Second option is a lot more precise, a lot more simpler, but this is a better way to understand the concept entirely. So what happens? The enterprises which are proposing to enter into combination, even before combination happens, they'll go make application to CCI, stating that CCI, we are going to enter into a combination, check our combination and give us an approval. CCI, after conducting inquiry, and if required, they'll conduct investigation, then they'll pass an order giving approval or rejection of the combination. But when should I make application to CCI? Within 30 days from the date on which it is approved by the board of directors. Or if there is no approval of board of directors received yet, but we have already entered into an agreement, executed agreement, 30 days from the date of agreement, whichever is earlier. Either approval from board of either approval from the board of directors or execution of an agreement, whichever is earlier, I'll go make an application to CCI. But if after making application, I cannot directly enter into combination, I have to wait for the order to be passed by CCI, where the CCI shall make efforts to pass an order within 210 days from the date of application. How much time is given in total? 210. If you don't make an application within 210 days, we'll assume that combination will be deemed to be approved. But if the combination order has been passed within 150 days, then it will be effective after 150 days. If order is passed within 200 days, effective within 200 days. If order is not passed even 210 days, effective from 210 days. So whichever is earlier, either on the expiry of 210 days or on the date on which order is passed by the CCI, whichever is earlier will be the date on which combination will be effective. But if at all I am a bank or a financial institution which has acquired interest in an entity and combination happened, but I did not have the control, I did not have an intention to obtain control, I did not have an intention to have abuse the market or something or enter into any agreements as such, what happened in this situation? Where I have made an application, but I have acquired it, but acquired it because of a covenant, because of a condition, because of encumbrance existing with the securities. I have acquired it, combination have been effective, then come intimate it at least. I'll come and do the inquiry after combination here. Within 7 days intimated. Within 7 days from the date of acquisition, already acquired it. Within 7 days, inform it to CCI. Now what shall the CCI do? CCI will start with the logic with the inquiry. A negative mindset, but I'll check whether it is having adverse effect or not. If after inquiry is conducted, after considering all the factors, after conducting inquiry, if I feel that this is necessary, I'll conduct investigation, or otherwise I'll simply pass an order. So I'll, on a prima facie basis, after considering all the factors, price, market share, competitors, size of the competitors, entry barriers, exit opportunities, driving out the existing competitors, write whatever comes to your mind. Everything is correct. After considering all the factors by CCI, if they believe that there is appreciable, if they believe that there is appreciable adverse effect, they'll state that inquiry is not enough, guys, we have to conduct investigation. But if at all they believe that there is no appreciable adverse effect, then they'll pass an order approving the combination and agreeing for the combination to be established. Now, if they don't agree, let's start with the investigation process. CCI will send a show cause notice with a length of 30 days to the parties to the combination, asking the parties to combination to show the causes, show the reasons why CCI shall not consider this to be having adverse effect on competition in India, and why shall the combination shall not be considered as void. Who will ask it? CCI will ask the enterprises to provide the reasons, show the causes. Where is it? Show the causes, reasons. Within how many days? 30 days. In the meantime, the CCI will also forward this information to the DG, Director General. This Director General will conduct his inquiry investigation and he'll prepare a report, and report will be submitted back to the CCI. Now CCI is happily waiting in their office, waiting for two things to be received. One, reply from the enterprises to combination, and report from the Director General. Once the reply and report has been received, whichever is later, once both of them have been received, the CCI will pass an order within 7 days. And whatever days I'm using here, everything is working days. So CCI will pass an order within 7 days, asking and giving directions to the enterprises to make a public announcement, which shall be made within 10 days. I hope the numbers are clear. Once I've received information from both the parties, whichever is later, from the date on which I've received information from both of them, within 7 days I'll pass an order giving directions to the parties to make public announcement, which shall be made within 10 days. Public announcement shall be made within 10 days. Once a public announcement is made, public will send their objections and suggestions. Public will send their objections and suggestions within 15 days from the date of public announcement. So parties to combination have made public announcement. The public have responded back with their objections within 15 days. Once the 15 days has been expired, the CCI, can I say, will now have three things in their hand? I don't have things, so I'll assume this. First, reply from the parties, then I have report from the Director General, then I have the objections from the public. I have three things in my hand. I hope they are visible. Three things in my hand. With these three things, I will consider the order to be passed. But if I am not fully satisfied, I may ask for additional information from the parties. I may ask for additional information within 15 days from the expiry of the 15 days of public notice. Within how many days? I'll ask 15 days. Once I've asked for additional information shall be provided within 15 days. Once additional information has been provided, now I have a time limit of 45 days to pass an order. There are two possibilities again. Either it is having an adverse effect or it is having no adverse effect on competition in India. If it is having an adverse effect on competition in India, if it is not having adverse effect, simplest answer, I'll approve the combination. If at all it is having an adverse effect on competition in India, I'll pass an order for rejection of the combination. But if I feel that adverse effect on competition in India can be eliminated by making certain modifications, the CCI will make a modification. Remember this carefully. Who is making the modifications? CCI is making modifications and giving this modification to the parties, the enterprises. Once have made the modifications to the combination and given to enterprises, enterprises have a time limit of 30 days to decide whether to accept them or not. If they accept, easiest answer, if they accept it, CCI has drafted a modification. CCI believes that because of this modification, adverse effect has been eliminated. That means CCI is satisfied. That means the combination will be approved. CCI will approve the combination. If it is rejected, who rejected it? Parties, the enterprises rejected the modifications given by CCI, and they have an opportunity, the parties, enterprises have an opportunity to make amendments to the modifications given by CCI. I hope this is getting sense. Enterprises are making amendments, changes to the modifications made by CCI, and they'll send it to the CCI. Now CCI will either accept or reject. If CCI is gonna accept it, everything is happy. CCI accepted the amendments, CCI will approve it, approve the combination, and combination will be effective. If CCI rejects it, rejects what? Amendments to the modifications have been rejected. If it is rejected, the CCI will send the original document, original modifications made by CCI to the enterprises. I'm giving you last option, guys. It's enough. You're playing with me. I'm giving the last option. Accept the original modifications, otherwise I'll reject the entire combination completely. If you accept it, I'll approve it. Otherwise, combination shall not take effect. Entire combination. I'll obviously leave this chart again in the description. Go through that, write it down if possible. So that's your combination concept done. Once the combination concept is completed, we have the next category where we have to start the Competition Commission of India. Competition Commission of India, is this it? Yeah. Competition Commission of India, again, will not take much time, Amma. I'm expecting somewhere around 10 to 15 minutes. Should be done with the Competition Commission of India also. Very simple topic. Competition Commission of India, as we have discussed already, is a central body. It's a central body which is established. Wait a second. Which is established by the central government. If it is established by central government, obviously it is going to be a central office. It is having its head office in New Delhi. It is a combination of one chairperson and not less than 2 members and not more than 6 members. So it's a combination of one chairperson and members. How many members? Not less than 2, not more than 6 in total. These members and chairpersons will be again appointed by the central government. They will usually be whole-time members. These members, no random person can act as a part of CCI. To act as a part of CCI, you must have a work experience of 15 years, at least 15 years of experience in trade, business, economy, in law, in finance, in industry. You must have knowledge in all these business activity sectors for at least 15 years. Can I say huge, eminent persons will be sitting in CCI? Very huge set of people, huge knowledge, carrying huge amount of experience, they'll be sitting in CCI. But what's the tenure of the person in CCI? There's no number of tenures limit, but they'll be appointed for one term, not more than 5 years. Each term shall not be exceeding how much? 5 years. But once you are appointed, you can be After expiry of these 5 years, you can be reappointed. You are eligible to be reappointed any number of terms until attaining the age of 65 years for everybody, members and chairperson. How much? 65 years is the age limit setup. And we also were discussing about Director General. Director General is a person who is been given work by CCI, but he is a person who is appointed by the mic working appointed by the central government. DG is someone who is appointed by central government, but he's been given work by the CCI. That's your introduction done. Then we have already discussed the duties of CCI. What are the duties of CCI? Nothing but the objectives of the Competition Act, the 5 objectives: promote and sustain competition, ensure freedom of trade, making sure and prevent anti-competitive practices, protect the interest of consumers, create awareness among consumers, industry, and governments. I hope you guys are remembering that. Now, while you are determining whether it is affecting the market or not, we have discussed this, right? Certain factors are to be considered. What are the factors to be considered? We have already discussed this amount. Market size, the social obligations, price of the securities, market share of this enterprise, size and importance of the competitors. Is it driving the existing competitors? Is it creating entry barriers? Is it creating or establishing a monopoly? Basically, all factors we already discussed, and you can write more points also. They've given some examples, that's it. Now, until this point of time, we had more discussion on the topic of combination. Now, if it is an anti-competitive agreement or enterprises abuses its dominant position in the market, and it is after inquiry confirmed that it is anti-competitive or abuse of dominant position, CCI will take an action. There are 3 categories of actions that CCI can take. CCI is, if it is an anti-competitive agreement as such, CCI states that first and foremost, if it is still being continued, discontinue that particular agreement or abuse of dominant position, and we shall not re-enter that in the future as well. Shall not re-enter. First and foremost, discontinue that, and we shall not re-enter that in the future. But if at all discontinuation is not required, but I can make small modifications and eliminate that adverse effect on competition. You have done this just recently. If I can make a modification and eliminate that adverse effect, I'll ask them to make modifications in the agreements or abuse of dominant positions. But sir, this is slightly different from combination. If you remember the combination topic, application was made before the combination was even effective. The inquiry was done even before combination was effective, even before the market was affected. But anti-competitive agreements, abuse of dominant position was found out after the market got affected already. If the market has already been affected, I'll not just leave them by a warning. I have to impose penalty also. I'll impose a penalty of, remember it carefully, every person in the cartel will be imposed with penalty. If it is a cartel, it's an agreement entered between association of persons, every member of cartel will be imposed with the penalty of 3 times the profit of every year, each year in which this agreement was continued. Not entire profit amount, 3 times the profit. And if that is not enough, we'll have a backup of answer, because there might be situations where they intentionally show less profit. So, or 10% of turnover in each of the year in which that agreement was continued, whichever is higher, a very good penalty established. 3 times the profit in each of the year, or 10% of the turnover in each of the year, whichever is higher, is what I'll impose as a penalty. A huge amount of penalties drafted. Then second category, these are something which are very, very easy amount. I hope you can go through them on your own here. If at all a enterprise is not having dominant position, but a division of the enterprise is having dominant position, not the entire enterprise, but one division of enterprise is having dominant position, then CCI will take such actions which are going to affect that particular division. Modify that MOA, ask them to discontinue that particular division, ask them to wind up that particular division, ask them to get merged or amalgamated with some other company with the same division. So basically adjust the contracts or modify the contracts. These are done only to affect what? A particular division or the entire enterprise. Only the division which is abusing the dominant position. Second category, if a concept of competition has happened outside India, usually we don't care about it. But if that competition, agreement or abuse of dominant position or combination happened outside India, but which is directly or indirectly having impact on Indian market, CCI states that my point is not about in India, outside India. My point is my Indian consumers getting affected? If my Indian consumers getting affected? If the answer is yes, I'm not going to sit silently. Wherever you guys are, I'll apply the Competition Act. You might be located outside India, I don't care, I'll apply the Competition Act. Coming with anti-competitive agreement first. The agreement is entered outside India, or the enterprises or the parties to such agreement are located outside India. 2 points more. Either the entire agreement is entered outside India, or the parties to such, the anti-competitive agreement is entered outside India, or the parties to such agreement are located outside India. I don't care. Or the party who is abusing the dominant position in Indian market is located outside India. The enterprise abusing dominant position is outside India, but he is abusing the market in India. I'll take action against him. Or combination was affected outside India. Combination has taken place outside India, but the parties to the combination were located outside India. I don't care who you are and where you are. If it is affecting the consumers of Indian market, I'll take action. I'll take action as CCA. Then penalty summa. I know penalties. I usually don't teach much penalties in the classroom. If I'm teaching penalty, that means it is important for exam. Competition Act is something where penalties have been asked for 7 marks in the past. So make efforts. Remember, do writing practice if you have forgotten. Must be remembered penalties. I'll make it easy for you. Underline the keywords, or otherwise write the keywords in the whatever book you have. If you don't follow the directions given by the CCI or the Director General, you'll be imposed with a penalty of rupees 1 lakh per day. What? 1 lakh per day, subject to a maximum of 1 CR. When will this penalty be imposed? If you don't follow the directions given by CCI or the Director General. And remember, during this regulation of combination process, the CCI sent a show cause notice and giving you a time limit of 30 days to come and reply. If you don't send this notice, you don't give this notice back to CCI, don't even respond back, CCI's ego got hurt. And they'll be charging a penalty here of 1% of turnover or your total assets, whichever is higher. How much? 1%. 1% of the turnover or assets, whichever is higher, a penalty will be imposed on it. Second category, if you have not served the notice, 1%. I gave back the notice, sir, but I've given false information. I've omitted material information, or I have suppressed or altered or destroyed the information completely so that CCI can never conduct investigation also. In that case, you will be punished with minimum 50 lakhs to a maximum of 1 crore. So it is better to provide information there. Minimum 50 lakhs to maximum of 1 crore when you are providing what kind of information, either false or omitting any material information, or you have altered, suppressed or destroyed any information. In that case, you will be imposed with minimum 50 lakhs to maximum of 1 crore. Commission states that, boss, I know investigation for competition is very difficult as such, because we don't enter into formal agreements if you're abusing the market. You obviously would have entered into informal oral agreements which are not having any legal binding. They're not having any authentication that you have entered into it. So it becomes difficult for me to find it out. But if I find, I'll impose huge amount of penalties. So I'll give you one option. I'll reduce your penalties. I'll lesser down your penalties. I'll reduce penalties even below the minimum limit given by Competition Act. Competition Commission of India says that I'll reduce it, but provided you have to give me some information about the process. It's basically give and take. You provide me information about the combination, I'll provide you about the competition or combination or anti-competitive agreements, I'll provide you lesser penalty. When will I give you lesser penalty? If you prove yourself to be beneficial for commission, the Competition Commission of India, I'll give you benefit. So, but there are certain situations where this lesser penalty is not given. When is the lesser penalty not given? If at all you have not cooperated with the Competition Commission of India until the investigation proceedings have been completed. You have cooperated at the beginning, but have shut your mouth afterwards, or you absconded afterwards. You did not give information till the end. It was difficult for me to complete investigation. I'll basically put in full concept of penalty. Or you gave information, but you gave information after the investigation report is submitted. When did you give information? After investigation report is submitted. That means by the time you given information, before you gave information, report is already received. If report is already received, my hard work is already done. I've put in a lot of efforts to investigation. Why would I give you lesser penalties? I'll give you only if you benefit the investigation process. But if you have given information, but at what point of time? After the completion of this report, there's no benefit for CCI, I'll not reduce your penalties. Or you have not fulfilled any of the conditions put in for the reduction, or you have given information which is false in nature, or you have given information which is not even vital, not even important for investigation process. If it is not important, if it is not false, you are actually detracking me from the investigation process. It is becoming difficult for me. Why would I reduce it? I'm not going to give you lesser penalties. But once an order has been passed, who passed an order? CCI, either passing order stating that it is adverse effect, anti-competitive agreement, abuse of dominant position, not effective of combinations, or passing any of the penalties. If an order has been passed by CCI and you're not satisfied, you're agreed with an order of CCI, you can go make an appeal. We have just discussed this in the introduction of this video. I hope you have watched that. You will make application to whom? Not compact anymore. It is NCLAT. You will make an appeal to NCLAT within 60 days from the date on which you have passed. Who has passed an order? CCI. Once the order of CCI is received, you will go make appeal within 60 days. Competition Commission of India passed an order. You made an appeal to whom? NCLAT, National Company Law Appellate Tribunal. They will deal with all the adjudication, the claim compensation, as well as the orders passed by, decisions made by the CCI. Once it has been appealed, what will the NCLAT do? NCLAT states that I will basically give reasonable opportunity of being heard to both the parties. What is both the parties? Enterprises, the parties to the agreement or such, and the CCI. I'll give opportunity of being heard to both the parties, then I'll pass an order. I can pass three category of orders. Either I might confirm the order passed by the Competition Commission of India, or I can slightly modify the order passed by Competition Commission of India, or I can put aside the put aside the order passed by CCI and pass my own fresh order completely. Set aside the order passed by CCI once an appeal has been made. Is there any doubt in this, Amma? NCLAT passes an order if it deems fit of any of the three categories. Confirm the order exactly passed by CCI, modify the order passed by CCI, make basically slight changes, or set it aside completely and pass my own new order. NCLAT can do so. Once you are not even satisfied by NCLAT's order, you can go make an appeal to the Supreme Court. Make an appeal to Supreme Court within 60 days from the date of receipt of order of the NCLAT. Who can make appeal? Agreed party, Competition Commission of India, central government, state government, any person can go make appeal. To whom? Supreme Court, if they are not satisfied with the order passed by NCLAT, same time limit within 60 days. But if NCLAT is not having enough amount of resources to complete the order, they may refer it to the local court. Which local court will they refer it to? If at all, the case is in regard to a company, they'll refer it to such a local court which is having jurisdiction over the registered office of such company. Registered office. If it is not a company, we are talking about parties to agreement, assuming persons, individuals, then where they are residing or where they are usually carrying out their business or profession. Voluntarily residing or business or personal gain or work, that is profession, is being carried out. Last, CCI is the ultimate authority. You have understood this now. CCI basically take care of everything about Competition Act. If at any point of time, if the central government feels that CCI is not able to take their responsibilities or duties correctly and it is affecting the Indian market, the central government will supersede the Competition Commission of India. Basically, throw away the Competition Commission of India and the central government itself will take the responsibilities of CCI, but shall not be more than 6 months. In this 6 months, basically appoint new set of CCI. If you believe that the personnel of CCI is not fulfilling the responsibilities correctly or they are doing something wrong, central government will take over it and supersede it for a period not exceeding 6 months. This can be MCQ, not exceeding 6 months. So close to 55 minutes expected time limit for Competition Act. Let's start with the most important chapter of your entire syllabus, MSME. A small but a very high weightage chapter, and there is an amendment in this particular chapter, so this becomes very important for your attempt of December 2025. Let's get started with this chapter. Micro, Small and Medium Enterprises Development Act 2006. It was introduced in the year 2006. It is a central act. It was passed in both the Houses of Parliament, assented by the President in the year 2006. Coming to the basics of it, a lot of people have this misconception of the fact that large entities, Reliance, Tata, Infosys, Wipro, etc., these are the businesses, these are the companies which run India. These are the countries which basically generate income out of India. They generate huge amount of per capita income. But we also have to get this fact clear that not everybody can be Reliance, not everybody can be Tata. Not everybody has enough amount of capital, not everybody has enough amount of resources to start businesses or run businesses at that huge, massive level. But and also the major problem of India coming to the Indian market is because of the massive amount of population we have, thanks to our population, the per capita income of Indian citizen is very, very low in nature. Because of the fact that per capita income is very low in nature, it should come back. Per capita income is very low in nature. Each individual is not having enough amount of resources and enough amount of capital or enough amount of affordabilities to start a massive business. There comes the introduction of these small industries. Lot of people in India have enough skill to run business, enough amount of enthusiasm to be an entrepreneurship, but this entrepreneurship becomes difficult when they don't have enough amount of capital as a backup. With this little amount of capital, they start taking risk and start doing businesses where they'll be able to generate huge amount of employment, because these businesses are not something which are focused on capital investment. They're more focused on human resource investment. Because of the availability of huge amount of labor in India, the employment creation is basically coming from what? Small industries. Now, getting into the statistics for this, the MSME sector is the second largest employment generator in India after agriculture. Imagine this, not the large businesses, not this Wipro, not this Deloitte, not this Infosys are creating employment in India. The small industries are creating the second largest employment in India. They contribute close to 40% of our exports. Our foreign exchange reserve is basically depending upon small industries. 40% of the exports out of India come from small sectors. 37% of our entire GDP. These are again past outdated data. This should have been increased tremendously now already. So 37% of GDP comes from this small industries. Now you have understood the intensity of small industries, but the major problem these small industries and the benefit for India also. Problem is they cannot establish business activities in urban areas. They cannot afford the rent, or they cannot afford the business costs that will incur in urban areas. They will rather set up their business activities in rural areas, which will actually develop. If a business develops in an area, in and around the business, everybody develops. So if a business develops in a rural area, the rural area is also directly or indirectly creating employment, creating growth, creating GDP, creating exports out of it, creating wealth out of it. The wealth is now being created not at urban areas, not focused on urban areas, is being created in the rural areas, which reduces the imbalances we have in India. India being a very vast country, understand this, Amma, there are still parts of India where there is no electricity and water supply also. And there are still parts of India where we are completely developed. We can compete with any other city in the entire world. Delhi, Hyderabad, Mumbai, Bangalore, Chennai, etc. These are the these are the particular cities in India which are hugely developed, have every infrastructure that is required, have every technology that is required. But there are also some parts of India where there is no electricity at all. So to reduce this imbalances, regional imbalances, to reduce the income inequality, the small industries play a vital role. But the problem is, small industries have very volatile to the market. If say COVID-19 happened, Reliance Industries can sustain COVID-19 for 100 years. They have enough amount of resources to back up. They have enough amount of resources to sustain even though they are incurring losses. But coming to a small industry, if it incurs a loss for 1 year, I'll not be able to sustain. I have to shut down my business. Shutting down a business, creating unemployment, reducing my growth, reducing the GDP, reducing Indian economy, reducing exports, foreign exchange is affected. A lot of factors are affected if a business is being shut down. So what does the government do, and what is the objective of government from this particular act? They make sure that we provide our helping hand to you, the MSME sector. I'll make sure that I'll provide you credit, I'll provide you technology, I'll provide you infrastructure, I'll provide you skill training, I'll provide you marketing, I'll provide you competitiveness, I'll provide you all benefits you are required. You grow your business, you upscale your business, I'll benefit you, because these benefits are not required for Reliance Industries. Reliance Industries doesn't require infrastructure support from you. They can establish their own infrastructure. Reliance Industries doesn't require credit support from you. Go to any bank, Reliance Industries will get any kind of loan they want, at any interest they want. They'll be able to have possibilities of credit worthiness to raise money, not with MSME sector. There comes the problem and there comes the solution. MSME Act, MSME Development Act 2006. For the purpose of making sure that this act is implemented correctly, understand this very concept, the central government are not going to implement it. As we were discussing, these MSME sectors are not set up in urban areas, they're set up in rural areas as such. because of the fact that India is so diverse in nature, the rural understanding the customs, the traditions of the rural area would be understood not to the central government, but better to be understood by the state government. Not only the state government, but also the district level understands it in a better manner about what is the requirement of MSME in my locality, in my district, in my state. Hence, the primary responsibility of implementation of MSME sector lies in the hands of, on the shoulders of, on the head of state government. Sir, but what central government does? Central government provides assistance to the state government for the purpose of facilitating these programs, policies, and schemes to the local level. So, who implements it at the ground level? State government. They are responsible for it. But central government at the top level provides benefits to the state government on creating policies, on creating programs, on creating schemes which are beneficial for promoting the MSME sector. Before we start into the act, let me come through this introduction and the background of ministries here. In the year 1999, we have established a ministry called as Ministry of Small Scale Industries. Ministry of Small Scale Industries doesn't stop there, and Agro and Agriculture Industries, a single Ministry of Small Scale Industries and Ministry of Agro and Rural Industries. But 2 years later, in 2001, they have decided to split them into two: Ministry of Small Scale Industry 1 and Ministry of Agro and Agriculture Rural Industries, a second category. Then in the year 2006, when the MSME Act came into existence, we decided we'll put everything in a single umbrella, making it possible to register every kind of small business in a single category. They have brought in a single ministry again called as Ministry of Small Scale, Ministry of MSME. Now they have brought in the Ministry of MSME, a central ministry. We also have state ministries of MSME. The central ministry will be responsible for the purpose of making sure that they provide facilitation to the state government. Who has the primary responsibility? It is of the state government, but central government provides assistance to them to be implementing it. Now we have understood the fact that MSME has a lot of privileges, lot of benefits, lot of maybe tax benefit, non-tax benefit, infrastructure benefits, credit benefits. Lot of benefits and lot of privileges are given to MSME. Now everybody wants to be called as MSME. Everybody wants to be called a small business. Everybody wants to be called as a medium business, a micro business. Now, to define what is exactly micro, small, and medium, they have given a ceiling limit. If you fall within the ceiling limit, you are called as micro, small, or medium enterprise. Only and only then you can get registered as MSME and avail all the benefits of MSME. There's an amendment in this particular classification, this particular ceiling limits. I'm expecting this to be coming for your exams. So read it once, twice, thrice. These are amended numbers just for December. So there's a high chance that it will come for December attempt. So what's happening? When you're talking about a manufacturing enterprise, you're not going to have much amount of turnover maybe, but you might have much amount of investment into plant and machinery. So investment in plant and machinery is what we take into consideration for a manufacturing entity. But you talk about a service entity, entity which is rendering services. We don't have, as a service industry, we don't have much assets as such. But we don't have assets in our pocket, but we have a lot amount of turnover based on the skill we generate as service industry. So for them, we'll categorize as annual turnover. So if the remember this for remembrance, I'll give you a numbering for micro industry. We'll remember for micro industry first. If the investment in plant and machinery is not more than 2.5, if it is exactly 2.5, it will fall under the small category. For micro, it should not be not more than 2.5 crores of investment in plant and machinery. Just remember this number and multiply the annual turnover by 4. Not more than 10 crores. How much? Not more than 10 crores. So what is the limits here? Investment in plant and machinery shall not exceed 2.5 crores. Annual turnover into 4 shall not exceed 10 crores. This is for micro. When you are shifting from micro to small, just multiply the numbers by 10. The investment in plant and machinery shall not exceed 25 crores. The annual turnover shall not exceed, multiply by 10 amount, 100 crores. Then you're shifting, when you're shifting from small industry to a medium enterprise, just multiply that by 5. This is multiply by 10, this is multiply by 5. What is multiply by 5? Shall not exceed 125 crores, shall not exceed 500 crores. If you are not exceeding these limits, you will be respectively classified under micro or small or medium. Once you have been classified as micro, small or medium, you can now start availing the benefits of MSME sector. one extra point you remember, whenever we make exports out of India, that exports are bringing foreign exchange to India. That foreign currency which is brought into India will not be taken into consideration while calculating the turnover point. Chalo. Give me the schemes of a central government which have been introduced for the purpose of MSME. Take it as a storyline. The first category will be, I don't have enough amount of infrastructure. I have set up my business in rural areas. I don't have enough amount of infrastructure to come sell the product where the consumers are located in the urban areas. I need infrastructure set up from the central government. I need smooth, I need infrastructure facility. With this infrastructure facility, I can start my business. But to start business, I need finance. I don't have enough finance in my pocket. I'll bring money from my pocket, but that is not sufficient to start the business. I have to get a smooth credit facility. Once I have got money, once I have got infrastructure, I start producing goods. But while producing the goods, I don't have enough amount of updated technological support for me. The government will provide technical upgradation. They'll provide latest technology on a free of cost basis or concessional rate basis for MSME sector. I need infrastructure, they gave me. I need finance, they gave me credit facility. I need technical development, they have given me upgraded technological advancements to me. Once I have technical upgradation, I don't have enough employees who can understand this technical upgradation. They'll provide me skill employment. Skill development will be done for employees. I have employees who are skilled, I have technical upgradation, I have proper machinery, I have infrastructure, I have credit facility, I have everything, but I don't know how to put everything in the right positions to make a optimum business out of it. They'll help me out in management issues, they'll help me out in management, how to manage all these factors. Once I've managed everything, I've got everything put in place. Are you getting my points clear? Infrastructure, I had an infrastructure problem, they gave me infrastructure support. They gave me smooth credit facility, they gave me technical upgradation, they gave me employees who can deal with this technical upgradation, they gave me management to understand and deal with all these four resources in a optimum manner. Once everything is put together, I brought my product into the market, but my product is not able to compete with all the huge businesses or branding or marketing that's happening in the market. So what will they do? They'll provide me competitiveness and they'll provide me marketing assistance. How much of assistance they might provide, I'll be able to do business in a better manner if I'm doing business at a large scale. But talking about small industries, the MSME sector, I'm not doing business at a large scale. So what happened? Multiple MSMEs will come together and form a cluster, form a pool of resources, form a pool of business entity and start marketing together, creating a single brand name, creating logistics in a better manner, creating the availability of product or visibility of product in a easier manner. They'll do something called as cluster development. This cluster development is happening between competitors. Now we can also integrate our business activities with backward supply chain and forward supply chain, simply called as backward and forward linkage, which will strengthen my business activities. And on top of all this, they'll also provide a lot of other non-tax benefits to the MSME sectors. All these points are, this is again one of the important questions, where whatever question that might be regarding MSME sectors benefits, you can write these points. Have to go through these points, remember them as a storyline. Smooth credit facility, infrastructure facility, they will provide technical upgradation, they'll provide development of employee skills, management issue, effective competitiveness, marketing assistant, cluster development, forward and backward linkage, and non-tax benefits. These are the benefits which are provided by the government. 10 different benefits are provided. Few quick definitions. The word board includes a national board of MSME. The word date of acceptance and date of deemed acceptance. Simple topic. Once an MSME sector supplies the goods or renders the services to the buyer has a chance to raise objections on those goods or services within a time frame of 15 days from the date on which the goods are delivered or services are rendered. If he does not provide any objections, we'll assume that there was no objections. He has been given a time limit of 15 days to raise objections. If he doesn't raise objections in 15 days, we'll assume he doesn't have objections. Then the date on which goods are delivered, the date on which the services are rendered will be deemed to be the date of acceptance. The day of deemed acceptance. If at all objections are raised within 15 days, either supplier, the MSME's unit, have to rectify and have to resolve that defect, resolve that objection. The date on which I have removed that objection by the supplier, the MSME sector, will be called as date of acceptance. Simple topic, guys. If you have objection, the date of acceptance will be the date on which such objection has been removed. Objection can be raised within how many days? 15 days. If there is no objection, the date on which goods are delivered or services are rendered will itself will be deemed to be acceptance. Now, what is appointed date? Now you're clarified regarding date of acceptance or date of deemed acceptance. The day after expiry of 15 days, I hope this is clear from chart better. Say this is date of acceptance or date of deemed acceptance. From the date, I'll wait for 15 days. The day immediately after the expiry of 15 days from the date of acceptance is called as appointed date. So basically speaking, 16th day from the date of acceptance or date of deemed acceptance is called as appointed date. Now I'll use these definitions in a bit. The National Board. Coming to the National Board, before we start with National Board, let's start with something called as Advisory Committee. Let me give the hierarchy in the process. What happens? The ground level reality is known to the Advisory Committee. Advisory Committee is a combination of multiple set of people who sit together, discuss matters, in if they have any suggestions or recommendations or objections about any policy, program or scheme, they will escalate it to the National Board. But National Board will consider those matters and National Board will give recommendations to the central government. Then the central government starts implementing the schemes, creating schemes, modifying schemes in order to make sure that they assist the state government while implementing it. I hope the process and hierarchy is clear. Advisory Committee giving it to National Board giving recommendations to CG implementing those policies, giving help to the state government. Repeat it again. Who starts the process? Advisory Committee. They don't implement, create rules, policies. They recommend it to the National Board. National Board recommends it to the central government. Central government implements it. While implementing it, they are helping and assisting the state government to complete their responsibilities of MSME sector. So let's start with Advisory Committee. Advisory Committee is a combination of a set of four people. Starts with the Secretary of Government of India. The Secretary of Government of India will act as a chairman of the Advisory Committee. There would be not more than 5 people representing central government. Central government, people from central government who are having knowledge about these matters of MSME will be existing in the Advisory Committee but shall not be more than 5 members. Then not more than 3 members representing state government. Now there's a huge doubt for students out here. So which 3 state governments? Central government will decide it. On a regular basis, they'll rotate on a regular basis, but they will be, one second, so they will be rotating on a regular basis, but we'll segregate 3 of the state governments, any of the 3 state governments, and we'll get it represented from state government. Get the points clear? The Secretary of Government of India, not more than 5 persons representing central government, not more than 3 persons representing state government. Now we have representation from central government, state government done. We want representation from the MSME sector itself. Let them also come and speak about their problems directly to the Advisory Committee. Let them be a part of Advisory Committee. We want one representative of each of the sector of MSME. Micro, one representative. Small, one representative. Medium, one representative. One representative for each of the association of MSME. This Advisory Committee will give advices to whom? National Board. Now, what is National Board? National Board again is established by the central government. Obviously, if it is established by central government body, it has its head office in New Delhi. Regular concept, it has its head office at New Delhi, established by the central government. People here are appointed by the central government. Start with a set of people. This is also one of the important questions, because there are direct questions asked from this particular chapter, and this is one of those questions which can be easily asked as a 7 marks part. So National Boards consists of, first and foremost, the Minister of the MSME at the central government will act as a chairman. The Minister of the MSME at the state government will act as a vice chairperson. Who is chairperson? The Minister of the central government's Ministry of MSME. If the vice chairman is a minister of the state government's MSME. Then we have 3 members from the parliament. We have what you call as a governor for state government. We have somebody called as administrator for union territory. 3 members from the parliament, 3 members, 1 person from the administrator of the union territory, Secretary of Government of India. Remember, the Secretary of Government of India was a part of the Advisory Committee where he was acting as a chairperson. Here he is acting as one of the member. So whatever that has been discussed in Advisory Committee has been recommended to National Board, and National Board will discuss about matters. While they are discussing, this person, the Secretary of Government of India, is present in that meeting, expressing their opinion on the recommendation they have given. Very good move made by government here. Then we have set of bank summer. The chairperson or managing director of Small Industries Bank, the chairperson of Indian Association Bank, chairperson of the National Bank, one officer from the RBI. A set of bank categories. Do a little writing practice on this particular point. You have to remember them. Then 20 people representing MSME sector. How many? 20 people. So national board is not a part of 2-3 people. It's a huge set of people. A huge meeting will be conducted. 20 people. Out of this 20 people, not less than 3 people shall be representing women enterprises. Not less than 3 people shall be representing. Who needs more voice in the MSME sector? Micro. Small and medium are a little better worse than compared to micro. So we have given more importance to micro here. Out of the 20, not less than 3 must be representing women enterprises. Not less than 3 must be representing micro enterprises. Then 3 people having knowledge of the market, 2 people from the union. Knowledge of the market includes industry, economic, finance, science, technology, small scale industries, etc., etc., etc. Right, whatever comes to your mind. Chalo, repeat it again for me. I know it is difficult, but try to repeat it again. For the first 2 points are very easy for us. The minister of the central government's ministry will act as a chairperson. The minister of the state government will act as a vice chairperson. Then we have 3 people. Third point, 3 people coming from the parliament. We have the administrator of the union territory. Then we have 1 person coming from advisory committee, the secretary of government of India. Once these set of people are kept aside, we'll come to the bank category. We have the chairperson and managing director of different kind of banks: Small Industries Bank, National Bank, Indian Bank Association, and 1 officer from the RBI, Reserve Bank of India. Then you have 20 people who are representing MSME sector, out of which 3 must be, not less than 3 must be women enterprises, not less than 3 must be micro enterprises. Then coming to the last 2 categories, 3 people coming from the eminence, having eminent knowledge, having basic expert knowledge in the fields of small scale industries and finance, technology, science, etc. And the last 2 people from the trade unions. We have included a lot of people in this national board, which will meet once in every 3 months, and they'll take decisions on a basis of majority. Once in every 3 months they'll meet. Once they have met, they will have certain functions to complete as a board. Are we getting this point? Board has been established. Now the point is, what does this board do? Functions of the board. Before I start with these functions of board, I'll start with this this fund to be established. The central government has established multiple funds for the purpose of MSME, making sure that the right amount of allocation of budget is done to the MSME sector. We have established 1 or more funds. Established by whom? Central government. Grants are given by the central government. It is administered by the central government. Where to use it, how to use it will be decided by the central government. Central government is responsible to make sure that amount is properly dispersed and amount is properly given, utilized on timely basis. Timely utilization of money is also the responsibility. Administration is also the responsibility. Basically, everything is taken care by CG. Established by CG. Grants are given by CG. The administration is done by CG. The process of disseminating this money, utilizing this money on a timely basis is of the CG. But CG doesn't have enough knowledge or time to do so on their own. Then who will give recommendations on how to use it? The national board. Are we getting this point? National board will give recommendations to the MSM, the national, central government, on how to use this fund. That is one of the functions of national board. And once a fund has been established, this fund shall be used and utilized only for the purpose of MSME sector and not for any other purposes. Shall be used exclusively for MSME sector. The responsibility of coordinating and timely utilization is also CG. But what does the board do? The board will give recommendations on how to use the fund, advise the central government on usage of fund. Next 3 topics are very easy to remember. Logic is very simple. States that first I'll go verify, review the existing policy and programs of the central government. I'll review them. After reviewing, I'll understand the factors which are affecting the promotion or development of this MSME sector. The factors which I have gone through, the loopholes which I have understood. Based on the loopholes, I will give recommendations to the central government on new policies or making of any modifications in the existing policies. 3 categories. Review the existing policies and programs. Once reviewed, you understood the problems, the factors which are affecting the promotion or the development of MSME sector. Once you've understood the problem, start creating recommendations to the central government to modify or otherwise create new policies in the market. Recommendations to central government and advise the central government on the use of the fund. A very important concept. MSME registration topic, you can get registered as MSME with your state government category. Once you have registered, you will get benefits of MSME sector. You can make application to the authority. Once you, the state authority is basically state government here. Once you have made application authority, the authority will go through the documents, come verify everything. If satisfied, they'll give you the registration of MSME. That's fine. You go through this outdated topic. I'm not going to spend much time on it. Probably another 15 minutes or so, we should be able to complete the chapter. We are mostly done. We just have the schemes which are introduced by central government. Facilitation council and the facilitation centers established by state government. Quick answers. What happens here? The MSME sector is not having enough amount of resources, enough amount of time or enough amount of people to run around the court procedures and disputes for a number of years. To make sure that the disputes of MSME sector between two MSMEs or a buyer and an MSME is being solved in a quick manner, we have set up something called as facilitation councils or facilitation centers. These facilitation centers will deal with the disputes regarding the MSME sector. Once a dispute has been referred to the facilitation council, if they have enough amount of time, if they are free enough, they'll deal with the case themselves. If they're not having enough resources or time to deal with on themselves, they can refer it to a conciliation and alternative dispute resolution process, an arbitration or conciliation. And this arbitration conciliation will sit both the parties, discuss matters and come to a compromise, come to a resolving of the dispute, and the resolving of dispute shall be done by conciliation. If it is referred to the conciliation and the conciliation does not resolve the dispute, it comes back to the council and the council has to deal it on their own. But this entire process has to be completed. If it takes number of years, doesn't make any difference. It should be completed within 90 days from the date on which it is referred to the parties. So first option, we have set up facilitation councils. They'll seek all the disputes regarding MSME sector. They can conduct the facilitation either by itself or they can refer it to a conciliation. This conciliation, if they have resolved the disputes, that's fine. If the resolve is not successful, it will refer it back to the council and the council has to take up the dispute of arbitration on their own. But end of the day, it should be completed within how many days? 90 days. Now, who will establish these councils? State government will establish councils at the local level. And how many councils? Depends on the state government, one or more depending upon the requirement. They'll set up this MSME facilitation councils or facilitation centers as we call, where there will be not less than 3 people but not more than 5 people sitting in this council. This is important. This is slightly different from your regular concept. Not less than 3, not more than 5 among the following categories. We are not asking all of them to be applicable. We are asking you have been given a platter of people, appoint at least 3 of them or appoint at maximum of 5 of them. First, the director of industries. The second, the one officer who is representing micro or small industries or enterprises at the state level. This is not third point. Cross it off. And one person representing banks or financial institutions. Usually that's where you have disputes regarding repayment of loans or advances you have taken as an MSME sector, or one person representing having knowledge of the field, same topic. Whatever comes to your mind, write it. The director of industries, one person representing each of the associations of MSME, one person representing banks or financial institutions, one person having knowledge, eminent knowledge of finance law, etc., etc. These not less than 3, not more than 5 will form part of the facilitation council. I'll come to this payment part in a bit, any which ways we'll discuss in the process. And this is one of the benefits of your MSME chapter. Question changes. Measures for promoting and development of enhancement of competitiveness of MSME. Answer remains the same. The first 10 points we have learned regarding the schemes of MSME. They will provide credit facility, they'll provide infrastructure facility, they'll provide technological upgradation, they'll provide skill development, they'll provide management issue, they'll provide grants from central government and promote MSME sector. Everything is repeated, so you can learn one question but you'll have 2 words. One shot, not 2 words, 3 words. Next answer also has the same topic. Various schemes of central government, you can write the same answer. The credit facility, infrastructure facility, technological upgradation, entrepreneurship development, that is basically your management issue and skill upgradation. They'll have quality certifications and testing facility, access to modern management practices, management issue, They'll have design, inventory and packing, development and support, assistance for better access to domestic and export markets. Couple of points extra, but 99% they are same. So you can go through the same question, sorry, same answer for 3 different questions here. Now comes the actual point of this chapter: schemes of MSME. Schemes of central government that have been introduced in the recent times for MSME. This is important for exam, Mama. Why? Because chapter is very small. Chapter has a weightage of 7 marks, and ICMA doesn't want to repeat questions on every attempt basis. We hardly have 3 to 4 questions, and ICMA doesn't want to repeat it, so they can create new questions out of these schemes. I have given an extensive details of these schemes, not a just introduction. Extensive details of the schemes will be there. Sit down for another 7-8 minutes, we should be done with all the schemes here. Very easy to understand, very easy to remember also, but you have to make efforts to do a little writing practice and understand the technical words proper here. So start with the first category. If you want to get any benefits of MSME sector, you have to get yourself registered. Now, to be registered, we don't have multiple offices you have to go through. We have a single point registration. The single point registration is again made online, making it easy for you to get registered at your house itself by a process called as Champions Control Room. Go through the internet, type in the Champion Control Room, you will get to the website of MSME, champions.msme. Basically, this allows you to register as an MSME without going to the office. But if you have any doubts, if you have any queries, if you want to have any support, you can also go to the district industry centers. The name itself gives the topic. At district level, we have set up centers for you to understand it in a better manner. It is similar to the MeSevas. The physical center setup, which will be having government officials and people who will be ready to help you and support you to understand MSME schemes and sectors and to get registered. So this Champions Control Room and the District Industry Center will work together to help you to provide a single point registration. A single point registration is available under MSME now. Now, once you have been registered, the second point, they are unrelated to each other. Revival and rehabilitation of MSME. If MSME is not able to repay their loans, the revival process of MSME starts with the banks itself. The banks and the financial institutions who have given loans to the MSME sector will have to revive the repayment schedule, giving them more time, reducing the interest rate, waiving off the interest rate, or sometimes waiving off a part of the principal amount. Revive and try to rehabilitate the MSME. The government will support you at the back end. So the banks who have provided loans to MSME shall revive it by rescheduling the repayment plan. They have to provide them suggestions on corrective actions that can be taken to revive and rehabilitate the MSME sectors. They have to look into each of the MSME to which they have given loan and try to understand that MSME and provide the revival plan for such MSME. Similar to CIRP process, but a MSME sector at a smaller scale, banks will do it. Now, second category, delay in payment. This is one of the important concepts and one of the beautiful concepts drafted for MSME sector. If there is a delay in payment of MSME sector depends upon the operating cycle. They don't have huge amount of backup. If I produce a good today, I have to sell it, I have to recover money out of it. That recovered money will be used to reinvest into my business. So until I am able to recover money, I will not be able to continue business. So recovery of such money on a timely basis, not on just recovery on a timely basis is very much important for MSME sector. For that recovery, government has established something called as MSME Samadhan. MSME Samadhan is a portal, an online portal where the MSME unit can register if there is any delay of payment from the buyer. If any buyer has not made any payments to the MSME sector, the MSME sector can apply for it, complaint about it on the MSME Samadhan, where we'll have complaints raised against a buyer for delay in payment beyond the allowed time. Obviously, we'll give an allowed time after which we will raise a complaint. Now, there might be situations where who are these buyers? Public sector, government, state government, central government, PSUs. These are the entities which give a little bit of priority, not to large entities, but little bit of reservation or priority to MSME. And if they don't release payment on time, you're creating rules and regulations stating that payment should be done on time and the government itself doesn't do it on time. If the government itself doesn't do it on time, you can again raise your complaint on the MSME Samadhan and it will also be referred to the concerned ministry. The concerned ministry, they'll have a separate dashboard for how much amount is spending from which particular sector, MSME or central ministries or state government, how much amount is spending from each of the category will be in a dashboard clearly observed. Now, if this dashboard is clearly mentioning the amount which is pending from this government sector, CEO of the PSU, Ministry of the central government, or the Minister of the state government can actually look into it and take a proactive action. They can take proactive action and start making sure the amount is actually paid. If there is still dispute regarding this payment, the Facilitation Council is any which way available to solve their disputes as such, to make sure that this amount is, the secretaries or the CEOs or the ministers will be able to take a proactive action. They should know how much amount is pending. If the amount is still pending for, if it is a company, not for government sector, if the buyer is a company, they have to prepare a report, a half yearly report, and submit it on the MCA website. On a half yearly basis, they'll prepare a report and submit on the MSME sector, on the MCA, on how much amount of money they have pending from pending to an MSME sector, which is overdue for more than 45 days. The logic is here, you have to pay within 45 days. If you are failing to pay within 45 days, you have to prepare a report on it on a half yearly basis and post it on the MCA website. And on top of it, not only posting on MCA website, you'll be charged with interest. This is also important. Interest will be charged at the rate 3 times the RBI rate. If RBI rate is say 6%, 7%, say 7% will charge 21% interest. And this 21%, the better part again is for benefits of MSME. This is calculated on a monthly rest. It is compounding on a monthly basis. Monthly compounding will happen with 21% of interest per annum. A huge amount of benefit for MSME. They'll get a huge amount of interest back in the point. Now we have done this fund already, Amma. I'll go through a little quick on this part. We have already established, CGS established the fund. The fund is exclusively used only for MSME sector, and this fund is used for the purpose of development, promoting, enhancing the competitiveness of MSME sector. Facilitation centers, we've already done this. Who establishes it? State government at the district levels. One or more will be established, not less than 3, not more than 5, which will be dealing with all the disputes regarding the MSME sector. Disputes between MSME and other parties will be solved by this facilitation center established by the state government, not central government. NSIC, this is something which is a very old concept, a very old PSU, National Small Industries Corporation Limited. It was established for small industries. Now it is working under Ministry of MSME. This is now under the Ministry of MSME. Now what does this do? Basically, this provides a promotion or help or foster, helping the growth of MSME sector in India. They provide a lot of benefits. Whatever schemes you have learned, technological upgradation, credit facilities, or the infrastructure facilities, or the cluster developments, whatever you have learned, marketing activities, credit rating, acquisition, technological upgradation, raw material procurement, preservations, all these points have been done by NSIC. What is NSIC? National Small Industries Corporation Limited, which is now working under the Ministry of MSME. These are just the widespread activities of NSIC. They have a total of 9 zonal offices. Remember this, Amma? Don't have to stress much upon it. Try to read it once and leave it off. You don't have to remember all this. 39 branch offices, 12 sub offices, 5 technical service centers, 3 technical service extension centers, 2 software technological parks, 23 NSI business developments, and 1 foreign office. Basically, they are stating that we are widespread. We are having widespread. We will be providing a lot of benefits to the small industries at the ground level. Digital MSME is one thing where it has been important now. What happened because of the digital market we are living in? We are not gonna maintain our books, or we are not gonna maintain our documents in a physical format anymore. Making sure that MSME sector has the training or the awareness or the literacy of this softwares which are available, which is being now linked to information and communication technology, to make sure that MSME sector has training to it. They have introduced something called as digital MSME scheme, in which they'll provide training regarding, they'll provide access regarding, they'll provide a concessional rate of software, they'll provide literacy regarding these programs about accounting, compliances, GST compliances, the ERP softwares, how to manage the business activities, design and manufacturing procedures. They'll support everything through a digital format with the help of information and communication technology being inculcated or integrated into MSME sector. They'll provide you training, they'll provide you literacy, they'll provide you support, they'll provide you awareness, they'll provide you basic digital marketing process also. This is one of the benefits in the modern language for our MSME sectors. Emergency Credit Line Guarantee Scheme. This was introduced during COVID-19, where the government stated that banks and NBFCs, you guys provide loans to MSME sectors. Other industries, large industries could sustain themselves. But MSME sector, because not having much sales during COVID-19, I don't want them to be shut down. I want them to continue and sustain their business, for which they require loans. Give them loans. Give them loans, I'll give you 100% guarantee on those loans. Banks and NBFCs have given loans to the small sector during COVID-19 crisis, where they have been guaranteed by 100% coverage by the central government. The government provided 100% coverage, but two conditions have to be satisfied. Loan shall not be for a period of more than 4 years, because it was for COVID-19, not more than 4 years, and the interest rate charged by a bank shall not exceed 9.25%. MCQ can be possible, and charged by NBFC shall not exceed 14%. Now, if you remember the COVID-19 crisis, during COVID-19, the interest rates were very, very high. Inflation was at the peaks in India. So 9.25% 14% was actually a lot beneficial for this MSME sector. And another benefit here, once you have taken loan, the loan tenure shall not exceed how many? 4 years. But the repayment will start, the principal repayment will start from the second year. The first year is given as a moratorium period. You have learned this word, moratorium. The repayment of principal amount will be suspended in the first 1 year. They will be repaying only from the second year. Moratorium period for 1 year. A very good concept again. They have a period of 1 year where they don't have to, 12 months, 1 year where they don't have to make any repayment of principal amount. I hope this is clear. You have to learn a couple of things. 100% guarantee, banks and NBFCs, 9.25% for banks, 14% for NBFCs, shall not exceed 4 years, but repayment will start only after expiry of 1 year. SIDBI, Sikh Industries Development Bank of India. The word itself gives you the topic. Industrial Development Bank of India. They'll develop industries for which they'll provide you loans at a concessional rates, especially to MSME, in a faster manner, without much of formalities, without much of documentations and inquiry, etc. They'll provide you in a faster manner for availability of loans, and this is a little higher than the emergency credit scheme, which will be provided up to 10 crores up to 10 years, where there will be including moratorium period, depends upon the industry, not exceeding 10 crores, not exceeding uh, 10 years. This is again a scheme which is established for the purpose of employment generation. Prime Minister Employment Generation Program. I'll provide you facility, I'll provide you infrastructure, I'll provide you benefits, I'll provide you credit. You just create employment for India. That's enough for us. Then procurement and preference policy and reservation policy are both same, one and the same amount. Basically, what happened? The MSME sector has been preserved, or should I say, reserved for certain sectors. There are certain sectors such as handloom, handicraft, agriculture tools. These are certain examples of sectors which have been reserved only for MSME. No large business can indulge into it, creating more competitiveness for MSME sector, making sure that MSME sectors indulge in consumer products where large number of MSMEs will get benefit out of it. This reservation is for two reasons. What are two reasons? Will create higher production of consumers at the small scale sector and create lot of employment opportunities. Not large industries doing with machinery, small industries doing with human resource. Employment will be created. Both of them are similar and go hand in hand. Then licensing point, simple topic. If as an MSME sector you want a food license or any other license from any authority, while making application for such license or approvals, attach your MSME registration and submit it. They'll complete your process on a priority basis. They'll keep you on the priority list while they are dealing with these licenses. So what should happen? Your certificate of MSME registration shall be applied along with the application. Then they'll give you a priority in the process and make it simplified for you to make sure that licenses are applied and obtained in a easier manner. Training, basically skill development program, mama. We have something called as National Institute of Entrepreneurship and Skill Development, Skill Business Development, where it has been established for the basic need of generating training for the people to understand the modern development. Just go to the skill category, it should be enough. They provide training to the trainers, management development programs, entrepreneurship and skill development programs. This is all basically kind of a webinar or kind of webinar which are conducted to make sure that the management has updated information regarding the market. That's your entire chapter with extensive discussion. 45 minutes it has taken us, but I hope this will be very clear for MSME. One 7 marks question will come and MCQs will also come for it. That's the end of this MSME chapter. So let's start with the next chapter, PMLA, one of the most interesting as well as one of the most scoring chapter. You know, this PMLA chapter has a weightage of 5% as per your ICMA syllabus, but usually it is being asked for 7 marks. Rarely it is also been asked for 4 marks, but usually it is been asked for 7 marks. Now you guys decide. Either you have to study entire SEBI, entire IBC and get one 7 marks question, or study the small little chapter PMLA or the small little chapter MSME for the weightage of same 7 marks. So I hope you guys understood the importance of this particular chapter. Let's dive into this. What's the chapter's name? What's the act's name? Prevention of Money Laundering Act 2002. So let's understand this word first and foremost. Prevention is fine. You have to stop something. Act is fine. This is a central act. It is applicable to whole of India. Now the keywords we have to understand is money laundering. What is money laundering? What is laundering to begin with? Laundering is nothing but cleaning something. Cleaning something which is got dirty, we clean it by a concept called as laundry. Now, what do you mean by money laundering, sir? I know there are students watching this video shouting, sir, we'll put this money in a washing machine, we'll wash it, but tomorrow morning it will be clean. Money laundering. Money laundering is not a literal word, it is a metaphor stating that we'll clean the dirty money. Sir, what do you mean by dirty money here? Any amount of money which is received from illegal sources. If you have conducted illegal activities, you have conducted any criminal activities, the money which is received from that illegal sources is technically called as proceeds of crime. This proceeds of crime is considered as dirty money. It has different names somehow. Dirty money. It is called as black money. It is called as tainted money. It is called as illegitimate money. This money has to be converted and cleaned. After being cleaned, this dirty money is now cleaned and now called as legitimate money. It is coming from. It is called as white money. It is called as untainted money. It is called as legitimate purposes. Now, the conversion process is called as money laundering. Lot of students get this wrong at the beginning stage itself. Money laundering is not considered about offense criminal activity you have done. Say assuming you have sold drugs. Don't do it. Just an example. You have sold drugs. Selling drugs is legal or illegal? Selling drugs is illegal. Selling drugs is illegal. The money which you have received from that selling of drugs illegal is now called as black money. If this black money is trying to be converted into white money, or if I want to use the technical words, this is called as tainted money, and you are trying to convert this tainted money into untainted money, then it is called as money laundering. Now, sir, get me a little more clarity on this. You have sold drugs, will PMLA apply? Absolutely no. PMLA will apply only when you are trying to convert that proceeds of crime. You have done a criminal activity, there are other acts which will take care of that criminal activity. Once a criminal activity has been conducted, the proceeds of such criminal activity called as proceeds of crime. If this proceeds of crime has been tried to be projected, claimed as untainted money, showing it as white money, then we'll apply the topic of PMLA. So I hope this is clear. Money laundering process applies only when you're trying to convert that black money, convert that dirty money into clean money, convert that black money into white money. That process of conversion is called as money laundering. Now, there are 90% of the cases, 90% of criminal activities are done for one thing, money. Why do we do criminal activities? I mean, we'll not do it, but just for concept. Why do people conduct criminal activities? Just for money. They're not doing it just for the namesake. They're not getting some kind of satisfaction to do so, unless you're a serial killer. Unless you're a serial killer, you are doing criminal activities for what? End of the day, money. And can you use this money directly in the market? No. If, say, assuming you are in your articles period, you have your stipend of rupees, say 10,000 per month, a huge amount of money. Our principal is giving us knowledge and paying in return how much? 10,000 rupees per month. Now, this 10,000 rupees per month is being deposited in your bank account, and all of a sudden you have, after the office hours, you sold some drugs. And from the drugs, you have received an amount of 10 CR and you deposited into your bank account. Now, this 10 crores of money deposited in the bank account will not actually have any reasonable connection with your bank account. It is not rational in nature. It is not reasonable in nature. It is unjustifiable. The enforcement directorate come knock your door tomorrow morning. Give me the reason where this money came from. Give me the sources where this money came from. And you cannot say that I have sold drugs, sir. So illegal money cannot be directly implemented in the market. I cannot use it directly. How it happens starts with the process of money laundering. Let's understand the process, then we'll go into the objectives later part. first process, the first stage of the process is called as placement. What happens in this placement? The money which is received from criminal activities, the proceeds of crime, will be introduced into the financial system. How would I introduce that? If I introduce that entire 10 crores into my bank account immediately, I'll get caught. Then what will I do is, I'll divide those 10 crores of money into small parts, small, less conspicuous parts which are not worthy enough for the enforcement director to look into. I'll divide them into small parts, and I'll not introduce into my bank account alone. I'll get it introduced into multiple accounts, various accounts through various individuals through the financial system. Now, what is basically placement? Where the laundered money is introduced into the financial system, where it is divided into small, less conspicuous amounts, where it is introduced into one account or multiple accounts. Different accounts has different locations. Once it is introduced in the financial systems, after it is being introduced, the next stage starts. The next stage, where I will try to make sure that I'll enter into hundreds and hundreds of transactions, different countries, different accounts, different persons, maybe different procedures. Different bogus transactions will be created. While these transactions are created, are you understanding it? I layer the transactions over and over again. When, if at all, enforcement directorate has a doubt tomorrow, even though they trace back, they'll not be able to trace back the origin from where it started. Now it is been hidden. The origin of the proceeds of crime have been hidden. If it is hidden, now they cannot prove that it is laundered money. They cannot prove it is from illegal sources. That means it is indirectly now converted into legal sources. I am hiding the origin of it. I am making sure that it is it is inseparably mixed into the legitimate money. I cannot separate what is black and what is white. It is mixed into the legitimate purposes. Once it is mixed, now it is, indirectly speaking, converted into white money. But now I have to use it, because remember, this was in different accounts and different persons. Now I will integrate everything. I'll pool everything into my account slowly. Once I got this money, once I've integrated it, I'll use it for luxury categories. The legitimate money will be used for what purposes? Legal purposes. From here on, I'll invest into real estate, I'll invest into ventures, I'll invest into luxury assets, I'll purchase watches, cars, buildings, lands, etc. From what money, Amma? Legitimate money. Now it has been inseparably mixed. Inseparably mixed with what money? Legitimate money. Now the criminal source has been, the origin has been completely hidden. I'm converting it continuously over numerous accounts. So are you guys understanding this? Can I skip placement and start layering directly? Can I skip layering and placement and integration can be done? No. Money laundering is a single process having 3 stages. It's a single process where we have to go through all the process, but it will be staged format, where the first stage is called as placement, second stage is called as layering, third stage is called as integration. All 3 stages combined together, we have one process. So what should we do as a money laundering act? We should promote it or prevent it. We should prevent money laundering. The prevention of money laundering is my ultimate objective. I will prevent and I'll control money laundering in India. That's my first objective. But if you guys observe it carefully, the prevention of money laundering is possible only at the stage of placement. Once it is placed in the financial system, once it is going through layering process, I'll not be able to find the true origin. I'll not be able to find the exact place from where the proceeds of crime has initiated. It is inseparably mixed. Once it is mixed, I cannot bifurcate whether it is black or white money. I'll not be able to prevent it. So prevention is possible only at the stage of placement. If prevention was not possible and I some or the other way found out that there was money laundering after placement stage, in layering or integration, I'll not sit silently and say, well done, you have done a great job money laundering. No, I'm gonna confiscate, I'm seizing that property into the government's authority. Such property which is acquired from the proceeds of crime, acquired from the laundered money, will be seized, a technical word, confiscated, in the name of the central government. It will belong to the central government. It will conduct investigations and will know it was wrong. Will collect it back. So the second objective of PMLA, to confiscate and seize property obtained from laundered money. Are you getting these 2 points, Amma? 3 objectives are there. One objective is to prevent and control money laundering in India. Second is, you have to confiscate or seize the property which is obtained from doing what? Laundered money. Third case, to do such other activities which are in connection with money laundering in India. Sorry. So how many objectives? 3. Prevent money laundering, confiscate the property obtained from money laundering, or deal with any other issue which is in connection with money laundering in India. 3 objectives of money laundering. Now money laundering process is fine, money laundering objectives are fine. What is exactly money laundering? Definition is important, ma'am. Why is it important? Because the chapter is not actually, to be honest, worthy of 7 marks questions. There's no particular question which is worthy to be asked for 7 marks as such. So to make sure that our answer is able to pop out, answer is able to highlight with other answers of other students, will better write the introduction of money laundering. So this definition which we're going to learn here will make sure that your introduction is done properly, then you'll jump to the real answer, which will make sure that quantity is increased and also show the examiner that you have proper knowledge of money laundering process. So definition will be very, very important. This is given under section number 3, section 3 of the PMLA Act states that, just go through the definition. Whosoever, I don't care who you are, let it be a businessman, let it be an individual, let it be a company, let it be a politician, let it be any normal individual, let it be an employee, whosoever you might be, I don't care. I don't care. If you're doing money laundering, I'll punish you. Whosoever, either directly or indirectly, you're indulged in the process of money laundering directly or otherwise. I'll give you the entire definition once. I'll come back explain. Just listen. Whosoever directly or indirectly attempts to indulge or knowingly assist or knowingly a party or is actually involved in any process or activity connected with proceeds of crime, including its acquisition, including its possession, including its use, including its concealment, or portraying or projecting or claiming as untainted property, shall be guilty of offense of money laundering. I know it's a very big definition, but it has a lot of sense to it. It will be easy if you understand the logics behind it. Whosoever, I don't care. Directly or indirectly, I don't care. Attempts to indulge. You have not done money laundering, but you have tried to done it. There's a chance that you might repeat in the future. I'll punish you today itself. Attempts to indulge. Or is knowingly assisting, helping a person to do money laundering. Or knowingly a party is a group of the people who are collectively doing money laundering. What are the categories, Amma? Whosoever, directly or indirectly, knowingly, attempts to indulge or knowingly assists or knowingly is a party or actually is involved. Involved in what? Any process or activity in connection to proceeds of crime. Sir, but we have just discussed having proceeds of crime is not money laundering. Continue that. Having proceeds of crime, including its acquisition, possession, use, or concealment. What are the 4 words, Amma? Acquisition, possession, use, or concealment. Or projecting or claiming. Now I'm claiming it as what? I'm showing it as what? Untainted property. Then comes money laundering. Then you are guilty of offense of money laundering. I'll take slow, try to understand the definition again. Whosoever, directly or indirectly, attempts to indulge or knowingly assists or knowingly is a party or is actually involved in any process or activity in connection with proceeds of crime, including its acquisition, possession, use, or concealment, or projecting or claiming it as untainted property, shall be guilty of offense of money laundering. If you're not comfortable, sit down, watch this part again, or otherwise do a little writing practice, get comfortable, then continue to watch this video. Then, what is this topic? Proceeds of crime. There's a little extension to this. What do you mean by proceeds of crime? You should have done any kind of criminal activity. Those criminal activities which are mentioned under schedule of the PML Act. There's only one schedule. We call it as scheduled offences. We have divided the scheduled offences into 3 parts. You can go to the website of PMLA and watch this. There are 3 schedules. Each of the schedule has its own priorities here. The schedule A, There's one schedule and which is divided into 3 parts. Part A, Part B, Part C. Part A has total of 29 different acts. Each of the act has clearly mentioned which sections will attract the provisions of PMLA. And 29 acts have been divided into each paragraph and we call them as 29 paragraphs. Out of the 29 paragraphs, I want you guys to remember para 2. Para 2 is talking about Narcotic Drugs and Psychotropic Substances Act 1985. What is that act called as? Narcotic Drugs and Psychotropic Substances Act. If you are made offensive criminal activities done as per para 2, you will have a special treatment for it. Then part B talks about those offenses which are having a value of 1 crore or more, or part C talks about those category of transactions which are called as cross-border offenses or trans-border crimes. What do you mean by that, sir? Criminal activity happened in one country and this criminal activity done in one country, money laundering will be done in another country. Then it will be difficult to find because there should be coordination between 2 authorities of different countries to tackle money laundering. For that, we have part C. Cross-border crimes are also called as trans-border crimes. So, without this scheduled offense, there won't be anything called as proceeds of crime. Without proceeds of crime, there is nothing called as tainted money. There is nothing called as dirty black money. If there's no black money, there's no concept of money laundering. So the entire process of money laundering revolves under the topic that starts under the topic that it should be what kind of offense? Scheduled offense. That's the reason it is also called as predicate offense, precondition for the money laundering to start. It is called as what? Predicate offense. Scheduled offense. Every scheduled offense is a predicate offense. If you are liable under section number 3, you are punishable under section number 4. Section number 4 gives penalty, quick answers. If you fall under para 2 part A of scheduled offense, that is narcotic drugs and psychotropic substances, you will be imposed with fine of any amount and imprisonment of minimum 3 years to maximum of 10 years special treatment. If you are anything other than para 2, then your entire process remains the same, but maximum imprisonment rather than 10 years will be 7 years. Minimum 3, maximum 7, fine of any amount. Here minimum 3, maximum 10, fine of any amount. I hope the introduction is all clear. Now let's jump into the category of situations where we'll try to prevent money laundering. This is something where they have two authorities. Some quick answers on this. We have one authority called as ED, one authority called as FIU India. I don't want to spend much time into this, just I'll give a briefing of the process. What happens? Prevention of money laundering, as we have discussed, is possible only at the stage of placement. Placement is a process where we are introducing money into the financial system. Introducing money into financial system happens to obviously your answer is correct, it happens through a bank. But not only bank, can I say it can happen through a financial institution, it can happen through a stock exchange. So to make sure that everybody is covered, we don't use the word bank, we use the word reporting entity, which includes bank plus the financial institutions plus intermediaries or any other person who is carrying on designated trade or profession as provided by central government, making sure that everybody through whom a black money can be introduced into financial system has been covered in the process. They are all called as what? Reporting entities, because they're having an obligation to report this information to the authorities. They're called as what? Reporting entities. So how the flow works, sir? If reporting entities have any suspicious on a transaction, they'll prepare something called as STR, suspicious transaction report. And this suspicious transaction report, assuming they say they'll prepare the suspicious transaction report, and the suspicious transaction report will be forwarded to the, no, you got it wrong, it is not ED, they'll forward it to the FIU India. What is FIU India? Financial Intelligence Unit India, which is a part of Ministry of Finance, Department of Revenue. This FIU India is headed by a person called as a director. I hope the voice is clear. Headed by a person called as a director, and this director is not less than the rank of Joint Secretary of Government of India. This person is responsible for a couple of activities. He will be responsible for receiving information, collecting information, processing the information, analyzing the information. If he finds anything wrong, he will disseminate it, provide information to the ED to take an action. So are you getting my point? It starts from whom? Reporting entity. Reporting entity giving information to FIU India. FIU India, after doing their processing and an analysis, they'll give information to the ED. ED will take action for investigation, etc. So FIU India plays a huge role in the process to make sure that money laundering is prevented. If not prevented, once it is done, it has to be confiscated. Will be the process started from reporting entity to FIU, FIU to director, enforcement directorate. This FIU India also has an obligation to coordinate. We have just discussed it. Part C, cross-border, trans-border crimes. When it is involving multiple countries, multiple authorities, the coordination between multiple countries is very much needed to tackle money laundering. That is possible only through FIU India. FIU India is responsible to coordinate and communicate with other authorities at the national as well as international level to make sure that the smooth flowing of investigation, prosecution, confiscation is done without any hassle. And end of the day, FIU India is a part of, is gonna report directly to something called as Economic Intelligence Council, which is directly headed by our finance minister. Our beloved finance minister will be heading this council called as Economic Intelligence Council, which will be reported by the FIU India. FIU India will report to the EIC. That's the introduction of FIU. Enforcement Directorate, you know, this is a person who is going to take action for the purpose of money laundering, as well as FEMA. FEMA in this has both one category, Enforcement Directorate. Again, this person is also a part of Ministry of Finance, Department of Revenue. Just go through them quickly, it should be sufficient for us. Jumping to the reporting entity logic, we have to be a little quick from here. Reporting entity comes under section number 12. We call this as obligations of reporting entity. Reporting entities have certain obligations to report matters about the transactions happening in the financial system to the FIO India, the director FIO India. So what's happening here? We as a reporting entity have two obligations. Remember, what is reporting entity? It includes banks, financial institutions, intermediaries, or any other person who is carrying on working with designated trade or profession as mentioned notified by the central government. Now, what happened? These set of people will be carrying on. They will be connected with the financial system. If they have any suspicious transaction, they have to report it. They have a couple of obligations. Just understand this. It should be very easy from here. There are two obligations. One obligation to maintain transactions. One obligation to maintain my client details. One, I'll maintain the transaction. Second, I'll maintain the details of the client. Client verification must be done. The client or beneficial owner's identification must be done. So what are the two categories? One is transaction. I have to maintain which transaction? The sentence starts with the word, the reporting entity shall maintain the records of all transactions. Is it practically possible for me to maintain all transactions? Then they have mentioned that all transactions as may be prescribed. All transactions as may be prescribed in such a manner that individual transaction can be reconstructed in the future. If, for example, there are 5 transactions and having a total value of 1 crore, I should clearly know how many transactions are there, which transaction was entered with which person, was entered for how much amount, was entered at what point of time, was entered with what reasons, so that I'll have a clear picture on which transaction may be money laundering and which transaction is actually genuine category. If they combine everything and say 5 transaction 1 crore sir, 5 transaction 10 crores sir, I'll not be able to do analysis correctly, I'll not be able to do the investigation correctly. Hence, every transaction which is required to be maintained must be maintained in such a format that they will be able to reconstruct individual transaction. And this transaction information must be maintained for a period of 5 years. 5 years from the date of transaction. Once it is maintained, whenever the FIU director comes and asks for it, give this information in such period as may be notified. What are the 3 points you would remember, Amma? They have to maintain records of all transactions as may be prescribed in order to reconstruct individual transaction. They have to maintain it for how many years? 5 years from the date of such transaction. And whenever asked of the director, we have to furnish such information to them in such time as may be prescribed. Done with the transactions. But before entering into transaction, I have to make sure that the client which I am accepting is properly verified with. Identity of client has to be checked. Identity of client as well as is beneficial owner if the beneficial owner is existing. I have to identify them. And what do you mean by identification? Collect their Aadhaar card, collect their PAN card, collect their photograph, collect their signatures, collect their maybe passport, collect the identity of the client. Once identity has been collected, I have to maintain them for a period of 5 years from the date of collection. 5 years from the date of collection? No. That means after 5 years, I'll forget who the client is. I have to maintain it for 5 years till the conclusion of the business activities with the client and reporting entities, or the closure of account, whichever is later, wiser. There are a lot of circumstances where the account is not existing, but the business transactions are being continued. Hence, I still have to continue to maintain it until what point of time the relation between the business relationship between the client and the reporting entity has ended, or the account opened in the reporting entity has been closed, whichever is later. I want to maintain it as far as possible, so whichever is later. But as we were discussing, we don't have to maintain all transactions. We have to maintain all such transactions as may be prescribed. They're prescribed in the rules. These are a part of rules. These are given in the rules. I hope the color is clear. This might be better. Rules. So they have given 5 categories. I'll explain why 5 categories at the end of the process. Listen carefully. If any cash transaction, what transaction? Cash transaction is of an amount 10 lakhs, more than 10 lakhs, or cash transaction in foreign currency which is having equivalent value of more than 10 lakhs. Say assuming they have deposited $20,000. 20,000 is not meeting the limit, but $20,000 is equivalent to more than 10 lakhs rupees. I'll report that also. I'll have to maintain what? Cash transactions of more than 10 lakhs or the equivalent value of that in foreign currency, or any transaction which is, now knowing this fact that 10 lakhs is a trigger point, people will not actually deposit 10 lakhs. What will happen? I'll deposit cash transaction of 9.9 lakhs. Tomorrow morning, I'll go back and deposit 20,000. Sir, I have bluffed the companies. I've bluffed the PMLA Act, I've bluffed the Enforcement Directorate, I've bluffed the entire government. If you think you are bluffing the government is going to be a bigger bluffer. They will bluff you. They stated that all series of transactions combined together, even though their value is less than 10 lakhs, we still have to maintain it. If we believe that there are a series of integrated combined transactions, we still have to maintain it. A series of integrated transactions which are having a value of less than 10 lakhs per month still has to be maintained. Then any amount of money received, any receipts of 10 lakhs or more or equivalent foreign currency. Then point number 4, you have deposited just rupees 20,000. Just 20,000, it is not integrated with anything. Is this required to be maintained? No, unless this 20,000 cash you have deposited is containing counterfeit currency. What do you mean by counterfeit currency? Fake currency. If it is containing fake currency and it is regular in nature, there's a chance that you're actually printing currency. You purchased a printer, started printing currency, or started depositing in your bank account. Small amount, but you are using counterfeit, fake currency. Then it will also be maintained by the reporting entities. Last and the most important. Now observe this. If the PML Act clearly mentions what will be reported, what will be maintained, people will read the law, people will understand the law, and people will try to make sure that none of their transactions are meeting those limits. So they've also added a vague but very powerful point number 5, stating that any transaction which is suspicious in nature will have to be mentioned. Any transaction which is what? Suspicious in nature, the suspicious transaction, whether it may be cash, other than cash, it may be deposit, it may be receipt, it may be cash, it may be check, electronic transfer, doesn't matter. If I believe that it is suspicious, I'll maintain it. Sir, what do you mean by suspicious? We will not disclose it to you. If I disclose it to you, everybody will know what we are looking for. Everybody will try to bluff the procedures of PMLA, bluff the procedures of Enforcement Directorate. I'm not going to disclose it. I'll keep it vague. Intentionally, intelligently kept vague. Any suspicious transaction will be reported. Now you can strike off these points if you are having this material. Those points have been summed up here in a better manner. We have to maintain the records on a uniform basis in a prescribed format. They'll mention a format in which you'll have to maintain the format given by them. Once maintained it, there are certain documents which you have to retain, collect in any manner you want, but retain them in a hard copy format only. Once you have retained it, whenever information is required, if it is identity of client, go file it within 10 days. 10 days of collecting that information, file it electronically in the KYC, Central KYC Records Registry. Nothing but a central database maintained to make sure that every information is collected at one place, analyzed, processed in one place, disseminated at one place, which makes it easy for us to supervise everything. RBI, they have power to get information from central KYC whenever they want. Then, about the transactions, we have to maintain all the specified transactions, Once these specified transactions have been maintained, report it to the FIU India director within 15th, at last by 15th of the succeeding month. If say it happened in the month of November, we have to report it on or before 15th of December. That's the basic introduction. Digital KYC is very easy. We are already 28 minutes into the video. It's getting a little late. I'll jump into the process of adjudication. You guys go through this point. This is very easy to understand. So continuing with the adjudication process, we have 3 stages of logic which we have to learn. First, what will happen? It will be provisionally attached. It will make sense in a 5 minutes of time if everything is completed. First, we'll provisionally attach it. Then we'll attach it. Then we'll go for the process of confiscation of property. So how does the process start? The process starts with a person called as a director. If the director or any of his office members, we have a hierarchy called as director, joint director, additional director, deputy director. A director himself, but if at all he is busy, he may delegate his power to any of the 3 category of people, not below the deputy director. So words used are a director or any person not below the rank of deputy director, if authorized by the director, has reasons to believe in writing, have proper reasons why this particular property is involved in money laundering, why this person is having proceeds of crime. What's the logic here? Director or any person not below the rank of deputy director authorized by the director has reasons to believe in writing based on the material in their possession. I have certain documents in my hand Based on these documents I have a clear understanding that some person is having proceeds of crime. And this proceeds of crime, we have to conduct a proper inquiry, we have to conduct a proper investigation and prove that it was involved in money laundering. But by the time I prove it, there's a time gap between the process. It will take time for me to conduct inquiry and conduct investigation. And if we initiate this process and the person knows that we have initiated it, the person will obviously try and make sure that property is concealed, property is transferred with, property is disposed of, property is completely scrapped off, or do such other activities as may he do in order to make sure that the property will not be confiscated. It will frustrate the proceeds of the PMLA Act for the purpose of confiscation of such property involved in money laundering. It will be, in simple words, it will be difficult for me to confiscate it. Hence, the process starts with the topic that director, if he believes that the person has proceeds of crime and the person can do such things which is going to make it difficult to confiscate, it will frustrate the proceeds of the act, he may apply for something called as provisional attachment. Who is doing provisional attachment? Director. The director will have the right of provisional attachment only after getting a prior approval from a magistrate. He has to apply for magistrate or first class magistrates, basically district courts. He'll apply to the district court, get a cognizance of it, get an approval for it, then he can provisionally attach a property for a period not exceeding 180 days. Now in this 180 days, we have to complete the process of inquiry and come to the conclusion whether this is involved or not involved with money laundering. But I, the director, will not do the process of inquiry. I'll forward this information to the next level of authority called as adjudicating authority. They'll conduct an inquiry. So are you guys getting this point? This 180 days of provisional attachment which we have is distributed between two people, the director as well as the adjudicating authority. We have to give as much as time possible to adjudicating authority to conduct their inquiry, which shall not be disturbed by transferring or dealing with the property. Hence, the director shall transfer all the material in his possession, all the documents, all the records he has collected to the next authority, adjudicating authority, within 30 days from the date of provisional attachment. That's your provisional attachment. First concept done. Amma, put everything together quickly. A director or any person not below the rank of deputy director has reasons to believe in writing based on the material in their possession that a person is having proceeds of crime, and the person will conceal or he will transfer or he will dispose of or do such other things which will frustrate the proceeds of this act for confiscation of property involved with proceeds of crime. Then the director can make a provisional attachment for a period not exceeding 180 days only after getting an approval from the magistrate. He'll go make an application, magistrate will give him an approval to provisionally attach it. During this provisional attachment period, we have to complete the inquiry, which is not done by director, which is done by the adjudicating authority. Hence, provide this information to adjudicating authority within 30 days from the date of provisional attachment. Once it is received by adjudicating authority will go through the material given by director. And if adjudicating authority has reasons to believe that property is involved in money laundering, who also believes it? Adjudicating authority also believes that property is involved in money laundering, they will send something called a show cause notice. They'll send a show cause notice to the person, asking the person to show the reasons why this property shall not be considered as property involved in money laundering and why shall it not be confiscated. You guys come and prove it that it is not money laundering. You give me your reply and I'll give you a time limit of 30 days to reply for the show cause notice. Are you getting this point? I'll send a notice, reply within 30 days, show me the causes why the property shall not be considered as involved in money laundering, why the property shall not be confiscated by the central government. Now, once this is done, the adjudicating authority will consider certain things. Consider the reply. Here, both director and the person who is involved in money laundering, and they'll collect all such material information in their hand and pass an order. If they, on a conclusion basis, believe that there is involvement of money laundering, they'll pass an order stating that the provisional attachment made by the director in the past is now being confirmed, and this provisional attachment is now converted into an attachment, which is for a period not exceeding 365 days. What was the first topic, Amma? Director has done something called as provisional attachment, which is not more than 180, during which will conduct inquiry. Now the second part, the adjudicating authority confirmed the provisional attachment and made actual attachment, which is for a period not exceeding 365 days. During this 365 days, we have to now start collecting evidences that it was involved in money laundering. We have come to the point that it is money laundering, but we have to collect evidences to prove in the court of law. Now, in this 365 days, we'll conduct a investigation. After investigation, collecting all the evidences, we'll present it before the special court. Now, the special court has two options. Concluded stating that property was involved in money laundering or it was not involved in money laundering. If it was involved in money laundering, they will confiscate the property and it will now be vested in the name of central government. But if at all they give a conclusion that property was not involved in money laundering, they'll pass an order stating that the attached property must be released, must be given back to the person to whom it belongs. But one more extra point here, the adjudicating authority is not a single person, it's a group of persons. It's a combination of one chairperson plus two members. These two members must be having knowledge of the four fields we have: law, accountancy, finance, and administration. Law, finance, accountancy, and administration. They must be having knowledge about any of these four categories, one chairperson and two other members. Are we comfortable with this entire logic? I hope. This is a single process, but happens through different category of people at different stages. If I had to put everything together in a single process, director will do something called as provisional attachment, which is not more than 180 days, during which we have to conduct an inquiry. Inquiry process will be conducted by whom? Adjudicating authority. After conducting inquiry process, adjudicating authority believes that there is money laundering, they'll convert that provisional attachment to attachment, and this will be for a period of not more than 365 days, during which we'll conduct the investigation. Investigation will be done by the special court. Once the special court believes that there is actual involvement of money laundering, they'll confiscate the property in the name of central government after considering the investigation procedure. This is what the entire process happens with bits and pieces added. And this is also important. Adjudicating authority involves one chairperson and two other members having knowledge of law, finance, administration, and accountancy. Any doubts in this process? Go through this. This is very, very important. I'm expecting this to be asked in the next exam, probably in your December attempt itself. It will be very important for exam. For doing this, we have to establish special courts in the first place. So the PMLA law, for the purpose of PMLA law, the central government has established special courts. These special courts established will be which will be seated by a judge in consultation with the Chief Justice of High Court. The Chief Justice of High Court in a particular area will mention a particular court judge to act as a judge for these special courts to deal with PMLA procedures. While they are dealing with PMLA procedures, just take an example. If say you have sold the drugs and you have received proceeds of crime and you are trying to convert this into white money, untainted money, and money laundering process started. Money laundering, as we have discussed it, money laundering is only on the focus of converting money. But while conversion, the court is dealing with money laundering, they can also deal with the scheduled offense through which the money laundering happened. So that rather than having multiple courts and multiple procedures and multiple judges involved in a process, we'll have a single court, single procedure where everything happens with one judge. So he will not only deal with money laundering, he'll also deal with the scheduled offenses through which money laundering has happened. That's your special court topic. Then, if you're not satisfied by the order passed by court, you can go make an appeal to a appellate tribunal. Appellate tribunal has been established, which is again similar to the process. This appellate tribunal is consisting of one chairperson plus two members. Who can make an appeal to appellate tribunal? Adjudicating authority passed an order. Remember this, adjudicating authority passing order can be of two types. Either they might pass an order in favor of the person, or they might pass an order in the favor of a director. This topic we have discussed. Adjudicating authority, after collecting all this information, if they believe that there is no money laundering, they'll ask the provisional attachment to be released. That means it is an order passed in the favor of a person. Second category, they believe that there is money laundering. It is an order passed in the favor of a director. A director or the person, their order is passed in favor. Now the opposite point. If it is in favor of director, it is against the person. If it is in favor of the person, it is against the director. A person who is aggrieved by the order passed by adjudicating authority can make an appeal. Either it may be director or the aggrieved party. Who can make appeal? Either a director or the person who are aggrieved by an order passed by adjudicating authority can go file a suit with the appellate tribunal. Second category, the reporting entities we have learned about. These reporting entities have to report to whom? FIU India, and FIU India will have supervision over them. If at any point of time FIU India feels that they have not fulfilled their obligations correctly, FIU India will pass orders and put punishments on such reporting entities. If a reporting entity is agreed by an order passed by FIU India, they can go make appeal to the appellate tribunal. So what happened here? Appellate tribunal has, as we discussed, how many? One chairperson and 2 members. Where we did not have much of judges available for this, so we borrowed from another appellate tribunal called as Appellate Tribunal for Forfeited Properties. A chairman and 1 member of Appellate Tribunal of Forfeited Properties will automatically act as Appellate Tribunal for PMLA. So the same person will deal with forfeited properties as well as same person will deal with PMLA procedures, making sure that we are using them optimally through 2 different laws. That's your process of appellate tribunal. And the last, STRs. This can be asked in MCQ. What is the full form of STR? Suspicious transaction report. They have to report the transactions. Every banking company has to report suspicious transaction, whether or not they are made in cash, to the FIU India, so that FIU India will analyze, process and disseminate information. What will be called as suspicious transaction? Again, as we discussed with the reporting entity, they will not clearly provide what exactly suspicious. They have given a vague answer. Start with this point. If the amount of money deposited in your bank account is unusual and unjustifiable, it is complex in nature. Amount is received from multiple people, X amount of money, same amount of money received. It is unjustifiable or complex in nature, or it is not matching with your economic income you generate. You are generating an income of, as we discussed, 10,000 of stipend, but you have been deposited with 1 crore. You have been deposited with 10 crores. It doesn't have sense to your income. It is not rational in nature. They'll report it. Or any other thing which they have reasonable grounds to believe that it is connected with proceeds of crime. I know it is very vague in nature. They have given just situations or circumstances very vaguely. This might be suspicious transaction report. But you, for exam perspective, remember this in this order itself. Either it is unusual in nature, it is economically irrational, or it is reasonably believable that it is connected with proceeds of crime. The banking company will forward it to the FIU India. I hope the chapter is clear. This is something which is important. Attachment. Second, reporting entity obligation is something which can be asked as a question. And obviously, penalty has been asked and process has been asked. 4 major questions. That doesn't mean that you're going to leave rest of it. Entire chapter is important. As we discussed at the beginning of this session, 7 marks will compulsorily come from this chapter. Make sure that you are comfortable with the entire chapter, guys. I've done a clear-cut, in-detail revision itself. If you have any other doubts, please do leave in the comment section. Thank you.